All right, what's up, guys? Let's go. It's Monday morning, and this is going to be a very, very interesting week. I think it's very interesting that just immediately Kramer's on the horn talking about how today is now Nasdaq's higher, fifth day in the past 6 days. I don't think anybody will that invests heavily in Nasdaq stocks thinks that like the whole thing is sage now since the Nasdaq opened up this week and is up 5 since the last 6 days. Because it is still way down from its high. It is still, what, over 1.5 points down in the last week. It is still 3.5 points down for the last month. So it's only up 4 points in the last 3 months. It is down 5.5 from its high back in, when was that, January was the high? No, early to mid February. We hit 14,000. So, uh, I mean, I know that CNBC likes the headlines just as much as the rest of us, just as much as the clickbait titles and thumbnails we all put here on YouTube as well. But the NASDAQ being up 5 days out of the last six is not in a good place. So, for the love of Jesus, Mr. Kramer and CNBC, let's fifth straight positive month. I, in, in what universe do you think it's on straight on track for a positive month? The only thing I think of is that on the first, it started low. Okay, it opened 13,192, so it's barely up, barely above just this morning green since the beginning of the month to date. So, but since it's high mid February, it is way down, way down. So, these guys can talk all they want about it being a good month for the Nasdaq. I think they are full of it. I don't know what they're looking at. To me, this month has sucked for the Nasdaq and um, tech stocks and any of that crap. So, yeah, that is. But anyway, so what we're looking at here is uh, the big stocks we're really watching are AMC, GameStop, and a few others. You can see Tesla's coming out of the gate strong this morning, which is really good. It's up 5% already. GameStop pre-market, look at this. It went down and then just surged way up and it opened right. Let's see what it actually. It opened right here, 205 after being 197. Pre-market early in the surged up to 210 quickly and then dropped down to 200. Now it's trying to make a comeback. GameStop, it seems like there's going to be, I think, a lot of volume the next 2 days. I believe someone could probably correct me if I'm wrong. I haven't looked into it perfectly, but I believe GameStop's earnings are tomorrow after the market. I don't believe they're before the market. And I might be wrong with that, so feel free to correct me if I'm wrong. I'll look it up just to double check. I believe they're after the market tomorrow. So if they're after the market tomorrow, you're going to see a lot of people getting into a position today, and you're going to see tons of people getting into position tomorrow. I think we're going to see just an absolute insane amount of volume and trades and possibly some crazy volatility over the next day, especially tomorrow afternoon. After 1, 2, 3 in the afternoon, into that last couple of hours, I don't know what to expect. I have no idea what to expect with these earnings for GameStop. I mean, we know they're not going to be good, but it really doesn't matter anymore what's actually good or not good. What does matter is whether it's positive or negative compared to the estimates that someone else has put out there. And even not a single person on Wall Street Bets is tracking what uh, what is it, relative or whatever the estimating company that they always compare the estimates to. Not a single person is on Wall Street that's looking at that and comparing what their value of the stock at and the prices they're trading today. So it's completely meaningless. But once the uh, once the earnings come out, those are the estimates that they showed against. So if the estimates come out, if the estimates are crazy low, it'll post, let's say the estimates are they're going to lose 50 cents per share. And they come out and say that they only lost 45 cents per share. Then it doesn't matter. I mean, they could maybe estimates 40 cents per share and look like crap, but they maybe estimates 50 cents per share, so it looks amazing. And I'm not saying the estimates aren't real and not scientific because there's people that are. I'm just saying that it's an estimate based on some third party's estimate, and the stock price completely just automatically reacts based to a comparison to an estimate, and rather than just actually the fundamentals of the company. Just just weird. The public market valuations just in general are crazy. Not even talking about these meme stocks. It doesn't necessarily have to do with what the company could actually trade for, like if there was a company buyout or something like that on the private market. So um, I expect there to be a lot. If there is a lot of trading tomorrow, if there is positive earnings and overestimate tomorrow on their earnings, then to me, no doubt in my mind, it's going to fly. I don't see, especially with the slightly uneducated retail traders that are trading these stocks that happen to be watching it. I don't believe we're going to see this massive decrease if the earnings come out higher. There is actually a chance that the earnings come out higher than estimated because we've seen the same thing from Express, we've seen the same thing from Cost, we've seen the same thing from AMC over the past month. All three of those companies have all three of the investments, all three of them did much, much better. All three of them are benefiting from not only the carryover, I guess the negative estimating of the carryover of the pandemic, but also into the future, looking forward, especially AMC, looking forward into the future of what the potential of these stocks can do. So, yeah, lots of interesting information. We're going to zoom in on some of these costs, not getting tons of volume today. Um, Express not getting tons of, at least not a lot of pre-market, but a little bit more here to what 100,000 shares right when it opened on Express. Cost the highest rate was 20,000 shares, so a lot more Express. Then again, the prices were cheaper, so that's part of the reason. AMC is just out of the gate today. I mean, it closed on Friday right at 14. Yeah, remember the weird day we had it with AMC on Friday, where it hovered at 14 literally the entire day, never shot up above, went up to 14.7 very briefly before the close, and then right back down to 14. And then it just kind of trickled down over the weekend in after hours trading, and here we are. So nothing great going on. It trickled down quite a bit. It actually opened at 13.15 compared to the close on Friday at 14. So huge drop, unfortunately. Bottomed out here at 12.46 right after the open. Looked like it was going to open very poorly. It kind of bounced a little bit and was settling right back down. 12.85. That's down 7.5%. GameStop had a huge surge out of the gate, and now it is selling. I still think we're going to see so much action from GameStop over the next 48 hours. It may or may not stay high. It may crash, may surge. I mean, in the next between now and Wednesday, GameStop could hit $400 and it could hit $100. It really is completely non-technical, no mathematical. It was literally game with what's going on with GameStop earnings coming out and the retail traders. So um, I would not base any stock or any purchase or sell of GameStop in the next 48 hours on any sort of fundamental basis. It is literally, if you buy a stock, if you put $200 in to buy one share, expect to lose $200. If you cannot stomach that, don't get in. Don't. It's like if you go to the roulette wheel in Vegas and you put $200 down on black and you roll around, if you can't stomach losing that $200 in an instant, don't do it. That's exactly the game you're playing with GameStop over the next 2 days. So, uh, could it double? Sure. Could you lose it all? Sure. Yeah, I don't know. I don't know what else to tell you. But it is still fun and exciting to watch this phenomenon that's happening with the stock market in the past 2 months. So I'm glad to have you guys join me on the way. Let's see what we're looking at. Out of the gates, we saw pretty good stuff coming from all the markets. I usually like to let it set in for a few minutes before you really look at the broader market. Dow is down slightly, but looks like on its way up. Nasdaq's up and slightly on its way down, but not bad. And S&P is up slightly and continuing up. So hopefully that means everything's going to just be on the up and up today. Looks like oil dipped down overnight to just above 60, but back up to 61. Looks like over the weekend, it was this Friday, it dipped down to $58 a barrel. So might be seeing a little bit of relief as oil is down 8% from its high last week. So that's good. Usually it takes at least a week for the delay in the oil price of barrel of oil to translate to the price you pay per pump. Bitcoin was up a little bit, but it's down from its high this morning. Hit 58 this morning, now it's down to 56.9. The volatility in Bitcoin lately is crazy. Not just the surge in the past 6 months, but I mean just the volatility of intraday. I mean, we saw one day, what was it last week? Was it Friday even? Friday or Thursday or Friday when it went a 10% swing in a matter of 10 minutes. That was just insane. So if you got in a weird dip, then good for you. But yeah, I mean, we're seeing swings of 2, 3, 4% within minutes or within an hour of each other. It's not like it's you know crashing. It'll swing down, swing way back up, and swing down, swing way back up, and we're all still trending up. The last 3 months were way up. The last month we're way up. Over the last week, we're actually slightly down over the last week right now, down 4%. And it in a few days over the weekend, and it's down 5% from that. I mean, so continue. If you see dips in Bitcoin right now down, 10%, with 10% dips, I mean, there's opportunity to buy the dips. Uh, I've got limit buy orders in at extreme dips. I might actually adjust some limit buy orders um, on some of the more mild dips. Maybe buy in again. I might buy in again at 55. Uh, right now I own it at 43, 46, I think. So I have a decent profit, but I don't have much. So I'd like to continue to add more, but I only want to add more when I'm buying dips. Um, Looks like we're continuing to see all the major ETFs, the index ETFs, Triple Q doing well, Netflix doing well out of the gate. Let's see if we see anything else on the watch list that's extreme. So the Asana got 3%. I think it's not up all the last couple of weeks, but I think Asana is a good stock. Um, it just didn't do, even though it beat the earnings report last week, it was in the middle of just a crappy couple of weeks at the stock market, and it's a tech stock. And so, to me, that's when you see a tech stock beat earnings and then it's in a slump like this, and over the next couple of days it crashes down, it's a great opportunity to buy. It's a great, I mean, so Asana, that's a great opportunity if you're able to get back in. You saw the same thing with Stitch Fix, even though their earnings report was actually worse than expected, but they also crashed. I think everyone was coming in to bounce back up. Sure, it did. Let's see. Roblox back up 2%. Ark Invest up 0.8. Strategy down 2.9%. Riot Blockchain down 4. So some of these companies that are greatly influenced by the price of Bitcoin are down a little because Bitcoin's down 1%. So let's just get back to watching the news and see what happens. We're looking at AMC still crashing, not having a good morning already, down nearly 10%. GameStop up very slightly, but it looks like it's trading with a relatively high volume, but not a whole lot going on actually. I mean, it's just hovering on the same cost. Hopefully, is going to turn north. But again, I'd love to see costs get up over 30, maybe $40 a share. And Tesla, who we're watching here on the side screen, had a big surge and is now going back down. So Tesla, again, it's one of those where I feel like I want to get back into Tesla if it goes back into the fives. Right now it's at 681. I personally feel it's too overpriced for me to buy back in right now, especially with its volatility. I expect it to dip down greatly at some point, buy the dip, ride it back up. That's my plan with Tesla as well. So we are just going to click back to the games, listen to them, and see what they have to say. They're smarter than me. I have it on CNBC enough, but I don't love CNBC's morning coverage. Not because it's not, not because they don't know what they're talking about, just because it seems like that morning circus morning show, just like your radio zoo bells and whistles and crap like that. So, well, it's a commercial break, so let's switch over to TD Ameritrade TV anyway. In the mornings, they actually just talk about stocks, which is good. In the afternoon, I think CNBC's so, even though I don't dislike Jim Cramer, I actually do like him. The mornings are just sometimes tiring to watch. it's really good. So anyway, and of course they're a commercial break too. But I'll turn the volume up when we come back. We can watch. And just keep an eye on these stocks on the screen because right now it's not looking like a great day for them. Good day for the overall market, not a great day for these we're looking at.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
I'm Jenny Horn. Here's a few of this morning's movers to kick off the trading week. PepsiCo is higher after a Barclays analyst upgraded the stock to overweight from equal weight. The analyst said she's been perplexed by Pepsi's underperformance within the staples sector. She notes the company is one of the few with clear visibility into achieving its algorithm in 2021, which could provide a multi-year stock appreciation story. DraftKings is unchanged on the day after Loop Capital doubled down on the stock as a top pick. Loop Capital said this call was due largely to the growing sports betting markets and the huge opportunity ahead in New York online gaming. The firm said that based on New Jersey's existing sports betting and iGaming, they estimate the online gaming opportunity in New York to be roughly $3 billion, and DraftKings stands to benefit. And 2 Royal Caribbean cruises will resume sailing in June, ending a year-long hiatus. The company's Celebrity Cruises subsidiary announced Friday that its Celebrity Millennium cruise ship will relaunch on June 5th. Celebrity Cruises CEO said this return to the Caribbean marks the measured beginning of the end of what has been a uniquely challenging time for everyone. Royal Caribbean is lower today, as well as the other major U.S. cruise liners. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Oliver Reddick.
It's time for Inside Out. Let's talk some fundamentals, get some picks, and trade. Joining us from the Hennessy Focus Fund is the co-portfolio manager, Ira Rothberg, to talk a couple stocks. All right, welcome to the show this morning. I want to kick it off with Restoration Hardware. Let's go straight to RH, technically the name. Is this one that still has room to run, or has it already been pricing in this big housing boom that we've seen as folks have bailed from the cities and been buying fancy couches for the new fancy suburb homes?
Thanks, Oliver. We still believe RH is in the early innings of its growth story. It's transforming its real estate footprint, moving from smaller mall-based locations to prestigious off-mall locations. We're talking a change in square footage from 8,000 square foot stores to 38,000 square foot prototype stores. And they're really building a luxury brand here. You know, to understand RH, you have to understand its chairman and CEO, Gary Friedman, who really transformed this company from an almost bankrupt purveyor of home accessories 20 years ago to really a leading luxury brand that stands alone. So we think they can double their sales here in the United States over time. And then there's an even bigger international opportunity. They're going to be expanding into England in 2022. But we see RH moving from about a $2.8 billion in sales company today to north of $20 billion over time. And we think over the next decade, they can compound their earnings per share at more than a 15% annualized CAGR. And the share is still only traded about 25 times forward earnings, which is a significant discount to other luxury brands.
Ira, I'm looking at the B-roll right now from Restoration Hardware, and I miss being able to go there. The only thing I've ever bought from them are their blankets. They are darn good, but I kind of miss the social atmosphere of it. Isn't that like part of the big story here? I mean, I think that what's interesting about this is, to your point, those kind of upscale, fancy, the restaurant. I mean, there's a whole other side of this that can almost be viewed as like a consumer services business.
Yes, they're really revolutionizing retail with their new prototype stores with restaurants and barista bars and wine vaults. You know, these are really quite an experience. I encourage your viewers to go check out some of these experiences. And these restaurants, can draw 3 to 5 times the traffic of the stores that don't have restaurants. And so you don't buy furniture every year, but this introduces consumers to the brand and it makes it aspirational. So again, we're in the very early innings here.
Okay. So RH up about 2.5% today after we've climbed all the way from $73. Now, in terms of thinking about what this company trades at on a valuation basis versus its peers, I mean, should this be trading as kind of lofty next to some of the other brick and mortar comparables? I mean, I know that the case here for them is particularly strong, but at what point, does an investor kind of draw the line on what they pay for a consumer stock like this?
Well, because they built this luxury brand up, the brand now has pricing power. And because it has a luxury brand, it also earns luxury margins. So, we think that they can maintain an operating margin, north of 25% over time. And their peers aren't anywhere close to that. A return on invested capital over time, they'll be north of 50%. And they have a very visible growth runway as they move from these mall-based smaller stores to the off-mall, a larger format stores. And then, we already know that the brand is very successful with international customers who order from across the sea and have it shipped to them. But, we think that the brand will translate overseas.
Okay. Stick with us, Ira. We got one more pick, but we're going to trade Restoration Hardware now. Let's bring in our own Tom White. Tom, as the stock opens up, it's a gap up higher from the previous high. It looks pretty great on the chart this morning in particular. How do you want to trade this thing?
Well, you do have to realize that they have earnings on Thursday, so you've got to take that into consideration. So volatility is elevated in there. The option market's pricing in a plus or minus $50 move either way in the shares. And as you mentioned, this stock's up over 500% from a year ago period at those March lows when the pandemic started. So take that into consideration. And also, there's only 20 million shares that are publicly traded. So the float is extremely small. So volatile moves can happen in this name. So keep that in mind. So stay risk defined if you're going to trade this going into earnings. But based on Ira's analysis here, if you're bullish on this name going into this earnings, maybe a short-term trade works out where you're staying risk defined. You know exactly what your downside is. So I looked at buying a call condor in here, Oliver. We're going to buy a bullish call vertical and then sell a neutral to bearish call vertical against it, creating this four-legged spread. I'm going to buy the 520 calls, which are in the money. sell the 540 strike calls, so creating that $20 wide bullish call vertical. Then against it, I'll sell the 560, 565, only $5 wide call vertical against that to reduce my initial cost on this trade. If I pay roughly a debit of about $7.25, that's my entire risk per spread, right? $725. Taking advantage of an upside move in here. You see that break-even point about 527.25 over the next 4 days. Really short-term trade. Okay. But you get to gather all that upside. It starts to level out above 560, but the apex of the profitability between those two short strikes, between 540 and 560. So if you're expecting Restoration Hardware post-earnings to start to move higher, this is the type of position that takes advantage of that without having to buy those shares, Oliver, because for 100 shares, it's going to cost you about 50 grand. So this is a less capital-intensive way to take advantage of upside going into that earnings report.
Okay, so basically anything from here you're making money on from 527 up, which is where we're trading right now. All right, Tom, you're going to trade CarMax with us, but let's hear the case first from Ira KMX. Walk me through why you want to own this right now when it's been living in the shadow of Carvana for the past year.
Sure. A little over 2 years ago, CarMax introduced its omni-channel concept first in Atlanta. And we've seen very promising results out of Atlanta, which is a market that Carvana's been in for some time. CarMax has shared that they have over 20% 2-year stacked comps in Atlanta. And today, their omni-channel concept is rolled out nationwide. And, they're still perfecting it, but they're starting to put ad dollars behind it and really introducing the new capabilities to the American consumer. And so we think this has the opportunity to expand their market share well beyond the 4% share of late model used cars that they sell today. And CarMax today has about 220 stores, but over time we see the opportunity to have north of 300 stores. The shares traded about 20 times our estimate of next 12-month earnings, and we think the business can compound EPS at more than 15% for the next decade.
Okay. All right, thanks for the picks here. We're going to get to CarMax. Appreciate you joining us. Good stuff. With the ideas, let's go to Tom and let's trade this one. KMX. Little change today to the downside, Tom. But it has been making a move here. As I mentioned, obviously competing with Carvana, which has been trading a lot loftier. What do you see here as a way to play CarMax?
Well, you got to remember, this stock just hit all-time highs above $136 a share just last week, Oliver, going into earnings that they have on the 1st of April. So that's going to add some volatility in those near-term options here. So I looked at maybe something a little bit more long-term here to take advantage of that higher elevated volatility in the April 1st weekly series, while still being bullish on this name, if that's your assumption. So going out to the May 125 strike calls, which are about $8 in the money. So that acts as a stock replacement type of call buy because you're buying a higher delta call. Then against it, because volatility is elevated in the near term, sell the April 1st weeklies, the 140 strike calls, paying a debit roughly of about $10.80. So for every spread that you buy for this call diagonal, you're going to have at risk about $1,000 on it, and that's going to be your downside. You can see the break even's about $130.75 at or near there, but as opposed to buying the shares at $133 a share, this is less cost prohibitive for a lot of traders here, and you still get to take advantage of that upside. Now, the apex of the profitability, you can see from the risk profile there, is at that short 140 strike. So the ideal situation going into earnings is that CarMax continues to move higher, grinds up to new all-time highs around 140, and that allows you to adjust or roll that short option on a week-to-week basis, collecting credits, reducing your break-even, reducing your risk, and increasing potential profitability. So a call diagonal or stock replacement type strategy might be in the cards here if you have that bullish assumption over the next 2 months, because you are long that May 125 strike call, which expires in 60 days.
Okay. All right. Thanks, Tom. Two very different trades here, but both bullish with the exposure for these stocks from Ira Rothberg to perform going forward. Thanks, Tom, for the trading. When we come back, we're in hour 2 of the show. We're going to talk about existing home sales that came in a little bit below expectations. We'll be right back.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Welcome back to Morning Trade Live. I'm Oliver Rennick. We are in hour 2 of the show. 30 minutes into trading. NASDAQ taking off and the Russell breaking apart a little bit. First signs of weakness that we saw last week in the sell-off on Thursday from small caps losing a little bit of their momentum. So we got some more of that this morning. We'll see how it develops. We're going to talk some data. We've got existing home sales came in slightly below expectations. The morning trade, lumber liquidators from Alan Nuckman. We're going to talk about ETF stories to watch this week with Dave Nadig, and the chart master has a few more upgrades and downgrades for us that we will look at on the technicals. Right now, let's go to Ben and let's check in on the data. Been a rare miss from the housing department, but what we have seen is just some slight choppiness in some of the housing data the last couple of weeks. Maybe rate related, maybe not, but they used to just hit and beat, and now it's kind of a hit or miss.
Yeah, you know, Oliver, I'm just checking in on the indices real quick to see if we're getting much of a reaction to. They're coming off just a little bit, but 3 of the 4 are still positive. You got the NASDAQ, which has been and continues to be leading the way. But as you mentioned here, a little bit of a miss in terms of the housing number here this morning. There's going to be a lot of focus on housing in general this week. We've got rates on the rise, and certainly this has been one of the pillars of strength that we've seen amongst the pandemic. Existing home sales today coming in down 6.6% in February, as you can see. Seasonally adjusted annual rate of 6.22 million. The median existing home sale price rose to $313,000, Oliver. That's 15.8% higher from a year ago, with all regions posting double-digit price gains. Now, as of the end of February, housing inventory remained at record lows. Keep in mind, it has been and continues to be, it looks like. This month, they're reporting that inventory of 1.03 million units. That's down by 29.5% year over year, a record decline. Properties typically sold in 20 days, also a record low. So we've been hearing about, again, not only how fast these properties have been moving, but how we're seeing multiple bids coming into play, Oliver. And this number is still kind of feeding into that narrative in terms of supply being very limited here. And the housing market still being fairly strong, again, down 6.6%. I wonder how much of that is related to some of the weather that we dealt with last month.
Yeah, I think that's a good point, where we don't want to get too carried away with kind of some of the weakness here, given how robust and how powerful the housing trend has been. We should definitely give it credit for the strength that it's had. Home builders last week went to an all-time high after Lennar earnings. But it is just something to keep an eye on, because it was very, very reliable. I think maybe this is just about maybe expectations than it is levels, right? Most of the levels in these numbers are still elevated. They're still good. It just seems that maybe the economists' understanding of this finally caught up to the reality, and now the expectations are getting a little harder to beat.
Yeah, none of the existing trends that have been at play, Oliver, that have created this scenario where we have, again, these tight housing markets here and really strong for the most part. None of those trends have really been removed from the narrative here, from the discussion. I think what's important just to keep in mind is that there are some concerns about the impact that higher rates could have on housing. And but in theory, there's an argument to be had that could speed things up a little bit as potential buyers try and get ahead of rates on the rise and start to move a little bit more quickly. Speaking of some of those trends that we've been seeing, Oliver, let's take a look at a product that I think a market that your viewers should be keeping an eye on. Not only does it feed into that narrative in terms of what we were talking about earlier today as far as the dollar, as far as rates to the upside derailing some of these trends, or in this case, lack thereof. You can see how rates to the upside haven't really impacted copper yet too much. We just recently traded up to the 437 level. We oftentimes do find resistance up and through this $4 level, and it does look like the market's just kind of taking a little bit of a breather. Here you can see it on the daily time frame. Step back from that daily, and look at this run up that we've seen off the pandemic lows here, Oliver, from below $2 to up to, as again mentioned, around the 440 level. Here you can see, though, a hurdle to get up above that 450 high from the summer of 2011. But just to give you an idea of where we are right now, we're talking multi-year highs here. We're talking 10-year highs, as you can see in copper, as we came off that $2 test. And I want to point out here, again, tying it back to what we were talking about earlier, copper directly tied to that rate discussion. Here you can see, again, copper in the candle still, and the sideways consolidation as rates have spiked. They haven't really made copper roll over or really raise too many concerns here. I also want to point out here, if you're talking about copper, you're talking about the indices, because it's a reflection of the economy, demand, not only here in China, but globally. So ultimately, you can see how closely these two track each other. So again, in terms of the trends that we've been seeing, higher rates, and whether you're talking the housing market in general or some of these products that we watch, it doesn't seem as if rates to the upside have been derailing some of these existing trends.
Yeah, certainly not yet. So it's going to take some more convincing to keep copper down. Ben, thanks for the update. Appreciate it, BL, host of Futures and Midday Movers. All right, with that, let's bring in Pat Mullally. Let's talk a little bit about some of the technicals and some of the home building side of the story. Pat, KBH is on your radar today. We've got earnings coming up this week. Lennar really shocked with the explosive move higher, but wasn't just some of the macro themes. Lennar and some of the tech that they're using as well played a role in some of that profitability. So walk me through what we're looking for here for KB Homes.
Yeah, so I think it is part of that macro thing, and that the operative word this year seems to be supply, whether it's supply chain issues, chips, containers, whatever, housing's lumped in there as well. So the long-term trend has been up, and it's recently breaking above what we call a double bottom cup and handle. And that's important because we can measure the distance between the low of that cup to the high of that cup to get us a resistance point, which should come in right around 50 if it can continue to the upside. Now, the housing, the existing home figures that came out today had about a 0.3% impact on the price of KB homes, so it wasn't really much of an earth shaker. It did last week. KB did hit not an all-time high, but a high it hasn't seen since 2007. So we're seeing the prices move higher. It's continuing to make these higher highs and higher lows. And the all-time high is not too terribly far above this, but it is at 82, so it does have a way to go. There has been, again, it's tightening up. We're seeing the range of the days, and this is important, going into these earnings as far as the price action. Tightening price action, meaning the range of the days getting tighter and tighter, is just more that coiling effect on a shorter-term basis. Now, we do have a divergence in the RSI, meaning maybe a little bit of lack of momentum coming in there. But when we look at all the housing numbers that we see coming out, low supply in new homes, low supply in existing homes, we're looking at housing market index being at all-time highs, so that has a tendency to mark near tops, but it looks like rates aren't going to be a big deal and look to push these. We'll look to see these buyers push stocks higher in the home construction industry, depending on what KB has to say. Looking not too terribly bad.
KB Homes often kind of put in the same categories D.R. Horton, the first-time home buyers, the kind of mid-priced houses that have been in such high demand and short supply. That's been a big part of it. The supply story where we've heard, look, even if rates go up, there's still such a backlog for housing and need for housing for first-time home buyers that mortgages won't be an issue coming up from low levels. So for KB Homes, Pat, it seems as long as we don't really break down kind of further into that $40 to $42 range, then we can still categorize this as a pretty steady uptrend.
Right. It's been a little bit choppy over the last couple of months, but again, if it does break down into that support's going to, if we look at the lowest support, that's going to be the bottom of that double bottom, and that's going to be right around $39. That's going to, I think that would have to be a strong indication of negative earnings to come. But typically with home builders, they start to sell off way before the earnings make any kind of changes. So I'd watch those technicals pretty closely here. Now, again, like you said, this is new first-time buyers. It's also move-up home buyers as well. So the thing that we did see last week that's a little bit of a negative is the optimism as far as the home builders go was a bit lower, and that's because of some of the softer sales. But again, like you and Ben were talking, that may be coming from some of the harsh winter we had, and then those record lumber prices that may be putting a little bit of a dent into the builders' bottom line.
Okay. All right. So KB Homes looking to extend maybe that top side of the range if it's going to go the way of Lennar, but it's certainly an interesting earnings coming up, and we'll see what their messaging is going forward. We expect to see some pretty darn good numbers on a trailing basis. But what doesn't this market now understand? KBH and D.R. Horton, the two big winners in this category. Pat, thanks for the walkthrough here on the technicals and the chart. Good stuff. Pat Mullally joining us from Salt Lake. You need to build a home, then you're going to need some lumber. Let's talk lumber liquidators. Alan Nuckman's the chief market strategist at St. Paul Research. Alan, why are you thinking about lumber liquidators right now? Because today it's up 6%. Apparently your note on it went out just in time.
Yeah, Friday note, Monday boom. So we're all thinking alike here today. A little bit of some strength in this stock. Now this stock has done amazing from this $3 lows last April. It rallied 500%. Yeah. But since that time, it's backed off a little bit. So it's 30% off its highs in January.
Oh, what a steal!
I like this. It's a value now. It's a value. So it's a pause in a profit-taking pullback, which is what I like to see. So you talked about many of the fundamentals that are driving the housing market and the lumber market. So this stock was 120 back in 2013. So this stock used to be somebody, and it's looking like it's got some momentum once again.
Okay, so we find some support, and you're looking for another push here, Alan. And right. I guess you don't have any deep fundamental beliefs in the company.
No, I'm a chart person just like your last guest. So let's just continue the theme. So if you look at the charts traded between 5 and 35, so the midpoint of that is 20. So I'm looking at the $20 call for May. So that 20 is a super level of midpoint support to lean on. It's a deep in the money play. That's the stock substitution strategy. So that's trading now for about 8, and it's $7 in the money. So it's like being long from 20. Now, if you look at the chart patterns, there's so many positive things here. There's a gap up at 45. And if we do take out these recent highs at 35, a full V recovery targets 60. So there's a lot here that very much encourages me. But in the big picture, we didn't get a chance to talk about it. There's so many things happening. You've got the S&P coming now to that 4,000 that we've talked about for months and months and months. And the fact that the VIX went below $20 last week in new year lows, there's a lot of optimism in the markets. And I like how this chart has set itself up.
Okay, so you're looking at the $20 calls as you go with the standard Nuckman approach here, right? Which is quite a bit in the money. And the shorter duration here that you're looking at, about a month, a little bit over that. The reason for why you're going so deep?
Well, we've got 2 months here, so you're going out, which is not much further if buying the May option as opposed to the April, but you get an extra 30 days, which is huge. Looking for something to happen here in the next coming weeks, but I have extra time just in case I need it. But again, it's another example of if you wanted to buy 100 shares is what each option covers. 100 shares of a $20 stock, it's going to cost more money, obviously, than it would be to buy this option where you're long theoretically from 20. So you've got limited risk, you've got you've got some time, and you've got a high delta of 80-some%. So it's going to act very much like the stock, but without tying up the money and having the unlimited risk that you do in a stock. You have limited risk with this in-the-money option that can give us a big payoff if we just get a modest move, back into that 30-some range.
Okay. A little hardwood, vinyl, whatever your preference. You got to put something
ceramic
in your new home. Ugh. All right. Home building, lumber connection, and Liquidator's back from the depths. Looking for a little bit more. All right. Thanks, Alan. Appreciate it.
Thank you.
Alan, Chief Market Strategist at St. Paul Research. Buying in the money calls, looking for a move in lumber liquidators back in trend to the upside. Okay, when we come back, let's talk some big picture stuff through the lens of the ETFs. Let's talk about what to look for this week when we get back.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played.
Welcome back to Morning Trade Live. Let's talk about what to expect this week and beyond in the world of ETFs. Joining us, Dave Natick is the Director of Research at ETF Trends. Dave, welcome back to the show.
Thanks for having me, OJ.
Appreciate it. So what's on your mind right now? What's the most exciting thing in the world of exchange-traded funds?
Well, I mean, let's start with infrastructure and taxes. I mean, I think that's going to be the headline for investors here for a little while. Certainly, the Biden administration's probably going to package these two things together. We're going to see an infrastructure bill. We're going to pay for that infrastructure bill with one of a number of taxes. You guys have been talking about it too, whether that's changes in step-up basis on the estate tax, whether it's increasing the capital gains tax for the wealthiest taxpayers. All these things have people a little concerned, both about the taxes on their existing portfolios and about the opportunity to maybe take advantage of an infrastructure spend. I'm not sure it's the easiest play, though. There are two big funds here that I like. NFRA, which is the FlexShares product here, and the Global X Fund, which is PAVE, P-A-V-E. And they take very different approaches. They're both 47 basis points. They're both about $2 billion. People love these funds. NFRA really looks at a global basis. You get exposure to things like firms you might not expect, like the Deutsche Post and things like that. PAVE looks a little more familiar to a lot of investors because it has companies like John Deere or Eaton Co., right? Real industrials. And that's really the split between the two. If you really want that industrials play, you go for something like PAVE. You go for something like NFRA. You're really getting that sort of global reinvestment play.
Interesting. So NFRA is predominantly U.S., but it does get spread around a little bit, right? Where you've got exposure to a lot of different countries.
Yeah, they're both global in scope. I think the big caveat I have here, OJ, is that honestly, historically, government infrastructure spending doesn't just flow right into public equities, right? And it's not supposed to. The point of global infrastructure spending is to get money into municipalities around the world to do the projects that keep countries running, that would keep the U.S. running. You know, when you go to build a bridge in a small town in western Massachusetts, where I live, that's not going to John Deere. That's going to a local contractor through a local municipality, and that gets real jobs for real people who are doing that work. So it's great from an investment in the country perspective, but sometimes a little tough to play as a public equity play.
Okay, so now the main difference between these two, in addition to what you're saying, I mean, to look at it by sector, I'm just kind of looking at the sector breakdown right now. It looks like, to your point, PAVE is kind of this more pure sort of industrial play, whereas you've got a little bit of a mixed kind of sector exposure in NFRA. And right now, that industrial bid seems to be what's been driving a little bit more of the market action to the upside.
Yeah, and this is a little bit of, we always talk about this. Investor psychology is almost as important as fundamentals. People have to be wanting a stock. It doesn't just have to be a good stock.
Sure.
And I think people are looking at things like a John Deere or an Eaton, these big industrials that people know, as sort of logical plays, even though the economics may not make sense. I think if you're thinking longer term, the diversity you can see in something like NFRA, which picks up things like telecom infrastructure spend, which are going to be huge, I think that may be a better long-term play. If you're just trying to catch a bid on investor psychology, PAVE may be the order of the day.
Okay. Hey, Dave, kind of bouncing around from subjects here. As you mentioned, taxes potentially becoming a story. A lot of this has been building up over the last week and a half. I guess ETFs as a whole, there are areas here where you can have some tax advantage. Does that depend on what you're invested in? Or how do you think about how the demand for funds might shift based on what could happen in tax law?
Well, we're hearing from financial advisors that this is the big transition year. They're trying to position their portfolio so that when we do face a worse tax regime for a wealthy investor, they're already well positioned to not have to worry about cap gains. And that really means ETFs. In 2020, only 70 ETFs even distributed a capital gain at all. Almost all of that was just big bond funds that, frankly, didn't get enough redemptions to wash away some of those embedded gains because they have to roll off some of those bonds as they start to mature. So that's sort of an inevitable thing that happens in big bond funds. But in the core equity space, virtually no ETFs paid any capital gains. That's why we're in the midst of frankly, an absolutely bananas year on ETF flows. We're up to about $250 billion already just in the first quarter, putting us on track for $1 trillion year. I'm not sure we're going to get there, but last week's was $75 billion by itself.
That's wild. So it's getting a huge amount of demand, even as we've had a little bit of chop in some people's favorites, kind of growth funds, but not our focus today. Dave, let's talk about some of the other end with the momentum that's been working lately, which this year has been about reopening themes. I've been wondering where the back ETF is, right? Or like the go out. So like, where is the reopen? What's the best way to get exposure to this? I mean, I know there's airlines. We talk about away. Am I missing anything for someone who just wants to place a big bet on back to normal?
Well, the big bet on back to normal would frankly just be back into the market, right? I mean, we've seen the rally already in things like travel and leisure. We've seen the rally in energy, although that obviously pulled back a little bit in parts of last week. So I think a lot of those reopened trades, frankly, they've already been expressed. I think the bigger concern, honestly, I'm a little bit of a contrarian to what you're talking about, OJ. I think a lot of these work from home stocks have now been oversold. Like we've had some big pullbacks in some of these big names like a Zoom, for instance. And I think that we're exaggerating how much we think we're going to reopen, except for perhaps some of that travel and leisure. You know, I certainly know plenty of folks who've now been vaccinated and they're booking those vacations. So that's definitely real. But I think that really means just reinvesting in the core economy.
Okay. So we've been looking at the gains, some of the trends. We're looking at the away ETF right now, but you're saying the stuff on the other end that's gotten beat up. I mean, we've been talking about some of the favorites that are down, like the ARC flagships and such. I mean, what do you see in terms of how folks have reacted to that? Are flows going in, coming out when we see some of these favorites start to roll over?
Yeah, the reality is, funds that are really hot money funds where there's a lot of headline on them, like ARKK, for instance. Historically, what we'd expect to see is, yes, some of that money will flow out on every downturn, but that money tends to be stickier than you think it is. And I think the kind of transparency we're seeing out of the ETF industry really helps people stay invested, right? If you believed the core investment thesis from the folks at ARK, nothing's changed there. You may disagree with an individual price target here or there, but what you're doing there is hunting for innovation. And if you like the way ARK's doing it, nothing in the last couple of weeks should have changed your mind.
Okay. All right. This morning, we're getting a little lift in it, thanks to the Tesla move. Hey, Dave, the other story that's been percolating again, I saw some more applications for the good old Bitcoin potential. What's the status? Are we moving towards it? I mean, we've got like all the old school guys on Wall Street now embracing it. So
Scaramucci too, right? Yeah, I think we are headed towards one. We had the one in Toronto, BTCC approved just a few weeks ago. To my mind, that set the clock on the U.S., right? We tend to follow what Toronto does by about 6 to 12 months. I'm saying sometime this fall is when I think we'll see an approval. But we've got a bit of a problem now. The SEC's made this a horse race. We've got a bunch of filings in. They hate making winners. The SEC hates making one person a monopoly. So I suspect what we'll see is what we saw with non-transparent active. They'll come out with some guidance to the people who filed about what a Bitcoin ETF needs to look like. Everybody will get a chance to refile to match those parameters, and then it'll be off to the races. So I think, towards the end of this year is still probably the best bet.
Okay. Right now, the grayscale, the GBTC, just walk me through that again, Dave, the status of how much we're paying like per Bitcoin there, whatever.
Yeah, GBTC, I give these guys credit for creating a really innovative product, but people really need to know that the Grayscale Bitcoin Trust is not an ETF. There is no way for the Bitcoin to come out of it. It's a little bit of a roach motel. Bitcoin goes in, but Bitcoin doesn't come out. What that means is now that we've got all of these other ways of getting exposure, we're going to see it trade to discounts. When people want to sell their GBTC, there's no way to get that trading price back in line with fair value. So I think GBTC is a bit of a tough play right now, and most investors frankly have another way of getting exposure somewhere out there, whether they're getting it in a brokerage account, or they're trading in Toronto, or they're just frankly opening up a Coinbase account and getting Bitcoin directly. So if you're dying for an ETF, I'd hang out and wait for one. I wouldn't be plowing into GBTC hoping that discount's going to collapse.
Okay, Dave, thanks for the thoughts here. Appreciate you joining us back here on the show.
Thanks for having me.
Dave Natick is the Director of Research at ETF Trends. When we get back, Chartmaster has a few more upgrades and downgrades for us. We're going to take a look at Dollar General, Booking, and Snap.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Well, I say no to kale. Yeah, they say if you blanch it, it's better, but that seems like a lot of work.
Now offering 0 commissions on online trades. We charge you less, so you have more to invest.
futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
Time for the Chart Master. Let's get technical here with Mr. Ben Watson. 3 companies with upgrades and downgrades today, Ben. Let's go to Dollar General first. This is a weird looking chart, Ben, as we saw earnings gave way to a sell-off, which caught itself and then ripped back up for 3 days in a row, today being the 3rd.
Yeah, absolutely. And it gets this double tap off that support at 178, Oliver. And you know, that has seemed to now become a pretty important level of support. And you're right, we get this just rip back to the upside into this resistance near the 193 mark. And as a matter of fact, I think we're just off of that 193, just underneath that previous resistance. And that comes on an upgrade. And normally on an upgrade, we'll see a little bit of perhaps reluctance on the part of investors to buy it up and take it higher. But in this case, we're seeing it just roaring back up. It's at about 192 or so underneath that 193 resistance. If it can break out of that 193, that's kind of the apex of this W type pattern. And this W pattern is a typical reversal pattern from this short to intermediate term downtrend. We could see this back up on 206, which is that next resistance level overhead, pretty quickly. But long-term sentiment flattening out still down and oversold. Intermediate term sentiment making a really quick reversal from a higher low here after it pulled back out of overbought. So this is a kind of a shift. There's some volatility and shifting going on here, Oliver.
Definitely seems like some shift indeed, Ben, the kind of U-turn that it went on there. Evercore ISI had the stock at neutral in line. Now they say to buy it. So that's the bullish no doubt, where it looks like maybe the sell-off here to them presents an opportunity, an entry point. The market seems to be validating that somewhat, given that sharp reversal that you point out.
Yeah, absolutely. And I think that's why this 193 coming into focus so quickly, because it becomes important, because on this pattern, that really represents now a new higher high in the context of this reversal. That's why we look at these W type reversal patterns, because it bottoms, rallies back up, creates an apex in the middle, pulls back to a same or similar low, rallies back up, and once it breaks through that apex, above that apex, that makes a new higher high, and that becomes now the start of a potential uptrend.
Ben, what I think is interesting here that we really don't see that often again is the way it gapped down and then snapped right back. It seems that if we then take out a potential resistance level, adds to the case for short-term momentum. And then it seems like one might even be able to interpret that as still an entry point if we are picking up momentum.
Yep. Yeah, breakout of a resistance like this on a reversal pattern is a pattern that some traders do look for entries. The thing to remember is just because it breaks that resistance, in this case at the 193, doesn't guarantee that it's going to move to that next resistance level or that it's going to become an uptrend. But think about it this way. Every uptrend begins with a breakout. Not every breakout turns into an uptrend.
Gotcha. Okay. All right. Ben, let's go over to a few others here. Let's talk booking as we see the Russell and the rotation plays getting hurt this morning. Booking is holding on. It's up by about 40 basis points. Did see some softness in the latter half of last week, but we're coming off highs of almost $2,500.
Yeah, absolutely. We got this gap up sell off today on this upgrade. So it gaps up and it sells back down. It's not really kind of a bearish engulfing yet, but it's still down here near this point. So I think if we see this bounce up off of the support here at 2261, that becomes significant. It can bounce and move higher. Maybe it bounces, and here's the scenario that we could see play out in the next few days. it bounces higher to a lower high on the right-hand side, and this creates a head and shoulders type of reversal. Or it just breaks that support at 2261 on its way down perhaps to 2181 or so, that little double tail on those two candles that made that excursion lower. The other thing is it could bounce and we could get this rallying back up to that 2470, that previous high. So long-term sentiment just kind of gently drifting down out of overbought. Intermediate term sentiment, though, reversed quickly. It's at an equal low down near oversold. There may be a little bit more downside momentum here, Oliver.
Okay. All right. So booking, if we do break from here, then suddenly we have a little bit of risk for some reversal of the recent strength. But if it holds, then it seems to be a kind of good sign that this stock is stable at levels that it's achieved in its rally. Bank of America upgraded it, the upgrade that you mentioned, to a buy from a neutral and a price target with some substantial room to run here. $29.50, Ben. What do you think about that price target?
You know, I think that's not outside the realm, because if we look at this moving back to 2470 as the previous high, that creates kind of a symmetrical rectangle. We take that distance from the 2260 support to the 2470, we double that to the upside. That puts you just about out at that range. And so I think that's within the realm of the next couple of months worth of movement here.
Okay. All right. So booking with a little bit of a break from its ascent, but nothing overwhelming to the downside just yet by any means. Trend still intact. Looking to see if we form support at that area or if this thing breaks down. Today, holding on despite some of the reopened themes being lower. That ETF we mentioned with Dave Natick, Away, is down 1.8% today. The high beta stocks down 1.5%. They're biased towards reopening, so definitely some weakness in that cohort. Ben, last one you've got. Let's go to Snap, which had just a mind-boggling run, and it started to soften up a little bit. It looks like we failed to push back towards 70.
Yeah, it came off those February highs pretty quickly, but what it is doing, though, at the same time, Oliver, is it's squeezing into the symmetrical triangle, creating a streak, that's a Snapchat term, around that $60 mark, from squeezing into that level. Now we're getting a little bit of a bleed down below that lower trend line. It was initially a hammer candle as we saw the gap down open on this downgrade. If it can bounce here at the end of the day, we may see this back up on that upper trend line around the 63.30 mark or so. Otherwise, a breakdown may take it down to the base at 52, and then that 48 horizontal that's been there for a while. Long-term sentiment falling slowly out of overbought, intermediate-term sentiment rejecting that overbought line. You know, it might be an interesting scenario here. This may be the breakout of the triangle, or it may stay here and wind up a little bit more closely to the apex.
All right. Snap definitely has a little bit of an interesting juncture arriving then potentially soon. You got a downgrade this morning from a buy to a neutral from Bank of America. $67. They had it at $78. And then apparently this $74 price was close enough for them. Downgraded it this morning. So a little bit of a loss of a bull narrative there, and 5% lower does seem to be showing up on a day where you've got generally tech stuff and growth stocks doing well. So Snap on the other end of that. Thanks, Ben Watson, the chart master. Good work here on the technicals. Market meetup time when we get back. What's behind today's reversal? Just some firming, much awaited strength in the bond market, helping pacify the NASDAQ. Right now, we've got a big split between the Russell and the NASDAQ.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You said it. NASDAQ. Rewrite tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Stephanie Lewicki here with your TD Ameritrade Network Market Update. Argus said it expects customer traffic at Wendy's to remain relatively weak in the near term due to the pandemic and are concerned about the company's high debt-to-cap ratio, which rose to 80% at the end of the fourth quarter of 2020. The firm also warns that Wendy's appears fully valued at 29.3 times the revised 2021 EPS estimate, above the average for small to mid-cap fast food chains. Wendy's is down 8% over the last 3 months. DoorDash announced that it will begin facilitating same-day delivery of COVID-19 PCR test collection kits across the U.S. through partnerships with Vault Health and Everlywell. Both the kits will be available in 12 DashMart locations across the U.S., including Baltimore, Chicago, Cleveland, Dallas, and Phoenix, with more cities rolling out in the coming months. The last mile fulfillment will allow thousands of patients on the Vault platform to get tested same day and receive results all within a record time of 48 hours. And shares of Support.com jumped 235% after the technology group said it planned to merge with power generator and Bitcoin mining operator Greenidge Generation. After closing of the deal, Support.com will become a wholly owned subsidiary of Greenidge, which is expected to be listed on the NASDAQ. Greenidge said it expects to be the only U.S. public company operating a vertically integrated power generation asset and Bitcoin mining operation. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Oliver Reddick.
This morning, we've got a little bit of a different vibe in the market. It's bonds firm and the NASDAQ strong, while the Russell dives. Let's bring in our meetup panel. JB McKenzie is Managing Director of Futures and Forex at TD Ameritrade, and Nick Theodorakis, Financial Risk Management Director at TD Ameritrade. So, guys, this morning we've got a little bit of a different type of market. But first, I want to start off with the overnight news from this weekend and kind of work our way through some of the headlines here. JB, that starts, I think, first with the dollar. Turkish lira got blasted. As Ben described it this morning, the revolving door of leadership at Turkey's central bank. And so that caused a little bit of a stir. But yet, we've actually got the greenback flat on the day, and it was down earlier.
Yeah, I mean, I think it's interesting. You look at what happened in Turkey just really quickly. 3 different leaders get fired associated with their central with their money sources as they're putting together. That tells you how concerning it is. Now, it has bounced off of an enormous move, at over 7% move or 8% move down and back up here. That has helped the dollar, but I also think the dollar is firmed on itself. I mean, we've talked about this going back a few weeks ago, where we were looking at the dollar down below sort of 90 in that 88 range. And it's really worked its way back up and has firmed pretty nicely in where it is there today. And I think part of this is just the realization is the U.S. is sort of where the world wants to be putting its currencies, and the dollar's firmness is holding there. And so the question can this dollar continue to work its way up slowly, not at a fast rate, but at a slow level, where we can continue to see it improve with the market also improving. So it'll be interesting to watch dollar rates as well as the equity markets to see whether or not all 3 of them can work in unison if they're both working to the upside.
Okay. So that, I think, is what's very fascinating here, is how we think about those correlations. And what they're going to mean going forward, where that dollar firmness that we've gotten this year hasn't been too disruptive for stocks. It has gone along with records in the Dow and the S&P. It's really just been kind of reserved to weakness in the NASDAQ, as the dollar up has also been happening as yields go up. Nick, we got a break from that this morning. Any rhyme, reason, causality, or is this just a break from our recent trend?
I think, one day, one night doesn't make much for a trend. And I do think there's some, to JB's point, and the news in Turkey, there's some interesting, we'll call it idiosyncratic information out there. Certainly, it wouldn't be well received if most central banks were managing their currency this way. So hopefully, not a trend. But yeah, I mean, you look at a longer term trend chart of the dollar, just a longer term chart of the dollar, and we've been, I think the high was 103 roughly. If you look at the /DX in the TOS platform, so we've had a pretty strong rally back, but we've kind of gone sideways here in the short to medium term, right? So I don't think it's a huge surprise that with the moves we're seeing today overall, dollar flat, and JB's right. I mean, people want to be in the dollar still, and you see what's happening kind of globally as the pandemic, oscillates, we'll call it, right? So it's hard to say you want to go be in Eurozone currencies. Brexit's still a real thing, right? The pound is sort of a little bit unknown, and then certainly. In China, you've seen a strong recovery, but still just not, that global currency. There's so much currency control that goes on there. It kind of is back to that old, the dollar is sort of the best place to be. And without broader, I think, kind of, global pressures, flat here doesn't surprise me a whole ton. And I think you're going to see a little bit of sideways here as the rotation in the equity and bond markets kind of continues. So you're seeing people wanting to be in the dollar so that they can participate in this sort of U.S. Investment rotation, and I don't think you're going to see a sell-off because of that, but probably sideways here makes some sense for a while.
As we speak, the NASDAQ really trying to rep up 1.6% this morning. But last week, Michael McCurr was pointing out the oddities in the chart, which had formed a head and shoulders with a negative implication, and then an inverse head and shoulders out of the right shoulder that has positive implications. JB, what do you think here the most important things would be to creating some kind of sustainable move in tech and pushing back towards the highs like everything else has? If you're a tech bull, what do you want to hear this week? I mean, what do you want to see from the market?
Well, you've got a lot of Fed speakers this week, right? And I think while Powell alleviated some of the concerns and fears in the market of what would happen if the interest rates or inflation took off to a certain time, he didn't say all that much different than he did before. And so it's kind of funny to me that suddenly you're looking at that 10-year coming down below 1.7. I think it was at 1.68 roughly. So I think the question ends up being is that when do we feel comfortable with rising interest rates, hopefully some rising inflation at the same time as the markets or as the economies continue to open up? So I think really what it comes down to being is can we watch these two work lockstep on a slow grind forward? We've talked about this before. Big jagged moves in the treasuries causes problems specifically in the NASDAQ marketplaces, and that's where some of the concern is. It feels as though that concern got a little over-rotated over the last week or so, but at the same time, what you're kind of watching is that playbook going back to sort of what I say is those stocks that the Apples, the Teslas, the Microsofts, sort of the slow and steady big performers from the FANG getting some of that additional push behind them today. The question I think more importantly as this comes through is what do the rest of these Fed speakers say the rest of the week? And by the way, you have a slew of economic data coming out as well, a lot of it having to do with the growth perspective. So if what you heard from the Fed Reserve member from Barkin from Richmond, which is we're close to being fully reopened, does this mean this is sort of that foot on the accelerator that we see in the marketplace? Is that going to be something that could be a little bit bearish for the NASDAQ versus bullish? I don't know. That's what I want to see. Can we hold this rising interest rate marketplace?
Well, we're looking at the relative strength, Russell versus NASDAQ, which has been so persistent since September. You could basically connect a line through the lows of this relative strength chart on the bottom panel, where if you do have further strength in the NASDAQ from here, it might get a little bit interesting if we kind of break some of the momentum in that Russell outperformance. The EU and the ECB, they're buying plenty of bonds, JB. The ECB increased the pace of their bond buying, as we just learned today, and they had told us they were going to. But here it seems Jay Powell is pretty steadfast not to do those. And some of the analysis that I read is from strategists now saying that Powell is kind of taking the first step towards weaning markets off of the Fed, as they chose not to extend the SLR exemption, as they've chosen not to up their bond plan. So I think maybe we have to get used to a little bit of a different environment here, at least so far, that when Powell has talked and when our central bankers have talked, it's not exactly been market positive.
No, but I also think as you're looking at these different economies, the U.S. is in a much different spot than where you're seeing the Eurozone. And I think you're starting to see that. We've had consistently strong numbers. I know there's been some weakness here and there, but you continue to see some strong economic numbers here in the U.S. And you've got a little bit more of, I would say, that pause occurring in Europe. Look, they just are going through what they believe is a third wave. Other parts of the countries over in Europe are starting to potentially pause or close down. I think the question comes into play is whether or not they can kind of get their economies pushing forward and opening up. Again, the beauty of a Eurozone is you have this inability to trade amongst all those countries, but also that free flow of goods and people causes problems. And that's what they're seeing from the pandemic standpoint. In the U.S., you're seeing stronger economic numbers. You're seeing lower rates for the most part in COVID positivity, but you're seeing that vaccine rollout. To me, this rollout is really what is spurring that growth. And that's the reason why I think it gives the Fed a little bit more leeway than you probably have over in Europe.
So what's interesting, Nick, and I want to chime in, I'll give some more context. Headline just came out from Bloomberg that NYC Mayor Bill de Blasio asks Governor Cuomo to pause reopenings to stem COVID cases. So we'll see how that tension plays out. But again, to JB's point, Nick, we've been so leading and forward on the vaccinations front and reopening front. Seems like that would be the type of headline that would then put strength into bonds and some of the kind of tech safety plays.
Yeah, and again, we had positive vaccine news over the weekend, right? AstraZeneca vaccine, in the almost 80%, 79%, right? So efficacy rate, that is. So you look at that and say, wow, we might get another vaccine approved here. So that would have, the U.S. the only country with every vaccine approved and with a supply readily available, right? There's approved vaccines in other countries and on other continents, but they can't get the supply, right? So this sort of is this goes a little bit to the pre-buying that was done, and so I do think that makes sense. But couple that with the fact that we're expecting another 750,000 unemployment claims this week, right? So, and then you are seeing in pockets, right? We see your story on New York right now, right? News out of Florida over the weekend, like asking for pullback and really going back to life as full normal. So I think going back a couple of points that JB made, I think it's a really interesting thought to figure out where is the balance going to be between rates being somewhat higher and tech growth, companies that typically do worse, right, during higher rate environments. Where is that balance? Because the other thing that's sort of different between the U.S. and the globe, right? We just put another $2 trillion into the economy. Nobody else is really coming out with money, monies of that size. So we're putting our own pressures on that and creating that inflationary perspective. But that doesn't mean that we're not going to go spend that money on the goods and services that these companies all produce, right? So we're going to be talking about NVIDIA on Fast Market coming up in a little bit, so a bit of a tease there. But these chips are in such high demand, right? Are the company's valuations going to keep up with that? Well, you think as more money comes into the economy, it's going to push these producers of services and actual hardware. But are they going to grow into the valuations that they had, or are the returns not going to be as great because rates are higher? That's really the question that we're asking. But the demand for product that these companies are producing, both services and hardware, I think are going to continue to increase because the money's just going to be more readily available.
Okay. All right, guys, some interesting thoughts and a little bit of dueling narratives that are getting tested this morning. The U.S. strength from the reopening and higher yields versus the money from the ECB sloshing around. All right, JB and Nick, good stuff, guys. Let's bring in Alex Coffey and let's check in on Fast Market. Alex, what's on the trading agenda on this Monday?
As Nick mentioned, there's going to be a lot of chip talk on Fast Market, all about the semis today. Oliver, we're going to talk Intel, AMD, and NVIDIA.
Okay, I like that. Quick, simple, and straightforward. Chips, AMD, NVIDIA, and a bit of weakness in the group. Fast Markets up next. I'm Oliver Rennick. Thank you for joining Morning Trade Live.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like calendars and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Good morning and welcome to Fast Market. It's Monday, March 22nd. I'm Alex Coffey. Let's take a quick look at where the markets sit. 90 minutes into the first trading session of the new week. Got a little bit of a mixed market brewing today. You have the S&P 500 up 22 points. Solid start to the week, up about 0.6%. The NASDAQ way out in front is up 1.56%, right at 200 points to the upside, back over 13,000. The Russell 2000 is our laggard, down 24. It's about a percentage point. So again, the divergence between the mega cap tech heavy NASDAQ 100 and the small cap cyclical Russell 2000 just continues to express itself as those two just do not move in sync. At least they haven't over the last year. The Dow Jones is also higher on the session, modestly about 0.1%, 40 points here to the upside. Some other moves taking place here in the bond market as well. 10-year yields in about 4 basis points. But to help me break down this action and more, I want to welcome in the co-host of Fast Market, Kevin Hinks. Good morning to you, Kevin. And sticking around from the Morning Trade Live panel with Oliver Rennick is Nick Theodorakis. You know him well, the risk management director at TD Ameritrade. Good morning to both of you. Nick, I'll give you the first thoughts here on the mixed market. Again, the S&P 500 continues to kind of just modestly move higher while the NASDAQ and the Russell duking out for, which one's going to really drag the other one higher.
Yeah, that's right. And we've sort of seen this bifurcated, stock market over the last, call it 6 weeks now. I guess we're going on. Clearly an interest rate driven, move again here this morning, and I think that's really the news of the week. Right, we've got a lot of Fed speak this week. Powell speaks a few times. Quite a bit of economic information coming out as well. We get some housing information. KBH, I think, announces earnings in a couple of days. So you got housing information going on. This is a lot of interesting information that I think we're all looking at now through much more of a yield curve and interest rate lens than we were a few months ago. And clearly the different indices are kind of divergent when it comes to that. We've seen such a rally in the S&P and the Dow, back to all-time highs, and the Nasdaq has lagged, which is just so rare for the recent, recent 3 years, right? The Nasdaq's led the way the entire way because there hasn't even been a sniff of interest rates, and now such a volatile move and such a jagged pop in rates has really kind of called into question some of those valuations and where that's going to stabilize. And on the panel just a few minutes ago, I think again JB McKenzie said it so well that there's going to have to be this sort of new normal that's felt out, and how these sort of rates and stocks and sectors are all going to kind of eventually play nicely together. And don't think that footing has been found yet. So that kind of continues to be the start of the week here with rates a bit lower. We see a pop back in the Nasdaq, like you said, leading the way today, and then some of the others, particularly the financial sector, a bit lower. So the sector rotation continues, just a little bit of an opposite direction to start the week.
It's a great point. It's well said. And Kevin, we hate to oversimplify things, but at the same time, you don't want to overthink it either. And it really does feel like the market right now is almost entirely taking its cues from the interest rate complex. And on days where you see a little bit of yield curve compression, pretty sharp moves to the downside on the 10-year yield even, you do seem to get a NASDAQ outperforming. And of course, the other way around, when the yield curve is steepening, you have a 10-year that's moving higher, you're seeing financials outperform, but really you're seeing weakness in tech. And I hate to oversimplify things, and I know you have thoughts, but it does seem like that's the primary thing that the market's focused on right now.
Yeah, I mean, couple things. It's nice to see the NASDAQ back from its spring break and back in the game here, leading us up about 1.5%. And we can connect the dots to any softness in yields or even moderating yields, as seems to be, making investors more comfortable with stocks, especially NASDAQ stocks. You're seeing a lot of big names that have corrected pretty significantly, Apple being one, up more than 2% now, 2.2% higher. So that's going to give a lot of buoyancy to the three indices that Apple is in. So this is a nice start to the week. And, we find ourselves now, after Nike came out with earnings on Thursday, we find ourselves in that chasm between the end of earnings season and waiting for the beginning of next earnings season. And so, this is a good time to do themes like we're doing on today's show, and starting with, tech is a great way to start. So I think the NASDAQ strength this morning is, probably very welcomed among the trading world, as, these are a lot of popular names. But in a week where I count them, guys, 24 times between now and the end of day Thursday, some member of the Fed is speaking. Jerome Powell, 3 of those times. So it's a Fed speaker palooza this week, and the NASDAQ coming back from spring break and coming in with a 1.5% move has got everyone feeling a little better that this rotation out of NASDAQ and into these other areas is at least paused for the time being, guys.
Nick, I think Kevin makes a very strong point. It's one that you've alluded to as well, which is, some weeks are very micro focused. Some of the earnings weeks where you get all the big companies, and it seems like, what company isn't reporting this week is really the question you're asking sometimes. And then you have other weeks where there's really no earnings. There's not necessarily a ton of economic data, but it's dominated by some type of a narrative. Well, this week, that narrative is going to be hearing from the different Fed speakers, and a lot of the conversation around this exact topic we're talking about, which is If there's a new interest rate environment, what does that mean for stocks? And more importantly, what kind of decisions are these governing bodies going to make? But Nick, I want to get your thoughts on something in regards to really kind of tying this all together and trying to find kind of a trader takeaway from it. And so what I've been focusing on a lot is VXN versus VIX. Not necessarily that one's trading at a premium to the other or how extreme that premium really is, but really because this is, to me, verification of what we're saying. We look at the S&P 500, VIX is still elevated on a historical basis, but it's sitting at 20. So it's on basically recovery lows, historically elevated. It still tells us there's still uncertainty out there. But when you look at the VXN, which is the NASDAQ volatility, Nick, at 28, this to me says the stakes are a little bit higher here. We don't necessarily have the financials and some of the more cyclically tied sectors to kind of hedge some reopening risk here, or interest rate risk. And that's why the NASDAQ's trading at a higher vol.
Both of you guys are taking cues. I literally had that chart up on my screen, Alex. I always take VXN minus VIX, right? So typically the NASDAQ vol is a bit higher. And it is a wider spread, right? So it's it's about $8 between the 8 points between the two. We saw that get as compressed as $2 or $3, and it kind of widens out, right? You can get out to sort of, you could get out to sort of $15 or $20 wide if it things get a bit extreme. But it's kind of middle of the range, but it's the wider end of the range from the recent history for sure. And I think what that's really telling you is. And just again, VXN, right? It's the exact same style of calculation. It's looking at the NASDAQ options instead of the S&P options, but it's the same style of calculation, looking at the out of the money options, and it's basically saying what is the premium that people are paying for index options, calls and puts, right? But typically we look at it as sort of the fear gauge because the put skew tends to be higher, and that is elevated for the NASDAQ. It just kind of goes back to the first statement of when we were looking at what's led this rally for the last 5 or 6 or maybe even more years, right? It's been NASDAQ stocks. It's been huge growth in tech stocks, and we remember that blip on the radar in 2018 when interest rates ticked up for a hot minute, and then kind of fast forward to pandemic, and it was like there was never going to be higher rates again. The Fed has done everything they can to say that's going to continue to be the case, right? And I think we're going to hear a lot more of that this week. To Kev's point, there's 20 plus occurrences of the Fed speakers, and I don't think that's an accident, right? I think they're trying to get out in front of this and continue to say, we're going to do everything we can to keep rates low to spur on this growth, because the last thing they want to do is flood the economy with cheap money, right? Both stimulus from Congress as well as what the Fed's continuing to do, but then have there be a credit situation where that money is just not worth as much, right? Because it kind of defeats the whole purpose. So I think we're going to see them continuing to tell us, hey, this isn't an issue. Inflation, it might go up a bit, but we're not going to do anything with rates. And, do we hear anything more about bond buying? I don't know. If we do, I would expect that NASDAQ vol to come in a little bit, right? Because if we hear that, then, if we hear some sort of curve control commentary coming out, the markets can get a sense of stability around the fact that long-term rates won't just go up exponentially. That would certainly help the NASDAQ and quell some of those fears.
Yeah, it's well said. And Kev, before we talk some intel here, just kind of closing thoughts here. When you're looking at volatility, and I think this chart is interesting, and it is important to note that it is towards the relatively high end of the range when you're looking at volatility of the NASDAQ and S&P 500. But to me, it does make sense. I mean, we've talked about the S&P 500 has kind of modestly moved higher in both the days that the Russell's outperformed the NASDAQ and the days that the NASDAQ has outperformed the Russell. And it's because that rotation that's taking place, well, if you move out of tech into financials, as long as you're in big cap companies, you're probably going to have some exposure in the S&P 500 to those different sectors, where the Russell 2000 is really that kind of, great expression of cyclical, investment. The same as NASDAQ, the high growth, kind of low interest rate, yield seeking environment. And so to see that expression a little bit exaggerated right now, I think makes sense when you have an environment that seems to go one way or another, depending on where interest rates go. Kind of closing thoughts on the macro here as we transition into some chip talk.
It's very important for our viewers and traders in general to be cognizant of where we are on the calendar. You know, last year at this time, volatility was running rampant. Why? Because it should have, right? Because all of the uncertainty in the world. Slowly but surely, uncertainty is coming out. It's not all out, but slowly but surely, uncertainty is coming out of this market. And the VIX, remember, you're moving into spring, and then you'll be moving into summer. So people are starting to evaluate what this 20, 21, 22 VIX means. Now today, it's drifted back below 20 to start the day based on how the market's acting. But remember, the average for the VIX is 15.4, basically the all-time average since it became the S&P 500. So we're sitting right now at about a 20. As we get into the spring and summer, and traders have a lot of financial and emotional scars from holding volatility over the summer. So that makes sure that everyone's cognizant of where we are on the calendar, guys.
Exactly. And Nick, let's talk some chips here. We're going to talk AMD and NVIDIA later on in the show. Like Folio is going to break down those companies, but we wanted to kind of keep a theme going, as Kevin mentioned. Earnings is winding down. We want to have reasons why we're talking about these different names. And we kind of have the new guns in AMD and NVIDIA that have really shined the last couple of years. And you have kind of the old guard in Intel, which is the name that we're going to focus on here. But Nick, set us up here on what's going on within this space and kind of why we're seeing this weird kind of almost inverse correlation between an AMD and an Intel and NVIDIA, where you're seeing Intel start to outperform now as this reopening trade comes back, where NVIDIA and AMD have largely gone sideways for about 6 months.
So there's a lot there, and I'm not a chip analyst, but I think it kind of those types of inverse relationships or kind of plays on the sector relate to where the chips are being used. I think as offices reopen and people are thinking maybe going back to buying more devices, hardware for business purposes, Intel kind of is at the forefront of that. NVIDIA is sort of more on the GPU and gaming side of things. So you think I continue to sit in my basement and get done with work and play video games, then those are the types of devices that are in demand. So I think there is some sector rotation again, or rotation within the sector, I should say, based on what types of devices are sort of perceived to be in demand. What I think is going to be really interesting is how these companies sort of backfill each other's weaknesses and gaps, and can they start to kind of get into each other's business a little bit more, because the theme overall is a shortage of chips, right? I think probably the industry that's made the biggest headlines on this is the automotive industry. And as cars become more chip based, right? We think electric cars, everything from the motor on out is run on multiple chips in every car. So you're seeing you've seen GM and Ford and others talk about the shortages and how they've had to actually stop, actually stop building automobiles because they can't get the chips to put in. So it's truly disrupting the supply chain. We haven't seen that as much on the smaller device side of things, like smartphones and other mobile or wearable devices yet. But you're seeing some interesting moves, right? Apple came out with their first in-house silica for their computers a few months ago. So some of these other companies that aren't historically in the chip space are getting in and trying to bring in and build out their own vertical supply chain so that they're not reliant on and have issues with supply chain, right? Because, kind of go back to the beginning of the pandemic when supply chains got disrupted around the world. So you're seeing a bunch of interesting shifts, right? Device type matters. There's shortages across the board. And then you're seeing, companies that haven't historically been in the chip supply chain trying to get there because they don't want to have those disruptions. And I think all those things are going to play together in how these companies perform over the, call it, next 6 to 12 months.
Kev, if I sum up kind of what Nick's laying out here, and I think all makes a ton of sense, is there's a little bit of the stay-at-home versus reopening expression kind of taking place within this space as well. You see names like Micron and Intel starting to come back a little bit after underperformance, and maybe some of your kind of gaming-heavy, new age kind of chip companies and the AMD and NVIDIA start to underperform a little bit after extraordinary kind of gains throughout the summer months of last year. He also mentioned some of the, the hiccups and the execution that's going to take place on a company by company basis as well. I'll throw in one more thing here, and Kevin, you can set us up an example trade, but a little bit of this is the expression of this macro interest rate environment as well. The names like Micron and Intel maybe just aren't the high growth names of an AMD and an NVIDIA that have outperformed in low interest rate environments. We're seeing even within tech a little bit of this rotation taking place.
I'll start this conversation out with Warren Buffett's quote, "Be greedy when people are scared and be scared when people are greedy." And Intel had some horrible news in the last year to 18 months, right? And their relationship with AMD, AMD had the product, Intel was failing on their ability to get some of their products out, and the two stocks almost did a flip-flop. Well, the news was bad, the news cycle was bad, there was nothing but bad news, but when people were most scared and fearful of Intel, it got into the mid to low 40s. If you were greedy then and traded Intel hard, you got rewarded with about a 50% move in this company. Why? Because even no matter how good AMD is, and they're doing a great job of cutting into Intel's product lines, it's still a Home Depot Lowe's relationship between these two, and Intel is clearly the leader in this space. So this recovery in Intel's been, a really good company that had some problems, getting their problems fixed, and the stock has paid off people that were greedy when other people were fearful. So that being said, how do you trade? Now, Intel's had an unbelievable run up to these levels, now trading, in the mid 60s. How do you look at it? They have earnings April 22nd. So we certainly want to trade ahead of Intel's earnings. And how do we do that? Well, there's a pretty low risk way to look at this because, let's face it, Intel could back off into earnings. It could run further into earnings. We don't know. We have no idea what they're going to come out with or how this stock is going to react. So, a lot of a very popular strategy that we've put on the last few weeks is the double calendar. And if you do the April 16th, staying ahead of the earnings event, right? Doing the April monthly, and just this week, even with 4 days to go, do the 70 call calendar and the 60 put calendar. You can do both these, Alex, for about 80 cents in terms of a debit. So really low capital outlay way to trade this name in earnings. Could be positive, could be negative. You'd be able to cheer for both ways if you have this double calendar on, Alex.
Yeah, and Nick, when you're looking at this type of a strategy, effectively, the platform refers to it as a double diagonal, but since the strikes are the same, we often refer to it as a double calendar. But effectively what we're doing is we're selling a near-term strangle in order to chip away at the debit for the longer-term strangle. And so in this case, there's a couple different opportunities to potentially roll that short strangle as well, further chip away at this 81-cent debit. But this is both a play on time decay and a potential play on volatility as we kind of venture off in time. There is a directional component as well. We do prefer a move towards one of our strikes. So in this case, as you look at the risk profile, it almost looks like a mountain range, Nick, where it peaks out at our strike. And that's what we'd expect when you're looking at the calendar spread. And of course, when you make it a double calendar spread, instead of it just being one peak, there's two.
Yeah, and if you look, so Kev said staying ahead of earnings. If my date's right here, it's obviously subject to change as far out, April 22nd, so you're ahead of that. But you would expect vol to ramp, into as that gets closer, right? You'd expect that vol to ramp up. And if you look at like the 4-day options that you're talking about selling here, the 70 calls are about 30 cents. So you're going to be able to chip away at that, really nicely. I mean, if we literally just sit, right? If you kind of go out, you do that, you're able to do that roll 3-4 times, you're basically talking about, a free look by the time you get to that side earnings. I was actually surprised, Kevin, you brought that up. I was building the trade out here. Surprised it's that cheap. I guess, what that's really saying is that, it's really cheap, but they're saying like there's just not a big move expected here between now and then. So you're banking on a bit of outperformance on a stock that's got a fairly historically low volatility. But there's a lot of news in the sector, right? We just hit all that stuff. So you're putting this trade on if you think that there's something that could be moving this potentially prior to earnings, and then ultimately the vol is going to ramp a little bit as earnings approach. So I think I was kind of like, is it really that cheap? But it is. So it seems like you could easily whittle that down to almost even money type trade and end up long that strangle for close to nothing by the time you roll it out.
To me, Kevin, almost looks like as if there's an event like an earnings event almost taking place this week. 56% volatility with a couple days to go. So whether it's an investor day or something within the industry, whatever it may be, there is certainly something kind of juicing up the volatility in the near term, which when you're doing this kind of strategy, this differential is really where the strategy shines. And with almost a 20% vol differential, this sets up for a very interesting trade to both your points. One that would typically trade at probably a much higher debit relative to where it is now. So that's a unique opportunity for this one. But the debit spent on the trade here, Kevin, is the risk. So this is one where we've given ourselves some flexibility on terms of trade management. So what we'll do here is we'll put it in. We'll put it in 5 times. So if we fill it at 80 cents, that's $400 total here. And Kevin, this is one I'm sure we'll come back to a couple times throughout the life of the trade, as there'll be a couple different times where maybe we think about rolling it or taking the position off, depending on what the market gives us to work with. Nick T, it's always a pleasure. We appreciate you joining us. Hope you had a great weekend, and we'll look forward to talking to you again soon. Nick Theodorakis, Director of Financial Risk Management at TD Ameritrade. Always a pleasure. Kev, we're going to take a short break. We get back, more semiconductors, more chip conversation. We're going to focus in on AMD. We're going to talk some NVIDIA as well. Stick around. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Welcome back to Fast Market. I'm Alex Coffey, joined by Kevin Hanks, as always, on this Monday morning. Kev, let's do a quick market update here because it almost feels like this divergence is accelerating a little bit. You have the S&P 500 up 23. It's about 0.6%. The NASDAQ now up 227. So piling on to its already outperforming gains. The Russell 2000 just not getting its, its sea legs, I guess you could say, down 26 points, 1.16% to the downside. The Dow hanging out up about 0.1% still. So, Kevin, that divergence just continues to exaggerate as the day goes on. We'll see if that can tighten or if this continues as we approach the end of the session. But for now, let's welcome in Jenny Horn, TD Ameritrade Network contributor, to continue the chips conversation. Good morning to you, Jenny. Talking some AMD, talking some NVIDIA here. Two names that I'm sure our viewers know very, very well. Although AMD moving in a direction I think investors maybe have gotten almost forgot that it's possible for this name. When you look at it just over the last few years, it's been so incredible.
Yes, it's incredible over the last few years, but now stock a little bit range bound, and it is up today sort of alongside the NASDAQ strength like you just mentioned, but it's still sitting about $19 below all-time highs, and they've actually they're down about 15% from what the street was expecting as far as price targets from their last earnings call. And I mean, they operate at a really high valuation and of course this super competitive market, but this is one of the largest technology companies in the world at a market cap of about $100 billion. So they have been not completely averse from this sort of rotation we've seen in the tech sector, being that this is a name that sort of operates in the PC and gaming market. So of course they were a beneficiary of that increased demand and then now have seen this degree of a correction. So through Friday's close, not excluding the strength they're seeing today, they've lost about 11% in the last month, which underperformed the technology sector, which was down about 6%, and the S&P 500's small gain. So one of the biggest headwinds with this company right now is that they're seeing serious supply issues. Just to paint a picture of how serious those issues are, they're expected to deliver over 50% revenue growth in 2021, but their chip capacity can only increase about 20%, meaning that potentially 30% of their orders may never get filled. They recently launched the RDNA2 and their new GPU chips, and they've seen that consistently out of stock ever since the launch, and it's been about 6 months at this point. They also reported in the fourth quarter that they lost PC market share for their first time since 2017. Because of this tightness in supply, they were facing in the back half of 2020 and the beginning of 2021 with their graphics cards and some models of their Ryzen 5000 CPU. So they're really continuing to see this, sort of weighing on their bottom and top line. Now, I think it's important to note this has been the conversation on social media for a while. I mean, I've been following this name because I think it's so interesting that basically consumers want their products and they're not able to get them, which sort of brings me to our first tweet, which says, I would agree it would be the best time to get into gaming if it weren't nearly impossible to get your hands on new hardware. PS5, Xbox, NVIDIA, and AMD GPUs are simply not in stock. And we're approaching 6 months since release for some of these components. So this has been the issue. I think this is really interesting because it highlights how long this has been an issue. And it's kind of confusing with a company like AMD that is so massive and so successful, why they can't seem to sort of alleviate this problem. But actually, this is sort of a space where it seems like the companies are able to capitalize on each other's losses. For example, NVIDIA has come out and said that they will not allow their GPUs to be used for Ethereum and different kinds of minings. They're actually going to limit the capacity of their GPUs to 50% if you're going to use that for, say, cryptos and Ethereum. Now, AMD has come out and said that they're actually not going to limit their capacity for these companies. They're sort of going to capitalize on NVIDIA's decision to avoid the mining space. And that obviously, anytime you talk about cryptos with a company that's in tech like an AMD, it creates a huge uproar on social media, which is our next tweet, which is actually in response to someone saying, "What are you buying?" And this tweeter says, AMD, they will be the king of crypto mining equipment. So this created a huge backsplash because basically now they're going to, really, I think, capitalize on the fact that NVIDIA is avoiding this space. And I'm not too sure why they decided to make that decision, Kevin. But I think it's interesting that, any move into the crypto right now creates buzz. And I think that could be part of the reason the stock is up almost 2% today.
Yeah, Jenny, that's why I changed my name to Kevin Crypto Hinks. just because anytime you mention crypto, your stock goes up, right? And there's more interest in what you're doing. So I think that's, that is the phenomenon that we live in. Now, I'm not an expert, full disclosure. I'm not an expert in crypto. So I don't know what the difference is between NVIDIA not allowing you to and AMD allowing you to. I'm not sure what that means in terms of a macro look at both these names. But certainly, I look at the relationship between, like, let's say AMD and Intel, and that relationship is real and the competition is real. When we start getting into, cryptocurrencies and things like that, I start to get less confident that I'm sure about what we're talking about. That I have to leave that to more intelligent people that have really studied cryptocurrencies. So it's really interesting that NVIDIA is doing one thing and AMD is doing another. I don't have expertise in that. I more look at AMD competing with like Intel. And I think and the overall shortage of chips in the world and how it's affecting car auto manufacturing and things like that. So it's unbelievable that a whole sector of this economy underestimated demand for their products like we're seeing in this space, guys.
Kev, one thing's for sure, too, when you look at these companies, they've had incredible runs. Since the lows, AMD up 108%, NVIDIA up 170%. And so even with the shortages, it's a much better problem than, let's say, maybe something like restaurants, where those companies, they can't even operate at full capacity right now. So they can't make their products fast enough to meet the demand. It's definitely a high-class problem when you're talking different kind of problems you could have as a company on an execution front. But Jenny, great stuff as always. Thanks for joining us. We really appreciate it. So we say goodbye to Jenny Horn. We want to welcome in Landon Swan, the co-founder of Likefolio.com. And Landon, maybe you can help us settle this. But I think if I recall, it may have been NVIDIA that they're not necessarily avoiding the crypto space entirely, but rather they're trying to design a product that really just fulfills what exactly the crypto miner needs. So they stop buying all the gaming chips so that the gamers can't get them.
That's exactly right. So they limited the capacity of mining by 50% on new products so that those products could be used for gaming. And then they introduced a new chip. I believe it's the CMP. Anyway, that is exclusively for crypto. So they sort of segmented their two markets and said, you know what, instead of competing with each other and the miners being frustrated with the gamers and the gamers frustrated with the miners, we're going to have two completely separate products. And that's the way that they're going to attack them. Meanwhile, I think that AMD is sticking with the one size fits all. You can use it for both applications and just buy our product. That's sort of their sales pitch. And so definitely two different strategies going on there. And we're actually seeing an interesting little divergence. If you look at the two companies on how well they've done on people talking about using them specifically for cryptocurrency, here in the green, you've got NVIDIA. And in red, you've got AMD. And you can see that for pretty much for the most part, those two lines were very close. Over the last year or so, AMD had the lead. But as NVIDIA announced that new product that is exclusively for mining, they've actually surged quite a bit, and they've sort of taken the lead on AMD. But this is one of those rising tide lifts all boats things where they're both booming because of cryptocurrency. And you can see back in 2018 when Bitcoin hit 20,000 for the first time, that was a huge spike for them. And it's really dependent on the value of the coins because, when you mine, you're getting coins as a reward. And if those coins are worth very little, then there's not a lot of incentive to go out and buy the processors and buy the chips that can do that for you. But if all of a sudden, that Bitcoin goes from 3,000 or 4,000 like it was close to a year ago up to 55 or 60 now, then you're much more incentivized to mine. It's 20 times as good. And so there's going to be a lot of demand for those products. And that's why the gamers are getting so frustrated because for so long, all those were eaten up by the miners. And now, again, NVIDIA is splitting that up.
Landon, obviously when we talk about this space, the tech space, it's a supply issue, right? Demand is, we know, off the charts. Demand overwhelmed supply. But do you guys have any information? And this is just me asking as John Q. Public. Is there any information? Are you seeing anything on social media where they're giving any timeline where all this backup demand, do they have any product coming on the market? Are we going to see like a flood of supply coming on the market anytime soon? Or is this going to be just a, like a crop shortage where these prices have to find a level where they trade? Because that's the main thing I want to know about these two companies is this overall shortage in semiconductors. Are they close? Is it coming? Are they mentioning dates when they expect supply to come back on the market?
I don't think so. I think that a lot of it has to do with China. I think that there's a huge supply issue there. And it's not just limited to processors and chips. I mean, it's just pretty much across the board. If your manufacturer's in China, it takes a long time because there's such a backlog. And a lot of it actually has to do with shipping ports. Is just shipping ports in the United States are full and there's a backlog of them. A lot of ships aren't leaving China to get here to deliver the products because they know that they have to wait in line to get in. And so a lot of it was basically due to the fact that we shut down the world economy for quite a while. And now things are ramping back up. And while we were shut down, you've got these two main components or these two main sectors for the uses of these chips, which is gaming and cryptocurrency booming, and the supply is down. And so I think it's just, you've got a huge backlog. You've got Xbox and PlayStation powered by AMD. You've got AMD and NVIDIA competing for cryptocurrency mining. And it is just, both of those have been booming tremendously and supply is down. So the only way that I see that demand is going to be relieved for AMD devices is if there is a cryptocurrency crash and the market, Bitcoin's down under 5,000 or 10,000 again. Mining will absolutely dry up if that happens, and then all the gamers can rejoice because they'll be able to get as many of these chips and processors as they need. Now that won't be the case with NVIDIA because they split those up, and so their one chip will have lower demand, but the gaming chip will still have very high demand.
So I hate to simplify this, but I need to for my own brain to absorb this. So who, by definition, then is in the better spot? Is it AMD that says all the product we have is you can use in both spots, or is it NVIDIA that has its own crypto and divided the two products? Which is, both have advantages and disadvantages, and I'm kind of exposing my naivete when it comes to these things, but who's got the better future, the one product or the two products?
Yeah, that's a great question. So my opinion is it's basically NVIDIA is betting on cryptocurrency continuing to be strong moving forward. And I think that's going to determine the winner.
Yes.
I think that if cryptocurrency continues to boom, they've got a processor that is made just for that and it excels and crushes that mining aspect. And then they've got the gaming on the side. And if cryptocurrency doesn't do extremely well, then you wouldn't be buying that one at all. They basically have a failed product that's just going to sit on the shelf, and while AMD's gaming chips actually surpass it because no one's using it to mine. And so I really think that's going to be the answer. And, it's speculation from here. Obviously, these, cryptocurrency is wild market. It's basically at all-time highs right now. Long-term projection, personally, I think I'm bullish on cryptocurrency 5 or 10 years from now. Short-term, you could tell me Bitcoin's going to be at $10,000 in 2 months, or you could tell me it's going to be at $100,000 in 2 months, and I'd believe either one. Either one makes sense. So long term, in my opinion, I like NVIDIA's strategy better because I think that specializing in different areas where you're satisfying the exact customer that you're going for is smarter. I think it's not as smart for AMD to just make one fantastic product that does really well at two things. Instead, you should make two products that are exceptional at each one. That's what NVIDIA is doing. But make no mistake, there is plenty to go around. Gaming is absolutely booming. Cryptocurrency is booming, and both of these companies are taking advantage. So they're both winners. Just a question of which one's going to be stronger, 5 years from now. My money's on NVIDIA, but I think that they'll both do well.
I think that sums it all up very, very nicely. And I think by splitting in the two products too probably helps them on their margins as well. But Landon, great setup for us as always. It is always a pleasure. Look forward to talking to you again soon. The co-founder of Likefolio.com. Kevin, We're going to talk some AMD in particular here. We're going to close out the show talking NVIDIA. So make sure to check out both of these next segments. But Kev, I think if I sum up what Landon said, this is the space that's booming. Both of these companies are in position to take advantage of it. And this is just one silo of what they're already doing so successfully. They have the gaming industry that's doing well. They're high quality products. Both of these companies have been growing tremendously. And now this crypto is like the biggest cherry ever to throw on top.
Right, exactly. And, you know, the difference between our strategy that we looked at Intel in and the strategy that we looked at AMD in is, you know, Intel has rallied significantly and AMD has just sold off about $20. So we have to look at them kind of differently. Now, could AMD, you know, sell off more from here? Of course it can. But I think this is the time, based on all the demand that, you know, that Landon just reported on is out there. I think you have to look at AMD from a perspective of, you know, when to get in, right? Everyone has to make their own decision on when to put deltas on an AMD. But if you think now is the time, I would think we did the double calendar in Intel. I think this is more of a diagonal spread. So again, it looks like AMD's earnings, they're unconfirmed, but it looks like about April 27th. The implied volatility of the expiration kind of confirms that, but nothing confirmed yet. So what I'm going to do again is stay ahead of that. I'm going to go to the April 23rd expiration, Alex, and then into this week's March 26th expiration. Let's do the 79.84 diagonal, trading right around $4, Alex.
And so I got this pulled up here. Kevin, looks like, yeah, as you said, 398 for the debit. And so this is going to be similar to what we're used to seeing with the calendar spread. You're going to see a peak where kind of the best outcome takes place, Kevin. And that's, of course, at our short strike, as many of these option strategies, usually a quick kind of trick to figure out what you would prefer to happen. A lot of times it is a move towards your short strike. But in this case, because we're buying that deeper in the money call with the longer dated expiration, Kevin, it actually is a trade that benefits really from any move higher, as you're going to be able to capture that move higher. And you can see we have a very long leaning delta here of 39 on just the one lot. So this is oftentimes called the poor man's covered call, the stock replacement strategy, or as you referred to it, the long call diagonal. But Kevin, in this case, the debit spent on the trade is the risk of the trade if we did nothing else with it. A lot of times a roll or two is kind of inherently a part of the initial plan when you're putting this trade on. That's subject to the stock price movement and the secondary markets going forward as well. But if we did nothing else with it, Kevin, we would take our debit, we would add that to our long call. That would be our break even. So in this case, just shy of $83. And the risk would take place if at expiration in April 23rd, if it fell below 79 and stayed there, we would see those calls expire worthless.
Exactly right. And so, you know, what a diagonal spread or something in the calendar spread family allows you to do is to be patient and collect theta while you wait for the move that you're wishing for to happen. If it doesn't happen, you extend duration on the trade and chip away at that net debit. But obviously the risk in this trade is two things, Alex, that for a while we haven't had to talk about this, but the risk is directionally. Obviously, if this moves lower, you've got long deltas. And there is the other risk that we have to mention is you are long Vega being long diagonal. So we've got implied volatility, the VIX overall at, just right around 20, now trading a little bit below 20. So you are long Vega in this spread, something going into spring that you should be cognizant of.
Yeah, and with this one, we're going to work two of them at 396. It's right around where the midpoint is. We may have to adjust this since it's kind of bouncing around between $3.95 and $4. Do two of them, give us a little bit more flexibility here with trade management, and we'll see if we're able to get a fill. Kevin, we're going to take our final break of the program. With fast market returns, we're going to close out the chip conversation with some NVIDIA, an example trade in there. We'll be right back.
Why did I add futures to my trading strategy? 24/7 access to diverse global markets, like wheat. Can you say growth opportunity? We should probably harvest that.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our Income Investing course. In the Income Investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Stephanie Lewicki here with your TD Ameritrade Network Market Update. Let's look at the stories making headlines this hour. Box Inc., the cloud services company, is up over 5% after speculation of a potential sale. On Friday, the company extended its board nomination deadline to May 11th in a regulatory filing. Deal Reporter speculated that the move to extend the nomination window could be seen as possibly setting the stage for a sales process. The news also comes after Reuters reported last month that the company was facing a potential board challenge from activist holder Starboard. And shares of Snap are down almost 3% after B of A analyst Justin Post downgraded Snap to neutral from buy with a price target of $67, down from $78. The analyst still expects the company to beat on Q1 results and accelerate growth in Q2, but he is reducing his forward sales estimate multiple to reflect the higher interest rate outlook and expects the stock to trade range-bound. He also notes he has better reopening ideas. And existing home sales dropped 6.6% in February from January to a seasonally adjusted annual rate of 6.22 million, the National Association of Realtors said. The February sales marked 9.1% increase from a year earlier. Economists surveyed by the Wall Street Journal expected a 2.8% monthly decline in the sales of previously owned homes, which make up most of the housing market. The supply of homes for sale fell 29.5% year over year, the largest annual decline ever to 1.03 million homes. This has been your TD Ameritrade Network Market Update. Now back to Fast Market with Alex Coffey and Kevin Hinks.
Thank you, Stephanie. I'm Alex Coffey. He's Kevin Hinks. This is Fast Market. Kevin, as we approach the end of the program, we've got to round out our chip conversation with some NVIDIA talk. But real quick, before we do that, I want to check in on markets. At the S&P 500 up 26, the NASDAQ up 232 as it continues to pile on its gains. The Russell 2000 is firmed up a bit, now down less than 1 percentage point. It's down 21.5 to 2265, and the Dow Jones up about 1/5 of a percentage point, now is up 63. The 10-year yield continues to have some weakness here as bonds catching a bit of a bid today, down about 5 basis points there. Gold pretty quiet, down $5, and crude oil quiet as well, up about 20 cents. The dollar move is muted as well. So today the action really seems to be, Kevin, in the bond market, in the NASDAQ.
Exactly right, Alex. Those yields drifting back down below 1.7, now currently sitting about 1.68, has given new fuel to the NASDAQ discussion. So NASDAQ having a big day. You know, a lot of widely held names having really nice days. Most Apple up 2%. So a lot of green in the board. You know, on the other side of that, industrials are a little weak. Financials are a little weak, as you would think, with lower yields, Alex. They've had quite a run up until now. So a lot going on there between that rotation. Looks like it's, you know, at least stabilizing in terms of the NASDAQ.
Kevin, what's interesting to me is I look at NVIDIA and I see a stock that's obviously had a very strong run over the last 52 weeks off the lows of March and April. It looks like it's stalled out a little bit over the last 6 months. It's about 13, 14, 15% or so, let's say, off its all-time high. But over the last 2 weeks, it's up 14.5%. So even with all this underperformance and sideways action, this stock is moving around a ton.
Yeah, a lot of these names, you know, like NVIDIA is one of them. Remember, they get volatile on the downside. That sell-off down to about the 500 or the $460 level and some change was harsh, and it happened quickly. But so does the snapback. You know, now trading about 530. Now the question, Alex, that you have to ask yourself if you're bullish on NVIDIA or bullish on semiconductor stocks in general is, what happens from here? You know, we're approaching the 50-day moving average at about 500. I have it about, on my Thinkorswim platform, my 50-day moving average is currently about $541 and right under $542. So as we approach that, what does that mean for the direction of this name? And if you are, like Landon Swan was talking about, you know, excited about the future for NVIDIA and making chips for not only gaming, but cryptocurrency as well, and the ensuing popularity that would hold, well, you probably got a plan for the upside. It's got earnings, Alex, May 20th, so about a month later, 3-4 weeks later than the two other, Intel and AMD. So this one, we're going to do it a little different, Alex. We're just going to go a pure one lot, a 570 call calendar with the April 16th and then this week, March 26th. Now, there's two choices for your short option, Alex. If you do the March 26th, there's not a lot of premium in that. It's a fair amount, but not if you compared it to some of the premiums in NVIDIA. So if you do the March 26th 570, you've actually got negative theta because of the differential between the two premiums. If you move that March 26th out to April 1st and go with your short, it lowers the price and it lowers that theta amount as well that you pay for that. So there's a lot of things to look at in terms of, you know, we know where we want to get long NVIDIA. Where do you sell it? Do you sell it this week or do you sell it next week? But remember, if you sell it this week, you can extend duration into next week as well. So it just depends on what debit you want it to be, Alex.
It's pretty interesting kind of market awareness, though, Kevin, to look at that, because going out to the end of this week is only 50 cents or so, but going out to the end of next week, the same kind of option is almost, you know, $1.85. And so it's just odd to see that there's that much premium, additional premium in next week's expiration. But Kevin, with this one,
all the way out till 570.
The debit paid is the risk on the trade. So nearly $5 on this one. That's probably why you talked about keeping that size in check. And so this is where, you know, not all spreads are the exact same, in the sense that a one lot here is, you know, more than 5 was in the Intel trade. And so it's very interesting using what the market gives us and kind of adjusting our risk accordingly. But in this case, it's an upside play. You see that by the delta reflecting a 12 delta. And Vega obviously is something that's going to benefit from expanding volatility. We need to move towards 570, and there's several roll opportunities here potentially in this one as well. And so, Kev, we're going to work just one of them. As you said, we'll work it at 501, and we'll see if we're able to get a fill. Kev, with so many things on the calendar this week, particularly from the Fed, and kind of a quiet, I guess, start to the week, even though there's some pretty big moves in, let's say, the NASDAQ and the bond market, it is just a fairly quiet, meandering day once that initial move was taking place. Do you expect much intraday volatility?
Well, I'm watching for headlines from, all the speakers today, but I think that will, hold us until later in the week when we get some good economic data, not till Wednesday, Thursday, Friday, Alex.
Good stuff. We'll keep our eyes out for headlines as they come across the wire, and we'll see what kind of impacts the different speeches make, as well as the economic data later on this week. But we'll be back throughout the week, 10 o'clock Central Time, as always. Thanks for tuning in. Make sure you check out Kevin later on this afternoon on Midday Trade, and stick around for your first trade coming up next. We'll see you tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay. I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Welcome to Your First Trade. I'm Scott Connor, 30-year trading veteran, and it is Monday, March 22nd. Now, on our show, we'll be talking a little bit later about portfolio management. We've got the end of the quarter coming up this week, so we thought that'd be an appropriate topic. Now, after that, we'll be looking at an example trade based on Costco, symbol COST. We'll do that with the chart master Ben Watson, and finally, we'll wrap it up by going into Thinkorswim platform and looking at a very dynamic tool called Think Back, something that gives us the ability to go back and back test an option strategy. Now, let's start off with what's happening with the U.S. markets today. Looks pretty strong across the board. 3 out of 4 indices are up on the day. Let's do a quick check of where they stand. Right now, the S&P 500 is up about 0.7%, and that's a gain of about 27 points. That puts the S&P at 3940. Now, the NASDAQ, even stronger, up 1.78%. That's a gain of 229 points. That puts the NASDAQ at 13,096. Dow Jones up about 0.2%, so just barely to the positive side. That's a gain of about 69 points, and that puts the Dow Jones at 32,699. And finally, the Russell, which is down on the day. That's down about 0.9%, or a loss of about 21 points, and that puts the Russell at 2266. Now, interestingly enough, the fear index, VIX, volatility index, is down substantially, down 1.23. That's about a 5 or 6% drop in the VIX, and that puts it one more time below 20. It's right now holding at 19.72. All right, well, let's quick look at the 4 major indices and a little bit of fear coming out of the marketplace. Now let's break it down a little bit further and take a quick look at the different sectors within the S&P 500, see how those are faring. And right now, we'll start with the gainers, and we see healthcare up 0.6, consumer staples up about almost 0.75%, consumer discretionary up 0.8, consumer communication services up about 0.9, real estate up 1.18%, and the strongest of the sectors today is information technology. The IT sector is up almost 1.9% so far today. Now, where are we seeing a little bit of weakness? Well, materials down about, less than 0.1%. Same with utilities. Industrials down about, just about 0.3%. And financials, the weakest of the different sectors today, down about 1.08%. So about 1.1%. We're seeing interest rates fall just a little bit today, so that would explain what's happening with financials. Now, let's take the next step and click on the Visualize sub-tab and get a quick shot at the heat map of the S&P 500. So I'll just drop down to S&P 500, highlight that, and now take a look at the heat map. And this is one of those days where the green is mostly on the left side of the heat map, and then it fades to a little bit of red on the right side. Why is that? Well, information technology and communication services and consumer discretionary are the 3 biggest sectors. And like I said, those contain most of the FANG stocks, which are performing pretty well today. IT leading all the sectors today, and you can see why. Microsoft up 2.5%. You can see Apple up a couple percent. In the communication services, Facebook showing some strength, Disney, Netflix also, and consumer discretionary, Tesla up over 5% on the day. That's helping, and so is Amazon up about 1.2%. Now, as we fade to the right side, we saw where some of the weakness was. You can see some red in industrials. We talked about financials being the weakest sector, and take a look. You can see Bank of America, JP Morgan, both down over 2%. Again, that has probably a lot to do with the drop in interest rates today. We'll touch on that a little bit later. Outside of that, materials a little bit lower, and energy kind of mixed in with a little bit of red. But that's a quick look at the U.S. markets and where we're seeing relative strength among the sectors in the S&P 500. Now, let's take a quick look at what happened internationally. Coming into the U.S. Trading day, and we had Germany up about 0.2%, France down about 0.4%, UK up about 0.3%. So kind of mixed in Europe. What about Asia? Well, Japan was down 2%, Hong Kong was down about 0.3%, and the Dow Jones Shanghai up about 1%. So really kind of some mixed signals there from Asia, as well as Europe, kind of a split like we're seeing here today. Most of the indices up in the U.S., but one of them lagging a little bit behind. All right, well, let's quick look at how the U.S. Market sort of was set up before the opening bell this morning. Now let's talk a little bit about what's behind the markets, what we're seeing today, and actually kind of think a little bit about this whole week. And to do that, we're joined by your first trade contributor, Sean Cruz. Sean, welcome. Good to have you back here on Your First Trade. And Sean, we're just kind of taking a quick look at the markets. It looks like we got some good strength. Maybe it seems like the NASDAQ is back, Sean. I'll throw that out to you because I know 4 out of the last 5 weeks, the NASDAQ has been down. It's been lagging as we've seen some of the other major U.S. indices. But Sean, it looks like, I don't want to say they're back in the driver's seat, but they're certainly getting back in the game, Sean.
Yeah, and I think it makes sense. If you look at really what's been going on with the NASDAQ over the past couple of weeks now, it's really been a highly volatile, tied to almost lockstep with volatility out of interest rates, particularly in that 10-year. And when you start to see the 10-year really moving around, especially if you see it shooting higher, I think that is something that really impacts those high tech or high multiple stocks that are typically associated with technology. They've really benefited from low interest rates. So seeing the 10-year sort of moderate here and coming back a little bit, pulling off of some of those highs we saw last week, I think is a good sign for these tech names. And it certainly looks like there's a lot of confidence in investors that maybe some of these pullbacks can be seen as more of buying opportunities. I mean, you talked about the VIX, which is sort of that uncertainty index tied to the S&P 500. We now have VOLQ, VOLQ, which is sort of a VIX type of a calculation, but it's more specifically tailored to just the NASDAQ 100. And you're actually seeing that pull back lower as well. And I always think it's interesting that you do typically see VOLQ sort of about 4 or 5 points higher than whatever we're seeing from the VIX itself. So certainly encouraging to see the VIX pull back below that 20 level, but also seeing VOLQ pull back below 25 is just sort of another positive sign that there's really not a lot of fear or uncertainty or caution in the market right now, which bodes well for equities moving forward.
Got it. Well, Sean, we mentioned earlier we saw the VIX finally below 20 again. Well, we'll watch it the rest of the week and see if it can maintain that level in the teens. It's had trouble doing it in the past, Sean, but we'll keep an eye on it this week. Now, we did have a couple economic data points coming out. I know all week, Sean, we've got lots of Fed speakers throughout. I think today we had, 4 or 5 just today, Monday. But let's look at a couple economic data points. There were 2, I think, that kind of I noticed, one being the Chicago Fed National Activity Index. Right, so we kind of look at these different Fed areas or sections that come out with these numbers, but this is a national activity index number. And how'd that one come out, Sean?
Yeah, it came out definitely below what was being expected. It came down at minus 1.09. They actually were expecting that to rise just a little bit. And I think it's interesting that they actually mentioned a lot of weather-related effects in this report as well. And that was a pretty big detractor here. So I think it's something you certainly want to keep an eye on. But I think right now the market's sort of willing to look past this for now. But definitely getting that negative reading is not something that you really want to see, but a lot of that came from personal consumption and housing related indicators that go into this report. So we're going to wait and see if maybe this is confirmed by other reports, or if this is maybe just seen as more of a one-off type of a phenomenon due to a lot of the restrictions on economic activity in February due to some of the unseasonal weather that we experienced in large swaths of the Midwest and the South and the Northeast.
Got it, Sean. All right. Well, the other number I wanted to look at was existing home sales. We're getting a couple numbers this way. Existing home sales today, I believe new home sales tomorrow. This number, I think, missed a little bit too, Sean. But again, there's been, we know February had some volatile weather. We know that the inventory situation in housing is kind of questionable right now. But is it a surprise this existing home sales kind of missed, Sean?
Not really. And so it's interesting. One, the average selling price actually ticked higher in this report, and inventories more or less maintained, where they were at in the previous reading.
although they are significantly lower than what we're used to seeing. If you look at the supply that's out there, the supply is still something that we're trying to right size as a market. But if you look into the internals of this report, and seeing what was going on with this data and this pullback, it was almost similar to what we saw with the housing starts data last week. So look at last week, we can actually break out the various regions, and there were some weather-related effects to the housing starts numbers last week. Housing starts were down in the Midwest, in the South, and the Northeast, but they were higher in the West. Almost the exact same sort of activity here where you had existing home sales lower in the South, lower in the Midwest, and lower in the Northeast, but positive out west. So I think this is another report that sort of points to the weather that we were seeing in February really hampering people's ability to get out there, go. If you're making a home, you couldn't go out there and break ground on getting it started. If you are going out and trying to maybe buy a house, you're probably not going to want to go out and cruise around town looking at new homes or going in meeting with your realtors, your bankers, whatever that might be, when there's an Arctic blast going on outside, or the roads are so bad you can't really get out and move around. I think that was another impact on this report. So I think the market's going to more or less be willing to sort of look past this. It may raise an eyebrow, but I do think a lot of the economic data that we're getting for February, if it is significantly weaker than what was expected, might get it past this time, and you're not going to see quite the reaction you would if there was just business as usual, normal conditions, and you see such a large miss. So I think that this is something where going to look past it. Tomorrow for the new home sales numbers, they're actually expecting something similar to be going on. So I don't think a drop in the new home sales tomorrow will be anything that really is earth-shattering for people that follow the housing market in general.
Okay, well, Sean, we'll keep a close eye on the housing data coming out. Sean, before we let go, let's look at a couple stocks that caught your attention. And these both, I think, are in the same sector, the railroads or transport. And one of those is symbol KSU, Kansas City Southern, and the other one CP, Canadian Pacific. Sean, what caught your attention with these two symbols?
I think it's interesting what's going on in the railroad market. There's a merger going on where Canada Pacific is now offered to buy Kansas City Southern, and there's a lot of opportunity they see here to sort of improve efficiency, and that's something that a lot of the railroads, when we get their earnings reports, for instance, the first thing people go to is this sort of efficiency ratio that they put out, and railroads have really been focusing on driving efficiency, getting longer trains. One other key part of that efficiency is sort of the handoff, or when these trains pull in the yards and they've got to switch things over. How fast are they able to do that? How efficient is that process? That's something that railroads have really been focusing on over the past couple of years. And the other interesting thing about the way the railroad industry is structured is that it's sort of segmented in that by geographic area, and that one railroad will pretty much handle a lot of the freight in certain areas. Another railroad will then handle it in another, and there's a handoff in the middle. For Canada Pacific and Kansas City Southern, that handoff actually is in Kansas City, where you have the Canada Pacific or Kansas City trains pulling into the train yards there, and they sort of transfer things over. By merging these companies, they're saying they're going to be able to create a little bit more of an efficient, streamlined process where maybe they can even go straight through. And that's something that's being seen as unlocking a lot of opportunity. But whenever you see a merger, I always like to look and see what each stock is doing. Kansas City Southern's certainly higher, while Canada Pacific is moving lower here a little bit. And I think the reason why is usually these railroads trade at about 9 to 14 times their price to earnings, or their earnings. So P/E ratio of 9 to 14. This deal, Canada Pacific is buying them for about 30 times earnings. So over double what you typically see these trading at, which is great news if you're Kansas City Southern, but maybe if you're Canadian Pacific, you're worried maybe they're overpaying, or maybe somebody else is going to come in and try and outbid them and drive up that price. So I think it's interesting to see that dynamic going on, but Canada Pacific certainly sees opportunity opportunity to improve earnings, like we said, more efficiency, and that's why maybe they're willing to pay up so much to get this deal done. But you definitely see the both names moving in opposite directions this morning, and it'll be interesting to see if you have buyers coming in and maybe try to start buying up a little bit of Canada Pacific, because some analysts are coming out and raising price targets for Canada Pacific on the back of this, although you are seeing the stock pull back today.
All right, Sean, we'll keep our eyes on this this acquisition, as you so well described. I was just looking at a 1-year chart of each of these. Even though they're going opposite directions today, Sean, Kansas City's up 155% year to date, and Canadian Pacific up just about 100% year to date. So they've done pretty well, both of them. But remember, when we look at a 1-year chart now going back, this was pretty much the bottom of the market last year. So we're kind of at that date, Sean. So a lot of stocks look much better than using those data points. All right, well, Sean, thanks again for helping us break down the markets, what's behind them, and bringing our attention to these two stocks that are on the move today. Thanks again, Sean. We look forward to seeing you here on your first trade. Now, coming up next, I'll be joined by Brett Crowther, and we're going to talk about quarterly portfolio assessment and management. We're coming up on the last week of the quarter, so we thought this would be a relevant topic for all our viewers. Stay with us. We'll be back in just 2 minutes.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Welcome back to Your First Trade. I'm Scott Connor. Now let's do another quick check of the 4 major indices. Right now, the S&P 500 is up about 0.75%, or a gain of about 29 points. The NASDAQ up 2% now on the day, which is a gain of 261 points. Dow Jones up just under 0.2%. So it's hanging in there, but it's up about 54 points. And finally, the Russell still down 1% on the day, and that's a loss of about 24 points for the Russell. VIX still holding under 20, 19.66. Now, let's turn our attention back to today's topic. And as I mentioned, what we'll do is we're going to examine managing stock portfolios on a quarterly basis. Now, first, you'll learn about the major asset classes that are typically found within a portfolio, and then how diversification and rebalancing are oftentimes considered by investors at these intervals, like quarters, biannual, annual. So what we're going to do is take a quick look and review the markets in the first quarter of 2021 and what investors might expect for the rest of the year. Now, joining me to discuss portfolio assessment and management is Your First Trade contributor, Brett Crowther.
Brett, welcome to Your First Trade. Good to have you here on this Monday to kick off the week. And it is the end of the quarter. It will be by the end of this week. And we thought we'd talk a little bit about portfolio management. So I think maybe to kick things off here, Brett, for our viewers who are maybe new to this, maybe we'll just start off with describing what we mean by portfolio management.
Yeah, sure, Scott. Portfolio management is creating and managing an investment account with the goal of maximizing returns while maintaining an appropriate level of risk and exposure. Now, some investors choose to self-direct their own portfolios, while others will pay professional portfolio managers for their services. But either way, for those desiring to do it themselves, Scott, education is an important first step for all self-directed investors.
Got it. Well, you mentioned a couple of things there. One of those that really stuck out with me is you said appropriate risk and tolerance. Very important, right? So people's portfolios at different points in their life obviously have different needs and financial goals, I guess you would call it. So very important takeaway. So now let's talk about a portfolio and the management portion of it. And what are some of the key considerations for someone that reviews or assesses their portfolio, Brett?
Yeah, there are three principal factors managers focus on, Scott. They have asset allocation, diversification, and rebalancing.
Got it. All right. So that's probably three important points. And maybe our viewers should even write that down if they're taking some notes here. Asset allocation, diversification, and rebalancing. All right. So got those three keys. Now, let's break it down one at a time for our viewers. And maybe let's start with the first one. What do we actually mean by asset allocation, Brett?
Well, asset allocation, say the four major asset classes include asset, equities or stock, fixed income, which are bonds, money markets, which are CDs, real estate or REITs, and commodities. And asset allocation among the four should align with financial goals, risk appetite, age, income needs, etc. And one example of an asset allocation in one portfolio might include something like 50% stocks, 40% bonds, 5% real estate, and 5% in commodities or other, Scott.
Got it. All right. So I like that example that you were just using there. But I guess the main takeaway here is just knowing what those four major asset classes are. Now, I guess there's other things people could add. I know one of the topics going around now is Bitcoin. Should I have Bitcoin in my portfolio, Brett? And yeah, maybe that goes in the fourth one you mentioned, commodities and other. But again, I like the way you broke that down, saying that the majority are stocks or equities and bonds, or what we call fixed income. And for many people, that's the vast majority of their accounts. And then they maybe add some real estate, commodities, and those other assets. But again, those percentages kind of change over time, we know. All right, so we've got the assets, the four assets that most people choose from within a portfolio. Now, in each of those asset classes, Brett, is that where we find diversification?
Yeah, we do. Once an allocation is established in the four major asset groups, then risk is spread out within each of them. In the example of the equity asset class, it's difficult to know which individual stock or sector will outperform. So diversification seeks to capture returns of the various sectors over time, and portfolio managers will often diversify by stock, sector, industry group, and even geographic region, Scott.
Got it. All right. So I think that's an important takeaway. We're going to focus today mainly on equities. Got that, because again, that's typically the largest portion, or oftentimes is, for particularly younger investors that have a lot of time before retirement. I know that when people get closer to retirement, that percentage can change, right? So a lot of people get closer to retirement. They think, well, wait, maybe don't want to have, or maybe it doesn't make sense to have as much exposure to stocks, which can be volatile. And then they increase the portion they have in fixed income, bonds and things like that, which don't move up and down with the markets necessarily, right? All right, well, let's do this. So you were just talking about the sectors and the groups within those sectors. Let's just show everybody real quick on the Thinkorswim platform how they can break things down. And what I'm going to do, Brett, is go to the monitor page and just make sure everyone's aware that we do have a stock portfolio that we put together, a while ago, just even pre your first trade. It's just a paper money virtual portfolio with an assortment of different stocks in different sectors, right? So I'm going to use that and go to the Market Watch tab, and we're on the heat map already. But what I'm going to do is drop down here to personal and put in your first trade stock portfolio. Now, again, this is just an example portfolio that we were using to put together. And this was, a couple of years ago, I think. But what we can see is the different the different sectors that you might have within a portfolio. And this is a great first step for people to bring in their portfolio. So create a watch list, if you will, of all the different holdings within your portfolio of your equities. And it will break it down for you, how you're sort of diversified within that asset class that Brett just mentioned. You can see information technology, which is a big part of this one, communication services, consumer discretionary, and then energy, et cetera, et cetera. And you can see this has 1, 2, 3, 4, 5, 6, 7, 8, 9 of the 11 sectors covered, right? Now, when we look at something like the S&P 500, you can see that since there are 500 in stocks here, a little bit more thorough or complete diversification, and all 11 of the sectors, as you can see, are covered here in a broad-based index like the S&P 500. All right, so there's a quick way to visualize kind of your diversification within that group. And remember, you can also go a little bit deeper, like Brett mentioned. I'm going to go to S&P 500 and drop down. Well, I just want to see what stocks a portfolio has in the energy group. Well, you can click on energy, and then it will break those down to just the stocks in that energy sector. Now, this is quite a few, but then you can see how they're sort of broken down into their subgroups. All right, so far so good. We've got asset allocation. We've got the 4 assets, the groups, diversification within the asset class. Now let's get to that third step that we mentioned, Brett, and that's rebalancing a portfolio.
Yeah, Scott, rebalancing is a periodic process of reviewing a portfolio to ensure its asset allocation and diversification targets levels are maintained. For example, maybe there's a portfolio that has a 60-40 equity to bond allocation. And after a long stock market rally, that portfolio's balance could shift to a 70-30 balance. So in this case, the investor would become overexposed to equities and could consider rebalancing the asset allocation to return the portfolio to its original 60-40 stock to bond ratio. Got
it. All right. Well, that's a pretty interesting takeaway right there, because if you look at kind of what the market's done, since the big sell-off in 07, 08, right? I think we hit the bottom in 09, actually. Equities have really performed well, right? Interest rates have come down, we know that, but equities have had, significant returns. So what you're saying then is, if I was back then 60-40, 60% in stocks and 40% in bonds, since there's been such appreciation, if you will, in the equity stocks, that maybe my portfolio now is 70% stock and 30% bond in terms of exposure, right, to the market. So maybe, okay, so what you're saying, Brett, then this portfolio has sort of a dependency or overexposure to the equities, and rebalancing would sort of bring it back to the 60-40. Now, what would that involve, Brett? Just kind of like selling stocks and then maybe moving that cash back into bonds to kind of get that rebalance back, Brett?
Yeah, it's exactly that, Scott. Here, an investor could consider returning individual stock exposure levels to the original target values, and shares that have rapidly increased in value could be reduced in number, and with the cash reallocated to underperforming or new and diversified stock holdings. Scott?
All right, well, okay, that makes sense. So now I kind of get what that rebalancing is. And we were just talking about, this being the week or the quarter ends. Before we kind of look over for how this quarter is done, year to date, just in general, when do people often look at their portfolios? Is it on a monthly basis, a quarterly basis, semi-annually, or annually? What is there any recommendation or sort of target people should use to at least make some point where they look at their portfolio?
Well, there are. Some people do it more frequently. Quarterly or semi-annually tends to be some of the more norms, right? But depending on how active someone wants to be. Now, it'll depend on also things like since 2007, the four best performing sectors in terms of total returns include information technology, healthcare, consumer discretionary, and consumer staples. Now, we're looking at a year-to-date 2021 perspective. The worst performing sector has been consumer staples, which is down 2%, closely followed by utilities, down 1.5%. Next would be information technology, which is actually up 1%, and healthcare, which is up 1.5%. Now, we switch when we look at strong sectors year-to-date. They include energy up 29%, financials up 14%, communication services up 9%, and industrials and materials up 7%. Scott?
Wow. So basically what we've seen here year to date in 2021 is kind of a reverse of sort of that long-term trend since the financial crisis back in 2008, 2009. You just mentioned energy, the leader, if you will, in sectors. And now, of course, a lot of that probably is the fact that we've seen oil move up. I mean, it was like in the 30s. Now, it just last week flirted with 70s. Now it's kind of dropped back to the low 60s, but still had a pretty good move. And you also mentioned financials, and we've started to see interest rates move up significantly. So, Brett, kind of looking out for 2021, if an investor is thinking about rebalancing here, since it is the end of the quarter, are these the kind of things that they want to keep in mind when they're making their decisions about their exposure and what the different sectors are doing?
Yeah, definitely. And, they can learn more, too. TD Ameritrade offers courses, webcasts, in-person events, and more at the Education Center at tdameritrade.com.
All right. Well, that's another good step for all of our viewers to follow up a little bit more about portfolio management and take advantage of all the different offerings. All right. Well, listen, we're going to wrap it up there. Brett, thanks for helping us kind of get a better idea of, portfolio assessment and management. I like your breakdown there of starting with the 4 asset classes and then diversification amongst those different asset classes. And then finally, what it means to assess or rebalance a portfolio maybe on a quarterly basis. Good takeaways, I think, for all of our viewers now that it is the end of this first quarter of 2021. Thanks again, Brett. We look forward to you helping us break down other topics on your first trade. All right, well, coming up next, we're going to turn our attention to today's example trade. We're going to be looking at a household name, one that many people are familiar with and visit, and that's Costco, symbol COST. We'll be looking at an example trade going out a few weeks for that symbol. So stay with us. We'll have that in just a moment.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I want to know what I'm paying up front.
Yes, absolutely.
Now offering 0 commissions on online trades.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back to Your First Trade. I'm Scott Connor. Now let's do another check on the four major indices. Right now, the S&P 500 up about 30.5 points. The NASDAQ up 280 points. The Dow Jones up about 60 points on the day. And finally, the Russell, only indice down on the day. And that is, of course, down about 24 points. VIX holding at 19.56. All right, well, let's turn our attention to Costco, symbol COST, and consider a potential example trade. And to do that, let's bring in the chart master, Ben Watson, coming to us live from Salt Lake City. Ben, welcome to Your First Trade to kick off the week here. We're looking at Costco. Now, there's a stock that started off or coming into the end of last year with a big run to the upside, but has had a little bit of rough sledding here in 2021, though it looks like maybe it's coming back. So, Ben, what are your takeaways from the chart of Costco right now?
Well, Scott, you described the trend just perfectly there. You know, Costco's been in a long-term uptrend, but they've been pulling back through this intermediate term downtrend. Now, maybe seeing a little bit of reversal of fortune here on that, this move back to the upside. So a little bit of a short-term uptrend. What I think we could describe this as is a completed head and shoulders pattern. You can see I've drawn in those three lines describing the head and the shoulders of that pattern, the neckline of that pattern right around the 348 level or so, and the completion of that pattern coming down into this support that the stock just bounced up off of right around the 306 mark. And so we get that bounce higher. That coincides with the early March earnings announcement, and we now start to see this rally back up to a resistance at about 334, a little bit of a pullback into a support level, and then a bounce higher. And that bounce higher now sets us up with a pattern that we call a cup and handle pattern. You can see that the left-hand portion of that pattern, it looks like a cup. The right-hand portion back up to that resistance around 334 looks kind of like the handle of a teacup or a coffee cup, if you will. The pattern target puts the price up around 360, but you've got a couple of things in the way. You've got a resistance at around 348 again. You've got the 50-period simple moving average, which is just under that 348 level. And then if it goes the other direction and it doesn't break out, even though today's candle is pretty solid and moving right up against that resistance, it could come back down to that 320 support and then all the way down to that 306 level of support again, where it bounced down there off the bottom of that cup, if you will. The RSI did something very similar. It made a very similar type of pattern. It's now rising, just barely breaking out of that line to a new higher high. And if you want to see a close-up of it, that second chart that I've got shows the close-up of this cup and handle pattern. So we might see this breakout. If it breaks out of 334, watch for it to move out to 348. But this is a bullish pattern as this starts to begin a little bit of an uptrend here, Scott.
Got it. All right. I like that head and shoulders that you pointed out there.
Yep.
And then that drop off after the shoulder, got it back down to those support levels there. I think you mentioned around 320, 315, somewhere in there.
Yep.
So, all right. Well, maybe what we'll do is consider sort of a neutral to bullish trade, example trade, based on the fact that this head and shoulders is kind of completed there, Ben.
Yep.
Great takeaway on the underlying of Costco. Thanks again, Ben. Yep. We look forward to you joining us throughout the week for other example trades. Thanks. All right, well, let's turn our attention back to the Thinkorswim platform, and I'll go to the trade tab. I have Costco in there right now. And again, let's put together a trade that would align with someone looking at, okay, maybe if Costco, as Ben pointed out, has completed the head and shoulders, found some support and might be bouncing here a little bit, that maybe we'll go out 3 or 4 weeks and say that, all right, it's let's go down to maybe where that support level was and look at selling a put spread. In other words, saying that we don't think, or at least the trader doesn't think, that the stock would be going down in the next 3 or 4 weeks and ending up below that support area, sort of where the Head and Shoulders had completed its pattern, so to speak. So let's do this. Time and price. We always start with that on your first trade. Time, let's go out 3 or 4 weeks. Let's take a look at what we have. How about this one? The 16th of April, that gives us 25 days. That would give the trader 25 days till expiration. And right now the stock is trading about $334. Now it's up $5 on the day. So that level of 320 now is about $14 lower than where it is. So let's start off right here and go to the put side and highlight about where the stock is now. And it's probably right around here, just a little bit under 335. Let's drop down to that area Ben was talking about where we see 320. That would be down about this level. It has about a 21% chance of getting there. If we drop down to the 317, which is a little bit closer to that 315 area that Ben was talking about, there's only about 18% probability of the stock getting down there. So tell you what, we'll start with this example trade of selling the 317 put and then buying the 315 put. So let's highlight the 317. Now I'll start off by left clicking on the bid price, and that creates an order to sell one of the 317.5 puts. Let me hide the left side bar just to give us a little more room. There we go. And that's trading right about $1.63 right now for that option. Now, if we're selling the 317.5, I'll highlight the one we just sold. I'm going to hold down my control key and purchase the 315 put. And you can see that has now become a vertical spread. So what are we doing? Selling one of the 317 puts, buying one plus one of the 315 put, collecting about 32, 33 cents for that put spread. Now, what does that mean? Let's tell you what, we'll make it 33 right now. Well, it's a $2.50 wide spread. So the maximum risk on this would be $2.50 minus any transaction costs, but we're collecting about 33 cents. So 250 minus 33 would be what, about 217. That would be the maximum risk on this trade. So let's hit confirm and send and make sure that that's exactly what's happening here. Take a look. Max profit will be the credit received, $33. Max loss would be 217. That's the 250 minus 33, 217. And right now that looks like that trade is somewhere around 32, 33 cents. Could it go a little bit higher? Well, if the stock were to drop a little bit, it might go higher. So maybe that's why we'll initiate this order, enter this order with a limit price slightly higher. Now, if this order is going to work and maybe not get filled today, but maybe if the stock drops off a little bit, in the next ensuing days, I'm going to hit edit, take it back to the entry tools box here, and then change our time in force, that's TIF, change it from day to GTC. So this order will work today, tomorrow, the next day, either until it gets filled or of course we cancel it. So let's hit confirm and send. Now the only thing we changed here is we made it a GTC order, as you can see. So I'm going to send that one out, and now it is working in the marketplace. So now we have an order working to sell a put spread about $15 lower than where, well, a little bit less than that. See, 334, yeah, about $15 to $17 lower than where it is now. That's right, because if you consider that we're trading at 335 up here and we're looking at 317, yeah, it's about $17 lower. So we'll let that one work, and again, we have a better chance of getting that limit order filled if the stock does drop just a little bit today or tomorrow or sometime in the near future. All right, we're going to let that order continue to work, and we'll be back with Pat Mullally. Now, what we're going to do when he gets back, we're going to go into the Thinkorswim software and go to the Analyze tab and bring up something called ThinkBack, a tool that allows you to go back in time, so to speak, enter a trade, and then see how it did over the time by moving the date forward. So you don't want to miss this. We'll break this down for you in just 2 minutes. Stay with us.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow. Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
I'm Jenny Horn. Here's a few movers following this morning's analyst calls. JP Morgan is lower despite Credit Suisse raising its price target on the stock to $165 a share from $150. Credit Suisse says JP Morgan's current valuation reflects its earnings momentum is in a recovery. The financial stock has an average rating of outperform among analysts, with price targets ranging from $95 a share to $185. Dollar General is up today after an Evercore ISI analyst upgraded the stock to outperform from in line. Dollar General is up about 15% from its pre-COVID levels, compared to the S&P 500's 25% gain. While the analyst acknowledged Dollar General's headwinds in 2021, including challenging comps, he believes the discount retailer's guidance is adequately conservative. He also said he thinks a traffic injection is likely for the company. And also to the upside, Airbnb has gained almost 3% following a positive note on tourism from Truist Securities. The investment bank said the U.S. is leading the recovery in travel, while consumer demand outside of the country continues to lag. Truist highlighted that platforms like Airbnb and Expedia's VRBO are benefiting during this early recovery phase. Search interest for Expedia, Booking.com, and Priceline is also starting to pick up. This has been your TD Ameritrade Network Market Update. Now back to your first trade with Scott Connor.
All right, Jenny, thanks for that market update. And right now, four major indices holding where we checked last. S&P up 0.8, NASDAQ up 2.3%, Dow Jones up 0.25%, but the Russell still down about 1% on the day. Now, let's turn our attention back to the Thinkorswim platform, and to do that, we're going to be joined by Pat Mullally, education coach, coming to us live from Salt Lake City. Pat, welcome to your first trade. And we're going to go into the Thinkorswim platform and talk about the Think Back tool. So, Pat, what is it that we're actually going to be looking at?
Yeah, Scott, it's another great tool. I'm always amazed at how many great tools are just a click away on the Thinkorswim platform. So it's in the Analyze tab. We call it the Think Back tool, and it's designed for option back testing. Now, this has about nearly a decade of stored historical option trade data, and this is going to allow traders to back test option strategies by entering hypothetical trades in a virtual trading environment. So today you're going to learn how to enter the back trades and then monitor the profit and loss as it occurred during the lifetime of that trade, Scott.
Got it. So we go back in time, enter what you call a hypothetical trade, right? It's not a real trade. It's just something that we're going to follow. And then just move the date forward, or kind of push forward the date, and it will let us know how the profits and losses came out for that particular strategy. And again, we can test lots of them. Now, I assume this is one of the main reasons people will do this, to benefit from this tool, right, Pat? To go back and test various strategies.
Yeah, great learning tool. So again, it's a backtesting tool. This is going to allow those traders to gain insights into how a particular option strategy behaved during a defined period in the past. Basically, Scott, what if implied volatility was high? What if it was low? How was each strategy affected by changes in price, time, and volatility? Now, keep in mind, backtesting is the evaluation of a particular trading strategy using historical data. Of course, that means results presented are hypothetical, and of course, no guarantee that the same strategy today, implemented today, would produce similar results, Scott.
No, that's a good point. And again, it's going back using historical data to see how a strategy behaved in the past. Absolutely. All right. Well, with no further ado, let's get into the Thinkorswim platform, Pat. Maybe you can walk us through how this works, and I'll follow along on the Thinkorswim platform itself.
Absolutely. So we'll start a demo here. We're going to start by choosing the Analyze tab. And then underneath the Analyze tab, you're just going to simply click on the Think Back sub-tab. And the first thing we're going to do is enter a symbol. And then on the right, we're going to select a back date or use the calendar dropdown that's in that date box. And then we're going to open the options chain to see the quotes for that period and initiate a theoretical back trade the same exact way, Scott, that you would initiate a trade in real time on the trade tab. Then from there, down at the back trade area below the options chain is the profit and loss date that can be advanced to see how the P&L played out over time, Scott.
Got it. All right, Pat. So what I'm doing is going through that process pretty quickly, trying to keep up with you there, but I think I got it.
All right.
So we went to the Think Back tab. We put in the date. We went back. I use the calendar to just go back by, you can click here to take it back by months or click here to take it back by years. So really you can go back quite some time. So I went back to kind of the beginning of the year, back on January 1st, for example. We'll just start off year to date. And once you've got the date in there, like you mentioned, Pat, you can look at the different option chains. And so I figured, well, maybe we'll go out to maybe the end of January to see how a certain option strategy may have performed. So I went out to the 29th of January and just clicked on, and the stock at the time, it tells you, was trading at 176. So I just said, well, what if we bought the 177.5 call? All right, so it put it in there, and you can see there it is. It shows up on the P&L. It's called the back trade P&L. It's got the date right here, and of course it shows you the trade itself. All right, so now we've got some information there, Pat, that we can look at. I'm going to raise this up a little bit here so we can take a quick look. Now, once we've got this far, then what's the next step, Pat?
A couple of things. Of course, you can advance it to see what your profit and loss is. But also, Scott, for those that might be more visually inclined, in addition to that daily P&L, profit and loss that we're looking at, there's another great feature that gives you the ability to add a graph which plots out the strategy profit and loss data on the price chart, comparing the profit and loss data to the price of the underlying stock itself, Scott.
Okay, well, let's do this then. So right now it says, this is beginning of the year, so I think obviously remember the 1st of January, holidays and everything going on. But right now, looks like the price of that was let's just remember it was about $5 for that option, right? And what I'm doing now is we can look at the P&L open as we change dates here. So I'm going to start moving this forward. Now you can see just on the 6th day, it started to rack up some pretty good gains there, Pat. It was up about $837. Now remember, if we go back to the chart and kind of look what happened at the beginning of January, well, no surprise there. As a matter of fact, let me just highlight from the beginning of the year. Remember we said it was about 176. Well, you can see on the right side where it was. But as we got to the 5th, the 6th, the 7th of January, all the way to the 12th, stock had a pretty good move up to about 197. So no surprise there. But look what else happened. As we went through January, it started to come back down. And by the end of, well, basically, we kind of ended up where we were. So just with that in mind, let's go back to the Analyze tab and take a quick look. So we can see that obviously the stock, the option itself, which was purchased originally about $4.90, had moved all the way up to, oh my gosh, it was up like $8. It was already like a $12 option. And if we can kind of speed up here a little bit and kind of move through here, at one point it was up about 1,000. But by taking this through the dates, actually it was up about 1,500 by the time we got to the peak of the stock. So it had a pretty good run there. And as I move the date forward, then you can obviously see those P&Ls start to drop. And lo and behold, when we got to the last day,
let's turn on the volume first. All right, guys, we've been open now for 3 hours, and I've been in meetings pretty much the entire 3 hours. So I apologize for not jumping on. Looks like we've had a few people jump on and join for a few minutes at a time, so I appreciate that. Quick update with what I'm seeing. It seems like tech shares are finally getting the surge that we finally needed at 1.65%. So, although Kramer's talking about how it's been positive for the last 6 days, it's still negative for the past week. So it's hard to jump up for joy about the last few days. But because bottomed out on March 5th, it's up 8% since the bottom. It's still down significantly since its peak back in mid-February. Down still 4%, even despite being up 4%. So it's still down quite a bit. Some of the good stocks that take advantage of it, like TQQQ, is still down 15, nearly 16% from its high back in February. So, but on the other hand, it's up 21% from its peak. So that is really what we look at. But the good news is that means a whole lot of stocks are up today. The big challenge we're seeing right here, if any of you guys that are following these stocks that you have here on the screen, is these guys are not doing so hot today. With the exception of Tesla. Tesla, is heavily traded as it is. It's riding the wave of tech stocks going up. But not the best day for these meme stocks. AMC has actually gone up slightly as the day's gone on, but it had a drop beginning today. So again, it closed right at 14 on Friday, opened at 13.1, dropped all the way down to 11.76, and it's trying to fight back. Now it's at 22, so not the greatest day. GameStop, maybe somewhat similar trend with GameStop we're seeing over here, where it opened right about 205, spiked, and then crashed down. It bottomed out here at 186, and now it's up to 190. Costs, just really hardly any volume with costs. So good luck seeing really a whole lot of anything going on with them today. Express is down a lot. Express is down. It's also trying to claw back some of AMC. It seems like costs and AMC are actually, Express and AMC are following a lot of the same trends lately. Similar to what we saw, a month and a half ago with AMC and GameStop. Now we're seeing similar with AMC and Express. GameStop's kind of gone rogue on some of the meme stocks, not exactly correlating as it used to with AMC, because I think a lot of people are jumping off the GameStop wagon. I don't know if that means good or bad things about what's going to happen with the GameStop stock. But I think a lot of people on that last surge 2 weeks ago, where it surged to 300, I think there was a lot of those people that got burned the first time around that were still holding on to their stocks. And so it's just not. It's not in the same hands. The stocks are not owned by the same people as they were back in January through the month of February. So that's probably why we're now seeing this chart breaking from this chart. But AMC and Express, both with earnings reports positive a couple of weeks, and a little bit more of an upward trend, are seeing very similar charts. You can see the width of this chart is wider, but the time frame is similar. Where it dipped this morning, slowly trending back up. Dipped this morning, slowly trending back up. So we're kind of seeing the same. This dipped at its bottom at about 10:30 this morning. This dipped at its bottom about 9 this morning. So the time's a little off. I guess this was 10 o'clock. So it's a little off, but the overall V shape with the very slow, gradual comeback is very, very similar. I got a whole bunch of buy which just came in right at 12. It's a lot. So I don't know if that's a bunch of look at all these. 2, 1, 2, 3, 4, 5 really crazy when it came right at 12 o'clock. See they're broken out a lot more. Right. 12 over 5 seconds, 6 seconds, 8 seconds, 11 seconds. I wonder if there was a bunch of guys, going on their lunch break or coming back from lunch break. Sorry, it's after 1 o'clock for me, so they might be coming back from lunch break and hitting the buy button on AMC. So that's interesting. What was saying about Tesla over here? Informational purposes. They're just showing what we're talking about. So yeah, Treasury yields are down today. Not inflated, so don't get too excited. It seems like when the Treasury yields trend down for a day, now Nasdaq trends up more significantly. So maybe that's a good thing for the overall stock market, or at least equity market. I guess technically it's down 2.5, almost 3% today. The Nasdaq's only at 1.6, but they are completely operating in an opposing force right now. So it's really interesting to see how predictive, I guess, it is between those two. Naked Brains is just not doing good today. Naked Brains at 4.848. It's unfortunately almost right back to where it was pre-January boom. Not exactly. No, I'm wrong. I was thinking it was okay, but it's not. It was at 0.4. So 0.455 before the boom in January. I still think it's got a decent chance of continuing to rise up because it also has good things going for it. MicroStrategy, Riot Blockchain are down a lot because Bitcoin's been down today. So Bitcoin down all the way to 56,885 today. That's the lowest it's been for the day, but peaked up to 58 just, was that 7 hours ago? So again, that's the huge swings you're seeing. Within hours, you're seeing 1, 2, 3% swings, sometimes 5 to 10% swings within a few hours of each other on Bitcoin and other cryptos. It's just crazy to see how quickly the wide swings fall. Now, those wide swings are still drifting upwards. So I think you're still in very safe territory. Looking back 3 months on Bitcoin, it was at 23. So lots of big up and downs. Still, even back one month ago, you're still at 10%. 1 week ago, you might be hurting, but it's sort of leveled. I really wonder if anyone is watching, has Bitcoin leveled off, or is it just kind of hanging out until it spikes? Hold on. I'm talking about home sales.
Buyers, the National Association of Realtors said that it was the coldest February in decades, which likely impacted the pace of existing home sales. But homes are only remaining on the market for a short period of time, still only 20 days. That's the lowest on record. I would say if there's a bounce back coming from better weather, there are some concerns certainly about these interest rates.
But of course, they're going to go up and down with the market conditions. You can't just, they're not going to go every single day. So interesting that Pulte's down and the others are all up. There it is. Existing home sales February 21. Other one down 6%. Doesn't surprise me, unfortunately. And 0.6% higher. So yeah. So the issue with the home prices is people are scared off by buying a new house right now because the interest rates are rising, but the supply is still really low, especially for resales. And the wait list for the delayed build cost for a new build is really slow. So it doesn't surprise me that home sales are down. And I fundamentally believe it might continue to go down unless we get relief on this interest rate. But the last month and a half, 2 months with interest rates going up has hurt it significantly. So I think there might be some pressure put back on the Treasury rate and then the overall interest rates we're seeing on mortgages just because homes are not selling. You might very quickly kind of going back into the downward trend we were seeing in late 2019 when people in the mortgage industry were actually getting laid off because they beefed up for the 2018 surge and the number of sales down in 2019. and then in in 2020 because people were not sure about this pandemic. And then once the pandemic hit, it was complete standstill for about a month. And then once like May happened, probably May of last year, it just blew up. And demand went skyrocket high while the supply was kept low. That also supply chain issues created a pinch with the price of commodities like lumber and metal and other building materials, and so prices just went through the roof. Between the demand and the commodity prices, the labor prices going up because of you know, either preemptively or by law, and wages going up for some of these laborers. And I don't expect the price of new houses to go down significantly in the future. It's not going to be until there's a flood to the market of two things that could cause it. Flood to the market of existing homes, which creates pressure on the new home builders to reduce their prices to compete, and a reduction in supply or commodity prices. But labor prices are going to stay high. Labor is still going to be a tough market no matter what. Finding laborers to build houses is going to be tough no matter what. And with minimum wages continuing going up, it's going to affect these types of laborers. I don't really see the price of building a house. Like, let's say you're going to build a $500,000 house, $500,000. I don't think that's just going to magically drop down to 300, 350, like it probably was and should have cost 3, 4 years ago. Um, that $500,000 house might go down to like 450 or 475, just because of the commodity prices. That's about it. So I think they won't reduce prices greatly because there's so much you can price a new house out. You still have to pay for the supply, you still have to pay for the stuff. So you can't undersell a new house build. I think the price I think in late 2021, maybe into the spring of 2022, you're going to see a massive amount of homes hit the market. Now there's going to be a demand. There's going to be a demand also for the supply because there's going to be a lot of people that are right. There's people that have now realized they don't have to live close to their office, and uh, if they don't have to live close to their office, then they might be wanting to move. So there's a demand to want to move. But if they're moving, it's likely because they are also selling, and so there's that they may not want to do that right now because of the virus. They may not want people to uh, walk through their house and do a showing. They might have some uncertainty on what's going to happen with their jobs still. So they're not really jumping to make this massive decision to change their life. But a year from now, next March, next April, I think we all hope and pray that this virus is behind us by then, at least in a large majority that it is. And then I think we'll see this huge shift because people that have been either wanting to move for the past 2 years for good reason, or have now since decided to move because they don't have to go to their office anymore, they can work from home, will absolutely flood the market like snooze. So there will be resale homes out the wazoo for sale for people leaving, especially like in city centers and moving outward. There will be tons of people looking to move homes in the next, 12 to 16 months. So, like not in the next 12 to 16 months, but I mean like 12 to 16 months from now. Might see a little bit of surge in the fall this year, but not really going to sell in the fall. More people sell in the summer because of schools. So I'm interested. I'm really interested to see what's going to happen in the South and in the market of someone who is wanting to build a house. And now, with the price of materials and labor, I don't know if I'll be able to buy a house. I might have to wait till a year later this year or next year and see maybe if it's more, if it's a better deal to just buy an existing house. And sure, I won't get exactly what I want, but if the price of a resale home goes down so significantly where I can get exactly what I want for a cheap price and for, like 3/4 of what it costs to get a new one, then it might just have to do that. So it's not necessarily what I want, but if I simply cannot afford to the custom home that I want, then that's the problem we're in. Having said that, if I built a custom home, I don't think you're in a situation where it's like a used car, where you build a custom home and then instantly going to lose 20% of its value the next day driving off the lot because um, I think you'll still be able to resell a new custom home pretty high for a while because the demand is still high and the demand is still high for new homes versus the old resale homes. So people might pay a slight discount to what you paid to build it, but not like 20, 23%, maybe 5% less if that. But you may not even have that problem. You may be able to get into a contract as the market continues to go up in price into the next 5 to 10 years, because I know it will, because of inflation, labor costs, and all that stuff. The cost of housing is going to go crazy in the next 10 years, guys. So because of that, you'll be safe. So even if you built a house now, relatively inflated housing market and commodity market bubble, even if there's a pinhole in the bubble that goes down, 10, 15% over the next, 1 to 2 years, eventually over 5 to 10 years, you're going to do fantastic. And you may even be better off deciding to make that move now than in 2 years. If you're waiting to buy a resale home, you may be better off waiting for a year or a year and a half for that surge of inventory to come, which could then drive down the price because there's just competition. Competition between sellers now instead of competition between buyers. So if there's competition between sellers, then there's less of that sense of urgency to just buy anything that's on the market. And so we'll see houses sitting on the market a little bit longer, prices getting reduced, things like that, things that you normally see in the housing market, which you're just not seeing in the market this year because it's in my neighborhood, it's a small neighborhood. Houses are literally on the market for a day, and it'll be like one house at a time because it's a small neighborhood. So one house comes on the market at a time, and when it comes on the market, 24 hours they have an accepted offer because there's so few houses on the market right now. You could almost put your house on the market and name your price. I mean, within reason. You can't charge $1 million for a $500,000 house, but if you have a $300,000 house, hell, put it up there for $350,000. You get that extra $50,000 right now because there's nothing else for sale. That's where we're at. So we won't be there 16 months from now, I promise you. Anyway, that's my rant about home sales. I think that we are going to have a pretty good year next year when it comes to home sales. Prices going down, volumes going up, but that also might come with mortgage rates needing to be higher just to accommodate that in a market. That makes sense because if the mortgage rates are crazy low like they are, and the volume of sales is crazy high, I don't see that being cost beneficial. So banks are going to step in. So interesting time, super interesting time. So if you have any opinions about that, feel free to put it in the chat. I'd love to hear if anyone else has any how the housing market might play out over the next 2 or the next 5 to 10 years.
You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I want to know what I'm paying up front.
Yes, absolutely.
Now offering 0 commissions on online trades.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back. Let's take a look at the biggest movers in the market right now. We were just talking about Tesla. It is on the rise after ARK Invest founder Cathie Wood expects the stock to hit $3,000 a share by 2025. In her note, Wood says ARK estimates the probability of Tesla delivering fully autonomous driving by 2025 at 50%. The stock's been a winner. It's up almost 700% in the last 1 year. PepsiCo shares are higher after Barclays upgrades the stock to overweight from equal weight. The analyst said she's been perplexed by Pepsi's underperformance within the staples sector. She knows that the company is one of the few with clear visibility into achieving its algorithm in 2021, which could provide a multi-year stock appreciation story. Here's a look at Box. Shares are jumping. It's exploring a sale after pressure from activist hedge fund Starboard Value. According to Reuters, Box has discussed a possible deal with interested buyers, and the stock is up about 30% just for this month of March. Now to the downside, both Snap and Pinterest are trading lower. Bank of America Analyst Securities downgrading the stocks to neutral from buy. The analyst says that the internet companies could continue to see strong growth. The stocks could fall out of favor, though, as the economy recovers and tougher comps in the second half of 2021. And let's check in on Bitcoin as we do every single day. See where it is right now, 56,690, trading down today. Well, we're looking at the rising rate environment and the impact it could have here on business confidence. Jeffrey Kleintop is with us, Chief Global Investment Strategist at Charles Schwab. It's always a pleasure to have you on the show, Jeffrey. I'm glad you're able to be here with us. As we look at business confidence, right, and the rising rate environment, is it not necessarily the rising rates, but more so the velocity of the rates, right? When we were at 0.5 last year, and then 1, then 1.5, then 1.7, and there was sort of this anxiety. But now today we pull back a little bit and look what happens with tech. So is the confidence in what we see more about the higher rates, or is it more about how fast they rise?
I think you're right, Nicole. I think it was about the pace and where it may end up. We know that rising rates make it more costly to borrow and could slow business spending on equipment and jobs. But that's not what's happening. I mean, rates have been going up for 8 months now, and business spending is booming. And so I think you want to look at capital goods producers. I think you want to look at the areas of the businesses that are making things for other businesses to make things, right? So this week, we're going to get more data on rising business optimism despite rising interest rates. We get Japan's machine tool orders tomorrow. Japan, they make stuff that other businesses use to make things around the world. So watching their orders are going to be great. We're going to get the final numbers for February. They're expected to be up 37% from a year ago. Now, I know that's on easy comps, but still booming. We know semiconductor capital equipment demand is huge given the shortages there. So many other orders for equipment are booming. We're going to get the preliminary PMI reports on Wednesday, along with U.S. durable goods orders. They should be good numbers. And then the German IFO survey, a business survey on Friday. Interest rates rising and rising rapidly. We're giving the stock market some jitters, but it doesn't seem to be bothering business leaders. And that's the key feedback mechanism. We can get rates to go up and have it not impact capital goods spending. Then I think that just further confirms that the economy is recovering. Businesses are going to continue to spend despite these concerns. Let me just add, that if I'm wrong, we'll find out this week. We will see these numbers in Japan's machine tool orders, the U.S. durable goods numbers, and if they are weaker than expected, then that would raise concerns that already the pace of interest rates, even as low as it is, maybe the pace started to give business leaders, CFOs, some pause, and they pull back on spending. So I think we'll get the verdict this week.
Yeah, you know, as we look at the consensus, right, we're calling for durable goods orders to rise 0.5% month over month to 258 billion. That may have been updated, but that's roughly where it's likely to be. And when we talk about this, I mean, there's been a lot of pent-up demand, and that's why you're seeing these companies spending like you're saying. I think you have a really great perspective on this, Jeffrey, because you always look internationally. I mean, you've mentioned Germany, right? For example, you've gotten some latest numbers there. You're watching for some numbers later in the week. What does the global picture tell us?
It looks pretty solid. I think what we're seeing, even in areas where where the pandemic is still lingering, where we're still seeing lockdowns in Paris and Italy, and in much of Asia, where they really haven't delivered much in the way of vaccine doses, we're still seeing very strong demand by consumers, particularly in China, which is really driving those economies and driving end demand. I think that's important. I think you want to focus on, thinking sectors over shots. Don't worry so much about the fact that maybe Germany's lagging in terms of its rollout of vaccines. Take a look at Germany's flash manufacturing PMI here on pricing, clearly showing prices are at a 10-year high for manufactured goods, reflecting the gap between demand and supply, which I think is likely to persist.
Yeah, and last month, the composite reading for both PMIs here at home hit 6-year highs. So it shows that there is this optimism. We are seeing this boom in manufacturing. People are talking about the roaring 20s. I mean, they're really very excited about what could be here. Something like home sales, I mean, took a breather, but that's not based on the confidence of the builders. It's based on supply, right? I mean, that's how we should take that.
Exactly. So when we take a look at some of these production numbers, and the PMI will be important, whereas we might see maybe output could have slowed, we'll have to see, but it may be simply because supplier delivery times are so stretched. It just takes so much time now. There's so many bottlenecks to actually get products delivered. I mean, we've seen backup in ports around the world. Of course, we talked about the semiconductor shortage, but this is true for a lot of key inputs. But it's not affecting orders. Order demand is booming, both for export orders and domestic orders, anywhere we look, in the US, in Europe, and in Asia. And that's really key. That's what stocks tend to key off of, the order growth trends, not so much the output trends, because they're often affected by these temporary factors. But, it could lead to higher inflation in the near term as, price pressures continue to build on the demand side, and we're just not able to deliver the products on the supply side. But as that evens out, maybe in the second half of this year, as more people are put back to work and we see more economies opened up more widely and those bottlenecks begin to ease, those pressures could begin to come back down again. So I think we're just in this near-term environment where markets are worried about the velocity of the rise in rates and inflation, but I think they really should be focused on the velocity of the demand comeback and maybe, as you put it, the roaring 20s.
Yeah, I'm glad you mentioned inflation as well, because that's the concern, right? As long as it doesn't all happen too quickly, because there's lots of demand and then not enough chips, for example, for the cars, right? Ford, Toyota, GM have all said that, right? We're ready to pump them out, but we don't have the chips we need. So that's the kind of stuff I think that we're going to deal with in the near term. That being said, I spoke with a trader on the floor of the New York Stock Exchange on Friday. So much excitement over there, a lot of SPACs, a lot of trading. It's been, I know you've been watching some different stats, including the inflows into the markets here. We had Quad Witch on Friday, a rebalance. I mean, lots of volume happening. What are you watching most closely, and what's it telling you?
I think there's a less appreciated positive out there in the markets. This is one of my favorite charts. I'm watching this, and we've talked about this back in October on the show. The idea is that we're seeing inflows in the market from individual investors for the first time in a long time. The orange line here looks at the flows through to ETFs and mutual funds. And like clockwork, money's been pouring in since the election, as it always does. Usually money's flowing out of the market, that orange line's coming down in the year ahead of the presidential election. And then, no matter who wins, the money starts to flow back in over the following year or so, starting right in line with the election. And the takeaway is that the market was able to produce gains last year, sure, but they were very narrow on weak flows, right? Just a handful of stocks. This year, we're seeing a much broader advance, a lot more sectors, a lot more stocks moving up, equal weighted indices doing well on stronger and broader flows to the equity markets, and that may continue. So a broader market advance than what we were used to last year.
Right. Yeah, absolutely. I mean, it's amazing to watch all of this in the big picture. Jeffrey, it's great to see you, as always. Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab. Thanks, Jeffrey. Coming up next, the CEO of Annovis Bio will join me to discuss the latest trial data as the company searches for treatments to battle Alzheimer's and Parkinson's. Don't forget, tune in 5 p.m. Eastern Time, Market Overtime. We'll focus on what you need to know for your long-term portfolio. Market Overtime airs weekdays right here, 5 p.m. on the TD Ameritrade Network.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Welcome back to the Watch List. I'm Nicole Pedalides. The search for treatments to fight Alzheimer's and Parkinson's diseases continues. Maria Mattachini is with us, President, CEO of Annovis Bio. Glad you're with us, Maria, to talk about this. You're currently studying lots of ways to fight off these important diseases and what you're doing, lots of clinical data. The very latest has some very positive results. So tell us about your drug candidate and the study that you've been doing. ANVS is the ticker symbol, folks. Maria, tell us more.
Yes, thank you so much, Nicole. This is a really wonderful time for us to talk about our company because, as you just said, we have some preliminary data, and the preliminary data looks really, really wonderful. So I started this company with a totally new approach to treating neurodegeneration, and that would be Alzheimer's and it would be Parkinson's disease. And so I decided to follow up on both and do a study in both. Now, our approach looks at the information highway of the nerve cell. If you really think about it, it's totally obvious that your brain needs to communicate with your fingers, your toes, your internal organs, your eyes, your tongue, with the environment. Because if your brain doesn't get any information and doesn't send any information, you're a vegetable. And so what we looked at is the information highway of the brain or of the nerve cell from the brain to the periphery and from the periphery back. And what we found is that in all neurodegenerative diseases, and this is true in Alzheimer's, it's true in Parkinson's, it's true in ALS, this information highway is slowed. And as it is slowed, nerve cells start to get sick. They get attacked by the immune system and they die. And once they die, the function associated with them is dead. What our drug does, it improves the information highway of the nerve cells. And we have been able to show this in mice and in humans. And by improving the information highway, it should, at least theoretically, improve function. Now, in 7 different animal models, we have shown that function is fully restored. These animal models are Alzheimer animals, Parkinson's, traumatic brain injury, stroke, acute glaucoma, frontotemporal dementia, and Down syndrome. However, animals are animals, and mice are mice, and rats are rats. So we wanted to show the same in humans. And so we devised a study in Alzheimer's and in Parkinson's patients where we are measuring the whole cascade that leads to nerve cell death. That would be including the information highway, including inflammation. Yeah. And then finally, we would actually measure function. And the very preliminary data we have so far in Parkinson's patients is that our drug improves speed and coordination. And it does that in just 1 month.
I think it's outstanding. I mean, it sounds miraculous because it's not slowing the process. In fact, it's restoring what you had before. I mean, that's what's so miraculous about the whole thing. And I like how you explained it, that as these things, and you have this, neurodegeneration, these cells become sick and your immune system attacks them. I understand what you're saying. And that ultimately leads to the worst. At this point, this is a lot of interim data that you're putting together. It sounds extraordinary. When will we hear more about the full data from the study? What are the next steps? What should I mark on my calendar? Where we'll make sure to have you on the show again because you're really hoping to hear more. I know clinical studies take time.
Well, this clinical study was really started last year. So we finished treating the Parkinson's patients, and the reason we have efficacy is that once you finish treating them, you have their safety and efficacy. So we released a news release about safety and efficacy. Now, in order to measure the toxic cascade, to measure transport and inflammation, we need to test their spinal fluid and their plasma. And that is being done right now. So we think that we're going to get the steps leading to dead nerve cells and to neurodegeneration in the next 4 or so weeks. And then the last Alzheimer patients are being treated right now. Since it's a 1-month study, they'll be done in 1 month. And then we have the same sequence. We will also show all the data in Alzheimer's. So by June...
So when does the FDA take a look at all of this? Sorry to interrupt you.
No, you're absolutely right. That's the most important, because if the FDA doesn't bless it, we have nothing. And besides, the good thing about the FDA is they are very impartial. They look at data exactly the way the data is. We plan to see them in February. What did I say? In September. So we can start our phase 3 study later in the year.
Wow, that is really exciting when I look at what's going on here. And it's not just Alzheimer's and Parkinson's, but also ALS, right? When you talk about that. Any things that you need to do? Is it partnerships? I'm sure there's competition, but you're bringing something unique. Is there anything that's on your agenda as far as the business side of getting this done in the way that you hope you can? Is it raising capital, things like that?
Well, with positive data in Alzheimer's and in Parkinson's, we will have as many options as we want. We can either do the phase 3 ourselves, we can partner them, we can partner one, we cannot partner the other, we can partner China or Japan and keep Europe keep the U.S. At this point, we really want to get the data and see how good and how solid it is. If it's solid, we have unlimited possibilities. Sometimes data is gray and we have to count on that, and then we'll have to do another study.
Makes sense. It's wonderful to see you. Please come back when you have all the updates, particularly I know in 4 weeks we're going to hear more, and then in September working closely with the FDA, and it sounds like, at least so far, the evidence is quite conclusive to a very positive outcome. But as you said, you need their blessing. So I'm sure you'll have plenty of more data for them to take a look at. Maria Maccecchini, thank you so much. Love having you on the show. Thank you.
Well,
President,
thank you.
CEO, Anavis Bio, thanks for joining us here on the watch list. Still ahead in the back half of our show, we're going to take a look at the merger in the railroad industry, break down and see what it means for some of the other transports like shippers. And let's take a look at winners and losers in the S&P 500.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back to the Watch List. I'm Nicole Petalides coming to you live from New York City. Thanks for being here with us. Let's check out the markets here. The Dow came up from a loss of over 100 points in the green now. So we're seeing strength across the board with the exception of the Russell 2000. Here you go. The Dow Jones Industrial Average up 118 points, gaining 1/3%. The NASDAQ 100 up 2.1%. The S&P 500 up 0.8%. So nice to see those techs bouncing back for folks. But the Russell has been to the downside more than 0.75% lower. We also have big news, a huge merger announced today in the railroad industry. And Canadian Pacific plans to buy Kansas City Southern. Stephanie Lewicki is looking closely at the details of this, contributor for the TD Ameritrade Network. So this mega merger underway. Tell us more about this.
Yeah, it is the largest M&A action so far this year in 2021. We have Kansas City Southern up about 12% right now, with Canadian Pacific down about 4% right now. And if we look at the deal, it is it came out with the news yesterday, and Canadian Pacific is agreed to acquire Kansas City Southern for $29 billion, including $3.8 billion in debt. And now the deal values KCU at $275 per share. That's a 23% premium to the closing price on Friday, which was 224. Now, this is still going to be pending the Surface Transportation Board approval. They're thinking it could possibly be approved next year, 2022, mid-summer months. And now this is going to create the first rail network to United States, Mexico, and Canada. So this comes on the heels of just last year, the new deal, the USMCA, after that took place and replaced the NAFTA, the 26-year-old NAFTA deal. So it's really betting on an increase in transportation, specifically with Mexico. It would connect 6 of the 7 largest metropolitan areas in North America. And they're also proposing an intermodal transportation, a new service between Dallas and Chicago to avoid some of the congestion that you see in Chicago so often. And what's interesting here is what we're seeing this year really in the market is this industrials, they're up over the last 3 months. The S&P 500 industrial stocks are up about 10%. That's compared to the NASDAQ, which is flat over the last 3 months. So we've been seeing that shift lately into these industrial companies. Again, this is going to be the largest merger in rail since Warren Buffett bought Burlington Northern Santa Fe back in 2010. And these railroad mergers, something I think it's such a big deal. This announcement is because they're more difficult to complete these days, and the industry really is already consolidated, making antitrust considerations a huge factor for a deal like this, Nicole.
Right. So when you talk about what's going on with this merger, they talk about the price targets that we've seen with the analysts. They've been raising some of the price targets. What do you think is the most positive part about this, or what's boosting these targets? When you look at it, give us some of the targets. They like this.
They certainly do. You have a slew of analysts out this morning upping price targets. TD Security raised their price targets to 585 Canadian dollars. They maintain a buy. Raymond James raised their price target to $500 Canadian dollars, and you had Wells Fargo raise price target to 418. Now that is in US dollars, maintains overweight, and then RBC raised their price target to Canadian dollars of $587. And what the CEO Keith Creel of Canadian Pacific came out and said, the stars have aligned to make this deal happen, creating this network at this opportunity. Just makes more tremendous sense to help participate and drive all those opportunities. So a lot of optimism out of both sides of the companies, and you're seeing that really reflected in, again, Kansas City's price, their stock price up about 12% right now.
Right. All right, Stephanie Lewicki, thank you for that. I appreciate it. And of course, we see, the acquirer going down, the acquiree going up. But we'll watch this action, continued action. Stephanie Lewicki, contributor for the TD Ameritrade Network, with a great breakdown. Now we'll go back to the broader market and examine what's going on here with the rising yield environment that we've been seeing. G.R. Barton is with us, Principal, Woodshaw Financial Group. Glad you're here with us because I want to get your outlook a little bit for the near term and then a little farther out.
Yeah, well, I think one of the things that's been really interesting that we've seen, Nicole, and we saw it again this morning, is the true lockstep connection between bond prices and stock prices. So the bond price opposite of yields. Every time yields tick down a little bit, the prices pop, like happened this morning, and this moves the stock market up. The Nasdaq, in particular, the technical sections, technical index, popping with that. And I think that it's kind of unusual in this way. We had a few years back where we took the 10-year up above 2%, and it was like we had a big drop in the markets and all kinds of storm and dang about that. And what happened next was just another recovery. And I'm thinking that not in the near term, but in the next 6 months, we're going to see these two thoughts decouple from each other once again, and interest rates won't impact every tick the stock market like it's doing today.
Yeah, it's interesting because we were talking about how fast they went up, right? As long as it doesn't happen as quickly. And we watch the rates, yield, coupled with inflation, right? Those are the two things that we're keeping our eye on as a market overall, and especially when you see that on the rise, it really hurts those tech stocks. As you look at what's going on in the rotation to some of the cyclical stocks, people are looking at value stocks, but you say you're buying on the dips. What are you buying on the dips specifically?
Yeah, well, I think that there are two different dips to look at here, Nicole, because you just mentioned those cyclical stocks, the industrials, the material stocks, the financial stocks that are moving opposite of the tech stocks, especially the mega tech stocks. When mega tech has a down day or a down week, those other cyclicals have a big, strong move. So I think as the cyclicals pull back, and we're having a little bit of a pullback day today, one of the stocks that I really like, Honeywell's off 1.5% or so. And I think when you get those pullbacks, it's down, Honeywell's down off 4 or 5% off of its recent highs. That's when you can add to those positions in those cyclical stocks. And you can do the same thing on the other side with the tech stocks during pullbacks. So one of the ones I like there is Taiwan Semi. Taiwan Semiconductor was up above 140. It got to 142. It's pulled back. It was as low as 113 last week. And I love it right here. It's strong today, up almost 4% with the interest rate machinations that we've been talking about. But Taiwan Semi cannot make any more semiconductors than they are right now. The world's biggest foundry. They are going 24/7, chock-a-block, and I think that's going to keep going for the rest of the year. I really like them.
Yeah, Taiwan Semi and Honeywell, as you talk about these names. The economy, is it all contingent upon, so overall you're feeling optimistic, right?
Oh, very much so, and for one big reason, and that is stimulus with a capital S, both monetary stimulus coming from the Fed and saying we're not acting, the dot plot showing we're not acting till 2023 or later, and then the fiscal stimulus, the money in people's pockets from Congress, all of that coming together to just put a great big old backstop under the market right now.
J.R. Barton, always great to have you on the show. Thank you for joining us on this Monday, kicking off a new week in style with some optimism. We appreciate it. J.R. Barton, Principal, Woodshop Financial Group. Thank you. Still ahead, we're going to discuss the impact of stimulus payments on the U.S. economy and the consumer. Because what are they doing? Some of these retail stocks are close. We're watching those. Let's take a look also at some of the recent trending stocks. Look at, for example, GameStop. Well, that's lower today, set to report its earnings tomorrow after the market closed. AMC down 12.7%.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads, like counters and diagonals, are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Evelyn Baker here with a few stories making headlines this hour. Shares of the data storage company Seagate Technology are up about 2% after receiving a price target raise at Argus. An analyst with the firm citing recovery industry demand now sees the stock reaching $86 a share, up from $75. Argus has a buy rating on Seagate, but the average analyst call among 25 Wall Street firms is a hold. Over the past year, the stock has gained roughly 85%. Nike shares are up a little more than 0.5%. An analyst at D.A. Davidson raised his price target for the stock by $6 up to $147 a share and kept it with a buy rating. Additionally, a UBS analyst issued bullish comments on Nike with a $183 price target and buy rating as well. The UBS analyst said that Nike stock and earnings still have room to grow. He said he expects the company will continue to generate strong growth well into 2021 and beyond. And Roku is up 3.5%. On Friday, the company announced it had acquired the assets of the long-running PBS home improvement show, This Old House. While the financial terms of the deal haven't yet been made public, the acquisition entails the global distribution rights of the TV shows This Old House and the related program Ask This Old House, as well as both shows' libraries, the production studio, and all digital assets. The show will stream on Roku's own advertisement-supported streaming channel. This has been your TD Ameritrade Network Market Update. Now back to the watch list with Nicole Petalides.
Evelyn Baker, thank you so much. Consumer has been very resilient during this pandemic, and pent-up demand and a rise in savings could help grow everything in 2021. So now, what are the risks to consumer spending? Sarah Henry, portfolio manager, Logan Capital Management, is an expert looking at all of this. We talk about some of the catalysts that are driving what we're seeing with consumer spending as the economy continues to reopen. What would some of those be, and what are some of the trends that you're seeing in consumer spending?
So, yes. So we have a trifecta of liquidity coming squarely at the consumer. The consumer makes up about 2/3 of GDP and should remain the economic engine for the near term here. And obviously, we've had this well-advertised stimulus that came in really quite high, close to President Biden's initial number, about 8.4% of GDP, and about 25% of that should be stimulus payments that will directly support economic growth. We also can't forget that we have the stock market wealth and housing wealth. Notably, the market is up 70% on a year-over-year basis at this point, making it the shortest downturn on record, and housing at trough levels of inventory, with millennial household formation and the value of the home driving increased investment. And then finally, we have a record glut of savings as a share of disposable income.
It's interesting how there are, you talk about, right, it's a trifecta, all good things here with the stimulus coming in, and hopefully people will be getting their jobs back. We saw that to a certain extent in the last jobs report for hospitality and leisure in particular. As far as stock market growth and housing wealth, I mean, those types of wealth are for a certain type of investor and a certain type of person. But to your point, I think a lot of people are being helped in different ways, and we have seen savings and household income at some higher levels. So what do you like? I mean, a name like Home Depot, you don't need to have stock market wealth to go and get some great stuff at Home Depot, right? So Home Depot, VFC Corp, these are some great names that you like. Tell me why you like these.
All right, guys, let's see what we got here. Coming up on 1 o'clock Central, which is 2 o'clock Eastern time. Let's see what we got on some of these stocks we were watching. Tesla's up 6% now. So pretty good day Tesla. Tesla's following the surge we're seeing on most of the tech stocks today, which is fantastic. Nasdaq up 1.5, actually 1.72%. It's gone up just over the last few minutes. So 1.72% on the Nasdaq. GameStop trying to make a little bit of a comeback, but not really getting there. It's down to 191. AMC just kind of flatlining. It came up a little bit off its bottom, but flatlining here. 12.2 is where it's currently at. Express 4.71, kind of the same story as AMC, where it fell, a little bit of a run, and then it just kind of is flatlining as well. Costs just doing their own thing, but a little bit similar to the trend we're seeing in Express. So just everything here we see on right now: Express down 11.5, AMC down 12, GameStop down 4, cost down 6, Tesla over here is up 6. But let's look at some of the others that we're looking at. Naked Brands down 7.5, BlackBerry down 1.5. So not the worst day for BlackBerry, not good. And Bed Bath & Beyond down 1.68. So overall, not the best day for these stocks, as I think everybody's paying attention to the overall market that's going up, especially with Nasdaq going up pretty significantly today. In opposite of what the Treasury yield is doing. Treasury yield is down 2.77%, which is a 1.684 rate is what the current rate is going today. Most of the other leveraged index funds like QQQ, SPXL, some of those others are going up significantly. So great day to be in the leveraged ETFs because the market's significantly just trending straight up. And I think it'll probably continue through the end of the day too. So this 1.71, honestly, it may continue to go up even more. It may end up over 2% positive, which is fantastic. The Nasdaq and tech stocks in general. So my portfolio personally is probably somewhere around
it seems that people really are leaning towards a lot of the big box names that we know so well, like
so not
Target,
overall
Home
the
Depot
greatest
has
day of
been
my
one that people
portfolio
like,
because
Walmart,
my
those
biggest
types of
losers
names.
on my portfolio
We're
are
going
the
to have
ones
you
you're
back,
seeing.
Sarah, and we'll
AMC
regroup and take a look at some
significantly.
of these names.
AMC
And things are looking
significantly
good
on
so far.
Express. So
Sarah
those are the
Henry,
ones
thank
that are
you so
bringing
very
my
much.
portfolio
Portfolio
down, even though
Manager,
it's a
Logan
small
Capital Management. Thank you,
percentage
Sarah.
of my overall portfolio.
Midday Trade is coming up next, right here on the TD Ameritrade Network, and Kevin Hanks is standing by to tell us
I also
what
have
he and his friends will be trading there today. What are you and the experts all trading today?
Which is a exploration.
Hello, Nicole. We have a theme today on the TD Ameritrade Network that is semiconductors and chips. So following in Fast Markets theme, we are going to trade Micron Technology and Qualcomm today on Fast Market. On Midday Trade, sorry.
And so we'll see. It may
Kevin Hanks,
not
looking
pop
forward
just
to
because
that.
it's going
Thank
into
you for joining me here on the watch list,
spring and the
folks. I
summer.
appreciate it very much.
Higher, but
Don't forget,
I don't
5
really
p.m.
see the travel
Eastern
season
Time,
being
market overtime will help you to
back to
focus on
what
what
some
you
people
need to
might
know
want it to be.
for your long-term
It won't be
portfolio.
back to
Have a
2019.
great,
Long
safe
as well.
afternoon. I'm Nicole
We'll be better in
Petalides. Thanks for
2020, obviously,
watching,
but
and I will see
not
you later.
2019. So I think with the oil prices being higher than 2019, mostly
24/7 access to diverse global markets.
Right
here.
Market.
That's why I added stock
I
index
actually
futures to my trading strategy. Now when I see ups and downs coming,
probably settling
I'm ready.
$40 to $50 a barrel.
Well played.
Sometimes similar, I feel about maybe Bitcoin. It's a little bit R-shaped bubble, but spiking. But I think it will go down. So right now it's 57, doing a little bit better than it was this morning. The VIX volatility index is just trending down very, very slowly. Same rate as the market's going up. So usually those work in converse with one another. It's
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com.
And so it's looking good. It's the lowest the VIX has been.
Whether you're an experienced investor
Heck, the lowest has been 3 months. The lowest has been 6 months. This is actually
looking to improve your portfolio management skills.
Surprised that it's
Our
as low
portfolio
as it is.
management webcast series
I don't know. Some people are way smarter when it comes to things like the VIX and how it's calculated. I wouldn't say that we should go lowest, but it's also driven a lot more by down S&P stocks rather than more leverage. Anyway, let's get back to the
Live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
It's 1 o'clock in Chicago. Good afternoon, everyone, and welcome to Midday Trade. I'm your host, Kevin Hinks. I'll be taking you through the next half hour. We're going to stay on our theme from earlier today and look at more in the IT space, in the chips. We're going to cover the two that we haven't covered today on Fast Market, and that is Micron, and we'll look at Qualcomm. So, first and foremost, Alex Golfi will stop by the show to look at the risk-off assets, and then we'll look at Micron Technology, look what they have going on in terms of 5G and why these stocks have sold off and now why they look so attractive. Then Jenny Horn, Ken Rose will stop by the show in the second half to look at our feature stock of the day, and that is Qualcomm. They're also involved big in 5G, and they're also recovering quite strongly today. So a theme today of semiconductor stocks and chip makers. All right, now before we bring in Alex Golfi, let's take a look at the four major indices and see where they sit here at 1 o'clock Chicago time. The S&P 500 up 0.9%, 35 points to 3948. The NASDAQ 100 up 2.2%, 285 points to 13,151. Dow Jones Industrial Average up 0.33%, 104 points to 32,732. And the Russell 2000 down 0.5%.
In some of the action of the equity markets, you see the S&P 500 continues to pile on its gains, as well as the NASDAQ. Let's take a look at some of the risk-off assets here. Looking at the 10-year yield down 5 basis points. So pretty big move here in the 10-year yield as it's down below 1.7. Once again, 1.682. Look at volatility here at 1901. I mean, this is about as low as we've seen volatility since the onset of the pandemic back in February and March of 2020. And so very interesting to see the price action here in volatility. Is volatility now 1901? That's in almost 2 full vol points back below 20 after spending some time last week below 20, bouncing back above it. It is now back below. So we'll watch volatility here as the day goes on, see if we can push into the 18 handle and then maybe even into the 17s. We get back in line more with historical averages for the VIX. Gold market has been quiet for most of the session, very tight range of only about $10 high to low throughout the trading action of today, but it is trading near the highs of the session at 1740.10. It's only down about $1.60 now. So gold weak out the gate, but it's starting to march back towards unchanged. The dollar has basically had the inverse price action of this, Kevin. When you look at the U.S. dollar down about 20 cents right now to 91.73. It's been pretty quiet, tight range, but working its way lower, inverse of what we've seen with gold. Crude oil has been about as quiet as you could ever see crude oil be, with about $1 range and trading right in the middle of that range at 61.56. It's up 12 cents here. Very, very eerily quiet day in crude oil.
Yeah, really strong, powerful day for the NASDAQ 100 today, Alex, and that is dragging up a lot as rate concerns are they're not going away completely, but they're dissipating a little and lightening, and that's giving a little boost to some of these names that we're covering today on today's show. All right, Alex Coffey, always a pleasure. Thank you so much for coming on and talking about the risk-off assets. Okay, let's get to our first stock of the day, and that is Micron. And you know, as we've been going through the day, Alex and I talking about the IT stocks that we've been covering today, it's kind of interesting. Remember, we covered Intel, NVIDIA, and AMD on Fast Market today. Now we're continuing that theme today with Micron and Qualcomm. And if we hit up charts on these IT stocks, it seems that there's one of two chart patterns. They're either trading at or near all-time highs, or they've corrected significantly. And your strategy should reflect that, right? Like, look at Micron and where it's trading. Now, it's only just a couple dollars off of its all-time high, up over $95. It has earnings coming out the end of April 31st. So it has traded similarly to some of the other names in the IT. Like I said, when we hit up Qualcomm, that chart will look different. And so yield concerns have taken some of the premium out of some of these names, right? As yields rallied, these stocks all struggled in this space. So, but if you look at Qualcomm and if you believe in, let's say, the 5G rollout, right? And what's happening with 5G, and if you believe the size and depth of this rollout, Micron's going to benefit from that, right? They're one of the names in there. So remember, 5G phones use DRAMs, right? DRAMs are made by Micron. And not only, and if you look at the chairman of Micron came out with a statement a short time ago, and it said, not only is there more phones being made, right? So that number will go up in terms of 5G, in terms of the DRAMs that they need. How even more important, 5G requires more DRAM than 4G. So it's not only more numbers, but bigger content in those phones. So Micron is going to benefit from all this. And you see that in the price of the stock. Now, like I said, how do you trade both of these? Similarly to what we did in Intel that's had such a big run, we will look at something that gives you an opportunity to be profitable in both directions, right? We don't know. Intel or Micron, with the run it's had, it could keep going, or it could break. And now remember, we're trading ahead of their earnings report at the end of April. So we're going to stay. We didn't have to go to the April monthly, but we can go out one more week before we have to look. So what we did here, we looked at the April 23rd, still 1 week ahead of that April 31st earnings play. And then we're going to do the 100 call calendar and then the 85 put calendar. So, and these are both trading. Now, here's the lovely thing about the double calendar spread. You can do the put, you can do the call side, cost you about $1.23, it looks like. You can just do the put side, costing you about $1.19, or you can combine the two and do both. So very similar to what we did today in Intel, you can do the same idea in Micron. And so if you look at it, if you do this one time, you're collecting almost $11, and that's with this week's expiration. So remember, the first sale in this, I'm sorry, correction. There wasn't enough premium. As I was creating this trade, that's right. There wasn't enough premium in this week's this week's options to make it worth it. So we went out to the April 1st expiration. So it's still a 3-week spread. Remember, April 1st is next Thursday. And it expires next Thursday because the exchange holiday on Good Friday. So next Thursday is when next week's earnings or next week's expiration goes off the board. So we've got April 23rd versus April 1st. The 100 call calendar trading about $1.22. The 85 put calendar trading about $1.19. So if you look at them like that, now you've got an opportunity collecting theta on both. for a move in either direction, and how would you play that? So a really good opportunity to play some of the movement. Now, one thing, we haven't really had to talk about this much, but as you notice, what's happening with VIX and implied volatility across the board, if you put up the chart for Micron, you can see that implied volatility ticking lower the last few days. So you do have some relatively small, but some Vega risk in this. So if you notice that like your back month is going down a little faster than the other one, just watch for moves of implied volatility. That will take a little of the premium out of the calendar spread, right? Because you're long Vega. Implied volatility goes down, overall long Vega positions underperform during that process. So let me go in and we'll do the 100. Well, we'll do 5 of these on both sides. Let's get those ready. Lined up here, 5. We will create duplicate order and we'll buy the call side and we're filled. Go back in, create duplicate order on the put side. Confirm and send. All right, now that one is in and working now to get in our double calendar in Micron. All right, let's take a quick break. Come back with more midday trade. Jenny Horn, Ken Rose joining the show to look at our feature stock of the day, and that is Qualcomm, another player in the 5G space. See you in 2 minutes, everyone, with more midday trade.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Welcome back to Midday Trade, everyone. Kevin Hinks back here for the second half of our show. Now I'd like to bring in a contributor across the TD Ameritrade Network, Miss Jenny Horn, to the show. She's going to look at another name in our theme today. This is another big 5G player, Jenny, but this hasn't traded the same way as Micron. This stock has sold off pretty sharply from its highs as yield concerns have kind of attacked this sector of the market. What do you got for us today in Qualcomm, Jenny?
Yield concerns was just what I was going to talk about, Kevin, because we're actually seeing something sort of unique today where the semiconductor stocks are all up on the day. Qualcomm's actually up over 3%. We're seeing the stocks up over 3%, sort of having an inverse relationship to these Treasury yields with the 10-year and 30-year both sinking about 3%. So kind of interesting you mentioned that because I think it's just interesting the way we can see that divergence today. Now, Qualcomm, like you mentioned, had a pretty strong 2020, not seeing the same strength heading into 2021, but there have been several good catalysts to sort of, move them forward in the long term. One being they've settled a lot of these sort of antitrust lawsuits that were sort of plaguing them back in 2020. So the latest development in this lawsuit was the FTC sued Qualcomm back in 2017. They claimed unlawful tactics to maintain a monopoly on the cell phone chips. And then the U.S. Court of Appeals actually ruled in favor of Qualcomm in 2020, which was, of course, good news to end the year. And then actually in the last few weeks, the FTC has just announced that it's unlikely to actually appeal this case. So this is great news for Qualcomm. This is kind of just like can take a breath and move on, hopefully. But now, I mean, this is not yet reflected so much in the stocks movement this year. Like I mentioned, it's fallen about 14% year to date. It's down three quarters of a percent so far this month. And a lot of this is, of course, due to the chip supply constraints we're seeing. But I think that Apple is partially to blame for creating some headwinds. So Apple's investing in a new German facility called their European Silicon Design Center, really focused on expanding their 5G and wireless capabilities. Now, this is potentially signaling that Apple's looking to make its iPhone modems in-house instead of outsourcing to Qualcomm, similar with what it did to Intel with its M1 chips. Now, the street chatter is, of course, this is all still very speculative and is still in sort of its infant stages, but the street is sort of discussing, if this takes effect, what does this mean for Qualcomm? Will they be punished like an Intel? And you consider the fact that Qualcomm, 20% of its revenue is derived from Apple. So that's concerning. A JP Morgan analyst actually said this could really crush Qualcomm's pricing power. They gave their full year 2022 estimates at about $8.60 a share for Qualcomm. And they're saying if you sort of eliminate this revenue that Qualcomm derives from Apple, that estimate is only about $7 a share. So that's concerning. Of course, this is only expected to take effect in their 2023 Apple iPhones, so still very long term. But I would say, Kevin, the more and more Qualcomm can sort of grow its revenue outside of Apple and outside of, just the supplier and those relationship it has with Apple, I say the better, because I see that being maybe a very long-term headwind that, of course, it's only the rumor, but it does give me some caution.
Yeah, exactly, Jenny. But think about this. If it's 20% of Apple or Qualcomm's revenue, guess what they sold the stock off? About 20%. So they basically discounted that whole price from the price of Qualcomm, which, they tend to do. But, this stock got down having a nice day today, up 3%, up over $4 as we speak. So really interesting turn of events here. But we'll see how this plays out in Qualcomm. Like I said, a different chart pattern than what we just had in Micron and some of the other names we looked at. Jenny Horn, always a pleasure to have you on the show. Thank you so much for spending your Monday with us. Have a great day. All right, now let's go from the fundamentals to the technicals and bring in live from Salt Lake City, Utah, Mr. Ken Rose to the show. He's going to look at some technical analysis on Qualcomm. Ken, nice bounce here off some pretty significant levels, huh?
Right, Kevin. Looking at the chart here for Qualcomm, a couple things that really jump out to you. One is that Qualcomm dropped into this downtrending channel, was moving in that downtrending channel until early last week when it broke out of that channel. Since it's broken out of that channel, though, it's moved in a fairly tight range. The upper part of that range is at about 135.50. The lower part of that range is down at about 128.50. Right now, we have resistance to that 135 level. That was also a support level back in late February. If we were to break out of that 135, 135.50 area, then we'd move up to what is perhaps the most significant price point on the chart at about 141.60, 141.70. This level was a resistance level in early February, as well as a support level in mid-December, as well as the support level in early and also late November. This is also a Fibonacci 61.8 retracement level. So very significant price level there to the upside, again at about 141.60. If we were to move to the downside and break down out the lower part of the channel, in other words, break down below the support level at about 128.59, our next lower support level would be where we found support back on 3.8, which was the 200 period moving average of about $124. I would say if we move down and we break down this area, I'd probably be zooming in a little bit more on the 200 period moving average. It's not going to be at that 124 area, but that very well could be a support level if we break down below this level here at about 128.59. Like those two levels are so close, they could basically be at about the same point in the event the stock pulls back here. Another interesting aspect on this chart is if you look at the volume oscillator, When this stock started to move in that downtrending channel, the volume oscillator was moving down rapidly, meaning that volume was not supporting the move to the downside. Since it's moved up and broken out of the channel, we can see the volume oscillators moved up. So volume is supporting movement to the upside, it's not supporting movement to the downside, which tends to be bullish by nature overall. That's what I'm basically seeing here at this particular point here, Kevin.
Volume giving us a big bit of information there, Ken. But I want to focus on one price. It went all the way back to mid-October and into November, and then just lately, and that is right around, well, I don't want to be too precise here. It looks like around 130, around 129.90 almost, with lots of touches back then in terms of resistance, and it looks like lots of touches in the last week or so around support. Are you seeing anything around that 130 level that we should pay attention to?
Right, Kevin. In fact, the tight range we're in right now is basically the bottom part of that range is sitting right there at about 120, 128, 129. So very close to the 130 level. And I can see what you're talking about when we had that peak going all the way back to September, October as well.
Right. Yeah, exactly. So I just wanted to make sure that that's not a level because, you know, this is one of those stocks that we have, you know, we talk a lot about these. This one is now working its way right into the middle between the 200-day moving average and the 50-day moving average, even though that 50-day is moving towards the 200-day. But, you know, it's amazing. You look at some of these IT stocks, and some of them have, you know, a chart like Micron where it's up just, you know, pennies off the all-time high, and then we get Qualcomm, which is significantly off its high. And like Jenny Horn said, it's discounted almost the entirety of Apple's business on the company. So really interesting. But having a nice day today, up over $4. Ken Rose, always a pleasure to have you on the show, sir. Thank you very much for coming on, spending your Monday with us. Have a great day, sir. All right, now, so much like this morning, when we saw the two different chart patterns for two different kinds of IT stocks, I think the way you got to look at them is different. We gave a strategy where we think that Micron could go in either direction, right, as it leads up to earnings. By the way, Qualcomm's earnings are April 28th after the bell. So, yes, April 28th. So, anyway, looking at that and looking how we'll trade this, we will do something similar to Micron, but we're using something in the calendar spread family, but doing the diagonal, a more pure, little more aggressive, bullish play in Qualcomm. Why? Well, because this stock has corrected 20% off its high, and that's 20% before today's move. Or after today's move, it's still down 20%. So a lot of room on the upside. Ken Rose made that comment about 141.65 is the next level on this stock where it could go if it breaks through or holds this 135 level. Well, so far, as you can see, it's holding the 130. It's gotten now up to 135. I think the way this finishes today and the rest of the week is extremely important. So what we're going to do, again, we're going to go with the April 23rd as our long side. And then we're going to look at the March 26th. That's this week, Friday, right? So there was enough premium in that option this week for us to use the 4-day option on this and not have to go out to April 1st. Of course, if it doesn't get there by this week up towards that 140 level, you can extend duration. And I think it was really interesting how Ken talked about that 141 level. That would be about right here, right about there. So you'd have a nice winner if this moved towards that 141 level. So anything, obviously our strike is 140. We're doing the April 23rd, 135, the March 26th, 140 diagonal on Qualcomm. So, but a move to 141 looking like that would be extremely advantageous for us. Any move towards that 140 strike, even if it were to go slightly past, then you could do one of two things. Remember, you can take the spread off. That's the first choice always when you get a move up towards your strike, or you could extend duration, buy in the 140s, sell next week's, any strike that you want to pick based on the expected move based on your opinion on Qualcomm. But make no mistake, if you get a move up towards 140, the first option that you have on your plate is to just close the trade. You'll have a clear winner on a move up there and close the trade. So you may be cognizant of a little drop off in implied volatility if it starts moving on the upside. So make sure you understand that in terms of what your P&L is. All right, now, as you can see, a 5 lot gets us 178 long deltas, collecting about $21 a day in theta. And remember, here it is, a 5 lot, it's long about $61 in vega. Remember, that's your spread will lose $61 each point in implied volatility comes out. So that is something this time of year and everything we're doing to be cognizant of. What, you're already got, if you look at the chart, you can see what's happened to implied volatility in Qualcomm. It's come way down. So volatilities are still, and you always have to look and make sure. There's the 3-year chart of implied volatility. It's come way down off its highs, but it's still now the 3-year range right in the middle. So now you're at a much more low level in terms of implied volatility, much more easier to start justifying calendar spreads and diagonals. All right, we'll go back to Analyze Trade tab, create a duplicate order, and send that diagonal off in Qualcomm. All right, that's our show for today. Ben Lichtenstein is coming up next with Midday Movers with Ben Lichtenstein. He's coming to us live from the TD Ameritrade studios in downtown Chicago to preview his show. What do you got for us today, Ben?
Hey, Kevin. Trend day up in 3 of the 4 major indices, being led by tech. The NASDAQ's on the move higher, and well, the only one that's negative actually is the Russell. We've got energies, we've got treasuries, which are kind of limited to begin the week, possibly a big week for futures though, but we'll also be taking a look at a couple individual stocks. Kevin, we've got the co-founder of TheoTrade, Don Kaufman, joining us to take a look at Facebook, Google, Apple. We'll dive into Nike as some of the dust settles from last week's earnings, and we've also got his comments on, his thoughts and reaction to Jerome Powell's comments on cryptocurrency. We'll talk Bitcoin with Don as well, and then the chart master is going to join us a little bit later on, and we're talking Pinterest, Tesla, and Applied Materials with him. And then in addition to that, I've got my eye on Tencent Music. Ticker symbol TME is on the move higher and breaking out here today. So lots to keep an eye on here in terms of individual stocks, some futures markets on the move. A good start to a busy week here on Midday Movers, Kevin. Stick around.
All right, that is Ben Lichtenstein coming up next with Midday Movers with Ben Lichtenstein, an old swim lessons alumni, Don Kaufman, joining him for today's show. All right, for everyone, that is today's show for today. Again, Ben Lichtenstein coming up next, then Oliver Rennick will be up next after that with Market on Close. For all of us here at the TD Ameritrade Network, have a great day. Remember, lots of Fed speakers this week, a little data later on in the week. How this market closes today, pretty important. Have a great day, everybody.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads, like calendars and diagonals, are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full options for volatility course and a whole lot more.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Good afternoon, ladies and gentlemen, and welcome to Midday Moves with Lichtenstein. We got 30 minutes of stocks, bonds, ETFs. We got some futures to take a look at. We got a double dose of energy for you here on the TD Ameritrade Network. Let's kick things off and look at the indices. The NASDAQ, first and foremost, is leading the way to the upside. Tech-heavy index is the, best in terms of the leaders today. It's up over 2% here, ladies and gentlemen. We heard from Fed Chair Jerome Powell. Take a look here, ladies and gentlemen, at the Dow Jones Industrial Average, up by 0.4%. Powell held back from discussing economic policy, but, well, the topic of conversation today was crypto. Take a look at the Russell, lower on the day by about 0.5%. We're going to discuss what Fed Chair Jerome Powell had to say with Don Kaufman, the co-founder of TheoTrade. Here's a look at the SPX here to 3950, and, well, we're up on the day by just shy of 1%. Now, with earnings season winding down, there are still a few names to keep an eye on this week. Let's take a look at the calendar in terms of, well, there you can see a couple companies reporting quarterly results that you should be keeping an eye on, potential to move markets here, and certainly a couple that we'll be watching and covering here on the show throughout the week. Let's take a look at the energies, which are, after last week's volatile sell-off, losing some of the energy and some of that momentum to the downside that we had been seeing. Again, the move lower last week down to 58.28, and here you can see on the daily time frame how, well, that retested the 50-day moving average, something to keep an eye on this week, especially if we see that dollar strengthen with rates on the move. And, well, speaking of rates on the move, let's just dive right into the bonds on the left, the 10-year on the right. There's the futures. So, again, as they've been coming off lower, rates have been on the rise. That mirror image of the futures, we're talking yields. And, well, here you can see after coming off last week's low of 153, the bonds are holding right around the 155 handle. 10 years holding right around the middle of the 131 handle. You've got the 30-year, which hasn't really done much today, kind of an inside day today after a big move up on Friday to end the week, and similar situation in terms of the TNX. I have my eye on this 2% level as far as the TNX. We're still holding short of that, but last week up to 1.75%. This week, we do have some economic data that could move markets. Take a look in terms of some of the numbers that you should be keeping an eye on, because if you're watching treasuries, if you're watching rates, if you're watching the indices, and, well, for that matter, the energies, these are the potential market movers that you should be keeping an eye on. New home sales tomorrow, durable goods orders on Wednesday. Jerome Powell is going to be speaking again on Wednesday as well. Also, the jobs report, GDP, ladies and gents, we got a couple data points there, as you can see, that, well, will be on the minds of investors and traders this week. All right, enough futures for now. Let's dive into a couple stocks that are on the move. PepsiCo, ticker symbol PEP, is up on the day. Let's get right in the charts, and I'll fill you on what's behind the move. First, the daily time frame, so you can see the net change and the range that they've been in. We're talking from 130, we'll call it, 128, it looks like, up to 148. And I want to point out how they are higher on the day by about 2.5%. And notice how they've come off that high from the end of December. They found support, though, again, right around that 130 level. I'm keeping a close eye on this one. Today, as you can see, they traded all the way up to 138.20. They were upgraded to overweight from equal weight at Barclays. They announced a price target of 151 for PEP last week. They announced plans, Pepsi that is, to partner with LeBron James to launch
Looks
a
like
new
we're getting
kind of
a little
energy
bit of
drink. The
action
drink's
here from
designed to
Express
provide
here in
a
the
boost with
afternoon.
enhanced mental
That is
clarity
awesome.
and
A little bit of a
immune
run here
support.
to
It's called the
479.
Mountain Dew
It's
Rise
not any
Energy.
longer
If
following a
Pepsi can
similar
add to
trend
these
toward
gains we're
cost and
seeing here
AMC. You know,
today, again,
AMC's
they're up by
still
about
just
2.5%.
dead. I mean,
We can let's get back into
it's
that
not really
daily
doing what it
time
was doing
frame.
on
They can get
Friday,
through
where
this
it just sat around
140, 142
14,
area through the
whatever, but
middle of this
just
range that
zero
they've been in, that opens
volatility
up the
in
door
this.
for a retest to that upper
Crazy.
extreme,
I mean,
and
more so than
again, a
Friday, I
retest to that
suppose, but
149 high. Let's keep an eye on PEP.
just
Higher on the
nuts.
day here by about
I mean, I think
2.5%, but not the
I
only
almost
stock that
want there to
we've
be
got our
volatility.
eye
I
on
either
here
want it
today.
to
I've got
spike,
my eye
obviously,
on a
rip,
couple
or even I want
individual
it to
stocks that are
crash,
on the
because if
move
it crashes, I can
lower.
buy in
Let's take a
more.
look first and
I just
foremost
want
here at
something to happen with
AMC
AMC, and it
Entertainment,
seems like
ticker
every
symbol
single day
AMC, the
there is
daily first and
literally
foremost,
nothing
up something
happening.
like 150 percent in the
Intraday, it's
last 5
crazy what's
weeks.
happening.
Here you can see the intraday
The
time
way it
frame. They're
is.
down right now by
Express, though, I mean, hopefully we'll
11%. I
see
also
some
wanted
movement.
to
I would
take
love
a
to get
look
this thing
at
back up above 5.
next
It's where it belongs.
Expedia, also
Above
down
5.
on the day
It's not
as
belong
well, down by
476 anymore.
2.75%. But both
Down
these
10%
stocks recently
per
coming
day.
off those
Cost down
recent
6%. Tried to
highs.
make
Here
a
you can see
run.
the move lower.
Kind of fizzled
Expedia down
out.
to
GameStop,
172.34.
I don't see
Both AMC
GameStop doing
and
any fire
Expedia are
work
part of
today.
the rotational
But
trade we've been seeing,
tomorrow
with
is
traders
just
getting
going to be
out of a few of these names that have had
GameStop.
strong moves
But
up.
look, we got
Last
over here
week,
a little bit of
from
run.
AMC, they
Right
said
back and beyond.
98% of the
I had
theaters
that up
would
in the
be
corner.
open
It's
as of
making
Friday.
a
These are
little
two
bit run
names to
after
keep an eye
dropping
on
just the day.
this week.
We're
Don't
down
forget, we get earnings
34
from
down to 31,
GameStop as
57.
well, and
And
certainly a
it is
couple names that have
making a
been
run
caught
similar
up
to
in this retail
Express.
frenzy, and a couple
Let's look at
names to
some of
keep
these
an eye on.
others.
That's
Looks
a
like BB.
look at a couple stocks I've got my eye on that I
Nothing.
think you
It's
should
going
as
to look
well.
like
Let's bring
AMC
in
today.
Don Kaufman, the
It's like
co-founder of
Nokia.
EO Trade. He's joining us this
Oh, yeah.
afternoon for a look
Looks
at
up
the
like
view he's
Nokia's
got
chart.
his eye on. Don, good
Just
to
the
have you back.
volume that's
Heard from
small.
Fed Chair Jerome Powell today talking
It's doing
central
all. It's
bank
kind of got,
crypto,
again, similar look
digital
as
currency. He said
AMC
that they're
chart.
highly volatile, therefore
Not a lot of
not really
volume.
useful
It was
stores of
their
value, and
problem.
they're
Their chart
not
looks like
backed by
crap.
anything. Basically, he kind of just said what we've been trying to figure out. Are they?
Let's
What are
look
they
at
tied to?
Naked
And
Brand
he summed it up pretty clearly.
and a.
Yeah, you feel the same way though right now about the U.S. dollar. Listen,
No,
I'm not
it's not
necessarily
making a
like in
comeback.
support of some of
0.85.
some of the
It's just
cryptocurrencies.
backdated.
Nevertheless, I
They
mean, what
down
do we
8%.
expect out of Jerome Powell?
It's
He's
had a
not,
rough
of course,
last
going
couple
to
of
be
weeks when we've
supportive
seen things
of a
like
completely
GameStop,
digital
AMC,
currency
and
unless, of course,
Express
they're running
over the
it,
past 3 weeks.
and you know, in
That is
large
not
part,
what's
there
happening
has to be
over your
regulation
heads.
behind it. You know, this is it's just kind of ironic the
Over
entire
here at Naked
discussion right
Brands,
now around
which does suck because I
cryptocurrency.
still have
You
some.
know, it's
Again,
rise up, of course, of
if you've
millennials,
been on
especially
last week
millennials
and the
that
week
are, you
before,
know, predominantly like
I'm in
electrons
free money
and clean
territory
energy
with
and so
Naked,
forth.
so I don't
And yet we have
really
this
care what it
incredible
does. They could go down to zero, and I still
inefficient
make money
technology
overall.
that
Hold
is
it.
there.
I had
And
in
again,
it back
that's
from
something that
January,
really kind of sticks with me.
but I
As
would
you know,
love
I
to
spent the
see
better
it
part of
spike one
15 years
more time.
inside of the
I'd love to
brokerage
see it get
world,
back up to $2 a
and
share.
you
Of
know,
course,
looking
I'm
at
100 in.
how securities trade,
Some were in
in this
at
marketplace versus how a lot of the
9.
cryptos
I don't
trade
know
and
if
the
they'll get there,
blockchain.
but at least get spike
Again,
one
I'm
day.
not
Let's do.
necessarily
I'd love to
anti-crypto.
break that
I'm really, though,
down
not
a
a
little
huge
bit
advocate of some
and
of the
liquidate these
technology behind it.
101
Yeah,
and
that's going to have to be addressed,
make myself
certainly.
enough
Now, the Fed went on to say that it's more a speculative
$100.
asset than essentially a substitute to
Cost same
gold
way. I'm
rather
in
than
free money
to the
territory, and I've got
dollar.
a couple
And,
of sellers
that's
on
kind
the
of
way.
what we've
I
been seeing
actually
in
did
terms of
put this
gold, which has
over
been
the
coming
last
off as
week. I
crypto's
think
been
it
rallying.
was
Let's move on, though,
30 or
because you got your eye on a
34.9
couple
or
stocks
39. I
you
think
want
it's
to take a look
39.
at with us. Facebook,
So that
Google,
worked out
and
pretty good.
Apple. I saw,
So
well,
I'm
the
super
chairman of the
excited
House
about
Judiciary
costs because they had the great earnings report here. What was the last week? 2 weeks ago, they had a good earnings report. Man, these weeks are flowing together. It might have been three good earnings reports that they had in summer. So I'm excited that it might have some traction here for the next few weeks. Long term, I'm not very happy about costs. I don't think there's going to be a whole lot going on with costs for the long term. Express, I could see Express doing well, similar to cost for a little while through the end of this pandemic surge, and then it's a dog company. I don't think it's going to go anywhere. It'll probably get bought out by Gap or somebody like that. It's a little bit healthier of a company. I could see that happening, which might actually help the stock. Might bring it up to a certain point, and then it'll settle out in the merger at a certain price. AMC, I still love AMC. I still think it's quite honestly a little overpriced right now, but I still like it as a stock. I still think it's a good stock. So we'll see. I would love to get other opinions for it though. If any of you guys have a good opinion about the future of AMC, is it overpriced now just because of the social sentiment? Is it appropriately priced? Is it underpriced? I think long term, I could see AMC being a great, healthy company once again. They're going to have to pivot to accept a little more of the digital streaming side of
content
Apple, what are you seeing there,
However,
Don?
you know,
Well, Apple has done absolutely nothing
they're
since
past the
since
bottom
August.
of
Again,
this
bid up
pandemic
almost
curve,
exclusively on the fact
and
that
if they can
the
survive
bonds are
past the
absolutely
bottom,
lower.
they've
And
got
this is not something that I would
new,
say is dead
new
money, not by
funding
any
sources.
means,
They've got movies
whatsoever.
coming out.
But
They've got
as a trader, you got to ask the
theaters
question,
opening
well,
up
what
in
have you
every
done for
state,
me lately?
including
There's not
California.
even that
So
much
they've got
premium to
a lot of
sell inside of
great
Apple at
things
this
coming
point
for
in
them.
time. So, there's
I
securities
actually
for
feel
me
good
that,
about the
kind of
future of
come in
AMC,
favor. And
but I don't necessarily know if it's worth $12 a share, right? So that's the tricky part with AMC. It could surge up to $20 tomorrow. It could crash down to $5 tomorrow. That's the dice you're rolling with AMC. However, I think AMC will stay in business for a little while. I don't know if Express will stay in business very long. It could die just like Dillard's is dying. Jason Pidden already died. Macy's died. This is a more segmented clothing brand rather than a big box store, but which possibly is worse. But I could see it actually getting bought out and absorbed by a company like Gap or one of those that has multiple kind of mall clothing brands. Let's click back over Tesla here in the corner. See what we're looking at. Tesla, yeah, it's up, not as high as it was its peak. I don't think quite at 700, maybe 698 earlier today. Now it's 690. Still at 5.5%. So still a good day. You know what? It is Nike. What's Nike been doing lately? I think Nike's longer term reaction was to their earnings report. Their initial reaction was bad, which is surprising. But then I think it's mostly because supply chain and looking forward. But it looks like it's up a little bit today. Let's see what it is for the it's down. See, right here was when they released earnings and it dipped significantly. Made a little run, dipped again, and it's kind of hovering right there in the mid 130s. It was at 140s just a few days ago. Let's go back 20 days. See the surge up here before the earnings came out, and then it's just been bad ever since. I mean, Nike's still a great business. They have a lot of good IP. Even if their sales of shoes goes down, they have a lot of IP that still brings their value up. Anyway, I'm going to switch over to it's coming up on 2 o'clock here Central, which will be 3 o'clock Eastern. So we're coming into the final hour. I'm going to switch over to CNBC. Still love CNBC's coverage after the TD trades. They're talking about the Treasury yield. I think Treasury yield going down today has helped a ton, especially in the NASDAQ. That's why you're seeing the overall market up. The overall market right now. We got 1.74 on NASDAQ, 0.52 on the Dow, and 1.04 on S&P. So it is helping immensely across the board. Some of the stocks that are Apple's up 3%, Amazon up 1.5%, which for those two stocks that's significant. Mark's up 2.88. Asana was doing better this morning. Now they're down. I mean, they're still up, but they're down. Overall, overall my portfolio, like I was saying earlier, the biggest dominant portfolio is these that you're seeing on the screen. AMC and Express especially are pretty good holdings of both of those still. They're both kind of in contract. They're bringing down my entire portfolio. Oh man, of course, right when I was about to stop talking, CNBC goes to a commercial break. So this is kind of the downside of CNBC is they go to commercial breaks and we don't get to see the commercials. They just go silent. It'd be nice if they just played like some elevator music or something while they were away. But look at AMC over here. It is slowly ticking up. This is about the last hour. It's gone from 12:05 and then 1:30 is right here to 12:30. So at least we're on a positive trajectory. It's the highest right now that it's been since 11:30 this morning. So man, I mean, let's go, man. If we can have a good last hour and maybe into the after hours, good. We got to keep that treasury yield going down. If we can continue to keep that treasury yield going down, then I think we're going to have an absolutely amazing tomorrow and the next couple of days. I really think we have a really, really good, significant amount of opportunity to have a great week this week because I think the treasury yield's on a bubble and the Dow has withstood that trend quite well. NASDAQ has not, but the NASDAQ is also not down a ton. It's only down 4% from its peak. So, if we have another amazing good day, Treasury yield goes down to 1.5. NASDAQ could spike 2.5%, 3%. And then next thing you know, you're back up to near long all-time highs on the NASDAQ again. So it's very, the markets have been very resilient to these things, even though these uppercuts that come sometimes that drop the NASDAQ 3% in a day, they suck. It's overall been very resilient. And I still think we have a great opportunity to have a positive week this week. So I'm going to shut up for a minute, and I think the news will come right back on any second now. And when it does, we'll watch that, and we'll see how things go through the 2 o'clock hour.
Well, the Dow is on a sprightly little run there, up 164 points. That's about 0.5%. The S&P now clearing the 1% hurdle, and the Nasdaq Composite still hanging in there where it has been for most of the day. The leader by far, up 1.75%. Frank?
All right, Ty. Time now for today's power movers. First up, Canadian Pacific buying Kansas City Southern for $25 billion. This is a cash and shares deal that will create the first rail network that connects the U.S., Mexico, and Canada. The deal values Kansas City Southern at a 23% premium. Canadian Pacific actually down about 3%. Kansas City Southern, it's surging right now, up more than 12%. All right, turning from trains to planes. JetBlue getting hit, down more than 6% right now. The airline planning to raise $650 million through the sale of convertible senior notes due in 2026. This comes as the TSA reports more than 1 million passengers flying on Sunday. And finally, Dollar General climbing more than 4% after a bullish call from Evercore ISI. The firm sees a positive inflection in traffic coming up, maybe tied to recovery. Remember, Dollar General does not have a big online business and now upgrading it to outperform. Now let's get over to Seema Modi for Trading Nation. Hey, Seema.
Frank, we are watching Bitcoin. Fed Chair Jerome Powell making some notable comments on the cryptocurrency this morning. Take a listen.
Crypto assets, they're highly volatile, see Bitcoin, and therefore not really useful as a store of value, and they're not backed by anything. They're more of an asset for speculation.
Bitcoin reversing from its highs of the day on those remarks, now down about 8% from its all-time record made earlier this month. Ari Wald of Oppenheimer, Gina Sanchez of Chantico Global, and Lido Advisors. That's the Trading Nation team today. Gina, this is not the first time the Federal Reserve has made some negative comments around Bitcoin, but I'm curious where you think this takes Bitcoin from here, and is the bigger risk the likelihood of a central bank-backed digital currency?
Well, there's a lot of issues to unpack here. You know, Bitcoin continues to be a digital tulip in the sense that it is very speculative. And I think the biggest challenge to Bitcoin really isn't necessarily the moves of the Fed, but the fact that Bitcoin has been the marginal benefactor of a lot of money printing, a lot of fiscal stimulus, but demand locked up in the pandemic lockdown. As we reopen, I think that's the biggest challenge to Bitcoin going forward. As money moves away from speculative assets, out of the riskier assets, and quite frankly, into goods and services spending, I think Bitcoin's going to get hit.
Ari, from a technical perspective, you've been watching the 50-day moving average. What are some of the key levels to watch?
Well, listen, I mean, we'll find out through time about the long-term viability of this asset, but there is some truth to what Jay Powell says. This is a highly volatile security. I lead in every conversation about Bitcoin is that here's something that can drop 20% like that and still uphold all of its trend lines and support levels and really and leave the trend undisturbed. Take, for instance, just the action last February, made a high of about 58,000. Next day was down to 44,000. Really been volatile and consolidating since then. If you're following the trend, the assumption is that you break to the upside and make that higher high, but you need to be able to stomach that volatility. It's there to stay. With the upside reward comes a lot of volatile day-to-day and even week-to-week action.
Yeah, big price swings on both sides. Good point. Ari and Gina, thank you for joining me today. And we're breaking down Bank of America's bold reopening call on tradingnation.cnbc.com. So be sure to check that out. Tyler and Frank, back to you.
All right, Seema, I'll pick it up. Thank you. And we're coming off a big weekend for college basketball. My bracket there's nothing left of it. It was also a big weekend for sports betting. So how are names like DraftKings benefiting from a betting boom? We will discuss that after the break. Plus, we're watching this market rally pick up some steam. A little sprightliness in the step of the Dow. Up now about 164, 165 points. Technology companies are the giant leaders today, and they're the big ones. Intel, Microsoft, Apple among the winners.
And now, the latest from tradingnation.cnbc.com and a word from our sponsor.
There's a classic investment thesis called the Dow theory. It says that transportation stocks can either confirm or deny a broader market trend. But it's important to remember that transports can be sensitive to changes in oil prices and other market influences. So don't rely exclusively on this theory when making an investment decision. I'm Randy Frederick, and Schwab is the better place for traders.
All right, folks, March Madness is in full swing, and there you see it. I just heard, I believe Iowa went out this afternoon, a number 2 seed to, I believe it was Oregon. Gambling industry expected to rake in more than 2019's record, $8.5 billion in take, with the number of people betting online up more than 200%. The dramatic increase in online betting is thanks to 13 new legal sports betting markets. And our next guest is betting big on DraftKings, naming that company a top pick. It is up almost 20% over the past month. Joining us now is Daniel Adam. He's Loop Capital Senior Vice President. Daniel, welcome. Good to have you with us. Why DraftKings? I think one part of it is that you are banking big on the probability that New York will allow online betting.
Oh, absolutely, Tyler. Thanks for having me as well. So next week is New York's budget deadline, and we expect, just based on the fact that all three budget proposals that are on the table right now, the governors, the senates, and the assemblies, all have some form of legalized sports betting. So we think it's a sure thing that it happens. The question is, in what form will they legalize? We think that the Senate and Assembly versions of the bill are the more likely scenarios to play out. And those are much more favorable for operators like DraftKings.
In how many states now can I use my phone to place a bet?
So for DraftKings, they're currently in 12 states, and it comprises roughly a third of the U.S. population. I think ultimately one would expect that it will be tremendously higher than that. So our market TAM estimate is substantially higher than other analysts on the street. Most analysts have a TAM number out there that's somewhere in the $20 to $25 billion range. Our estimate is closer to 40 billion with upside to that. The fact of the matter is, if you look at New Jersey and extrapolate the GGR per capita, so that's the gaming revenue per capita in the state of New Jersey, which is the most mature market, but still growing astronomically. Just based on that, you can get to a $30 to $40 billion TAM. I think that's what's being underestimated. And so increasingly, we're going to see more states roll out.
Where does DraftKings, relative to its competition that you follow, where does it fit? Is it at the top of your list? Is it in the middle? How is it positioned vis-a-vis the Penn Gamings, the FanDuels, the MGMs?
Yeah, it's a great question. So in just about every market that DraftKings is in, they're the top one or two player. And it's been consistent pretty much since they launched initially in the first few states. What we're seeing is that top segment of market share is being held by the top two or three players. And then from there, everybody else is competing for scraps. And that's why we like DraftKings, because consistently in every market that they launch in, they have been the number one and two player. FanDuel, which is owned by UK traded company Flutter, is the other top one and two player. Penn, on the other hand, which owns a 36% stake in Barstool and has the Barstool Sportsbook app, is only in 3 markets right now, which to us is a bit concerning because they have market access rights that should theoretically put them in more markets than DraftKings is. So 12 states now, and growing.
Because a lot of those states have budget holes they're going to need to fill. We got that one at least for sure. Daniel Adam, thank you very much. We'll see you again soon.
Thank you, Tyler.
All right, thanks a lot, Ty. We're going to give you a final check on the markets at the highs of the session. That's coming up right after the break. Stay with Power Lunch.
All right, let's take you for a final lap around the markets here as we finish off Power Lunch. Stocks are at session highs, as you see there. The industrial's up 0.5%. S&P now up an even 1%. NASDAQ Composite up 1 3/4. It is the likes of Apple, Intel, Microsoft, Cisco, Salesforce. Big tech, Frank, is what has been leading the way today. But remember what Tony Sacconaghi said, top of the show, beware of companies that don't make money. Beware of tech stocks that are selling at above 15 times their revenue. The history there is not good.
Yeah, Ty, one other point that Tony made is that he wasn't as worried about that chip shortage. Intel up 3.74, 3.3%. Another stock we really want to talk about right now is Tesla, up big as we see those bond yields start to retreat from that 1.77 level that we saw last week.
All right, Frank, thanks very much. Good to be with you. Let's toss it over to Closing Bell. Wilfred and Sarah, take it away. It's all yours.
Gentlemen, thank you very much. Welcome to the Closing Bell, everyone. I'm Wilfred Frost, along with Sarah Eisen. Stocks are higher across the board after last week's losses, with the Nasdaq leading today's gains, up around 1.7%, though small caps remain in the red, down 0.5%. Let's have a look at what's driving the action. A familiar story, Treasury yields pulling back, and that's giving a boost to tech names. The FANG names are mostly higher, and Tesla's getting an extra boost on the back of a very bullish new price target from Cathie Wood. More on that in just a moment. There's mixed headlines on the COVID front. The U.S. is now administering about 2.5 million vaccine doses per day. And there's positive news about AstraZeneca's vaccine shot, but cases are rising in 21 states across the country. And we're watching commentary from a slew of Fed speakers ahead of Chair Powell's congressional testimony this week. Richmond Fed President Thomas Barkin, who joined us last week, saying in new comments today that he's hopeful the U.S. is on the brink of completing its recovery. 59 minutes left, Sarah. Mostly green across the screen.
Yeah, big surge in the NASDAQ. Ahead on today's show, a rare interview with Oaktree's Howard Marks. We're going to get his outlook for stocks after last week's pullback and his latest thinking on Bitcoin's rapid rise, among other things. Plus, could Tesla really quadruple in the next 4 years? That's what ARK's Cathie Wood thinks. But is there a road that leads to those lofty returns? We're going to ask Loop Capital's Gene Munster in just a bit. First off, let's focus on the big stories we are watching. 1 hour left of trade. Mike Santoli tracking the market action. Meg Terrell with new details on AstraZeneca's latest vaccine trial. But Mike, start us off with the broader market as we approach 1 year since the COVID bottom.
Yep, tomorrow the anniversary, Sarah. Right today, the index level looks like it's very much on trend and hitting 3950. It's been at or above this level 5 of the last 7 days, not including today. So clearly, it's spending some time up in this higher range. Now today, there are more stocks down than up, and this is one of those days when yields are backing off. It's flattering the S&P because the mega caps are leading, and that's usually been kind of the toggle we've been on for a while right now. So again, at the index level, as long as it stays above, the mid 3,800, it seems like this trend is intact, even if in fact it's had a hard time, making a real run up toward that 4,000 level. Take a look at this comparison of the total return in the 10-year Treasury this time around, the last several months, compared to 2013. That was the year of the taper tantrum. This is from Neil Dutta at Renaissance Macro. Obviously, very much point to point, a similar type move, similar type losses, yields going up back then from about 1.6 up to 3%. This time about 0.5% up to 1.7. It was a faster move then, too. You see it basically reached its lows in terms of bond return right there, only 80 days into that move. Now, what was going on in 2013? Well, the market had a very strong year, and it was also benefiting from rotational action. At the time, I think I came up with the idea, immaculate rotation is what I called it. Back then, it was going from defensive dividend stocks into tech and cyclicals. Right now, it's been mostly about that tech versus cyclicals trade. Take a look here. This is dividend aristocrat stocks. Year-to-date basis, obviously benefiting from the fact that stocks are doing well and people don't really want to own bonds because they seem treacherous, so they're buying other sources of income. Obviously, in green here is the Treasury ETF, so that's losses. In between, trapped in between, are the NASDAQ 100 stocks, which are sort of bond-like but not purely bonds and also don't have the income. So we'll see if this remains kind of the rotational pattern for a while right now, or if, in fact, we're going to break into something new, because I think we've been on this treadmill for a little while, guys.
So on that rotation, today's a growth day over value, which is a bit of a reversal from what we've seen. What's happened to the relative valuation of growth versus value, say, than we were several months ago, where Growth was the huge winner of 2020.
Yeah, growth's premium has come in a fair bit, but the people who are making the case that this is a sustainable move in value and cyclical stocks will point to the fact that value valuations, if you want to look at forward price earnings valuations, as a percentage of growth stock valuations are still not nearly up to where they were on average over the past couple of decades. Now, I could argue the other way and say all that says is that growth stocks got so expensive that, by comparison, value still doesn't look like it's fully valued. So I think that's the argument we're having right now. Can we really expect value to go back to where it used to be trading relative to growth, just because we did see such extreme concentration in some of these expensive tech stocks at the highs, guys?
Mike, thanks so much. At session highs with 55 minutes left of the session. Meantime, shares of AstraZeneca also higher today on the back of encouraging vaccine trial results in the US. Meg Durrell's got the latest on what we've learned. Meg.
Hey, well, so of course this vaccine is available in multiple countries around the world, not yet here in the United States. Here we were waiting for these results from this 30,000 person phase 3 clinical trial, and they came in today ahead of expectations. 79% efficacy for this 2-dose vaccine on the top line in terms of preventing symptomatic disease. They say 100% efficacy against severe disease and hospitalization. They saw 5 cases of severe disease, all in the placebo group in this trial. Importantly, they also said there were no vaccine-related safety concerns identified in the trial, and their oversight board specifically looked for the risk of blood clots, as that has been a concern over in Europe, and they did not find them here in the trial, although some note that that is such a rare event, you might not see it even in a 30,000-person trial. Now, the company says it plans to file for an emergency use authorization in the U.S. in the first half of April, and if it follows the same pattern as we saw for the 3 previous vaccines, it could be about 3 weeks to an FDA decision. We talked with Ruud Dauber, AstraZeneca's president in the United States of their business here, about how they could contribute to this pandemic. Here's what he said.
Despite the good progress we have seen across all vaccine producers, that there is still a need for more vaccines in the United States, but clearly also in the world. So we are thrilled with those results, and hopefully it will help in order to fight against this terrible pandemic.
And in terms of supply, they expect to have 30 million doses immediately ready upon emergency use authorization if they're granted that. 20 million doses could come later that same month, and then a rate of 15 to 20 million doses monthly going forward. And guys, at this point, it could be essentially around May when this could be entering the market. There are already calls from folks like Ashish Jha at Brown saying we should just donate this stockpiled AstraZeneca vaccine because we already will have so much of the other 3. So there will be a debate over how best to use these vaccines. Guys, back over to you.
Meg, this particular vaccine has had quite a few questions thrown at it, whether in Europe or here, and had more hurdles, I guess, put in front of it to overcome before approval is reached. Do today's results answer unequivocally all of those questions? Does it even raise a further question as to why perhaps some of the coverage of this vaccine hadn't been as supportive as for some of the others?
That's a lot of really good questions. I think the reason questions were raised about this vaccine is that the clinical trials were a bit messy. They were hard to interpret. There was a dosing error in the first set of data that we saw that led to 62% efficacy for one dosing regimen and 90% for the other. And so it's just been a little bit harder to interpret these data. This does give that sort of gold standard look at a well-controlled large clinical trial that the U.S. FDA at least wants to see before considering approval. 79% efficacy for these 2 doses of this vaccine. AstraZeneca also notes, though, Wilf, when they space out the doses at a 12-week interval, the efficacy goes up. And so you see 79% for that 4-week interval. Would we see higher if they spaced it further? We'll have to see what the FDA says about considering that.
Meg, thanks so much for that. One does wonder whether damage has already been done to the image of this vaccine in continental Europe, at least, with various poll results on that over the weekend coming out, but hopefully not in the US or the rest of the world. Still to come, bracing for a pullback, technical expert Tom McClellan says he's expecting a scary feeling dip soon, and he's got the charts to back it up. He'll discuss what he's expecting precisely after the break. You're watching Closing Bell on CNBC.
are near session highs as we head into the close. The major averages have had a strong performance so far this year, with the Dow higher by 7%. However, our next guest says the market could soon be in for a rude awakening. Joining us now for more is Tom McClellan from the McClellan Market Report. Tom, good to see you. You've had your share of really good calls on market timing. You are predicting what you say is a scary feeling dip next week. Why? What do you see in the charts?
Well, starting this week, and it actually started last week, and I want to say scary feeling as opposed to scary actually. Hopefully that we can do just a little bit of damage to prices, but a whole lot of damage to people's confidence and get them all thinking that the sky is falling and we're all going to die, so we can get a nice bottom put in terms of sentiment. What I'm seeing, first of all, is a great leading indicator that I have shared with my subscribers for several years. It's based on some really wonky data coming out of the Commitment of Traders report. We look at the net position of the commercial traders of Fed funds futures, which is an interest rate product. And these data about what the commercial traders' positioning is as a group tends to give us about a 5-month leading indication of what the stock market's going to do. It's like the pig going through the python. You can see it making its progress. Well, if there's a fluctuation in the banking system that shows up in those Fed funds futures, it shows up 5 months later in the stock market, and it says that there's a dip coming right now. And by right now, you should understand these are weekly data, so it's not going to tell us exactly to the second. And lasting into the first part of April, we'll probably get all the damage done at the first part of it, and then wallow around in the bottom for a while, getting everybody upset and discouraged, and then should take off like a scalded dog as April unfolds. One other thing that I'm looking at for expecting a correction right now is some work done by my friend Rob Hanna from Quantifiable Edges. He notes that the week after March expiration, which was just last week, that's down 3/4 of the time, 3 times out of 4. So you really have to be fighting hard against seasonal tendencies to get an up week this week.
So when you talk about the market and make a call like this, Tom, are you talking about the S&P 500? Because lately it's been a tale of two markets. There's the NASDAQ and there's the cyclical groups, which you can see in the discrepancy between the Dow and the NASDAQ, which has already had a correction off these higher rates fears. What are you making a call on?
That's very true what you're observing, that lately it's been a lot more different among the major averages. You'll get the Dow going one way and the NASDAQ 100 going the other way, and then they'll flip rolls the next day. Today, the big cap tech is up, but the Russell was down, and breadth is not that great. So it's unusual to see the market getting this kind of differentiated, and it's actually a sign of illiquidity that the limited amount of money that there is to go chasing cannot chase everything all at once. So it goes in very narrow directions. I'm expecting that liquidity to remain with us into early April, that illiquidity. And then it should start roaring back as all of the stimulus goes to work and all the Fed money printing at $150 billion a month continues to go to work. We're just having a normal seasonal interruption. I will note, however, that one factor affecting liquidity is as people start going back to work, going back to restaurants and shopping malls and going out and doing things, that money that they might be spending in the stock market because they got nothing else to do, they got something better to do with it. So that's going to create a little bit of a liquidity drain, but only temporarily.
Tom, you've also been looking at rates, where you expect them to go, and the relationship between rates and gold.
And it's an interesting relationship. People look at them most often coincidentally, and that's how I started looking at it early in my career. But I realized that interest rates get a message from gold. Gold seems to know what's coming well in advance. It knows what grain prices are going to do about 15 months in advance. It knows what interest rates are going to do about a little over 20 months in advance. And so I sent you a chart comparing near-month gold futures prices. Shifted forward in the chart by 20.5 months to show how the same movements that gold prices sees get echoed, the same dance steps get echoed in long-term interest rates. So in that chart is the Treasury yield index, which is the current yield to maturity on the most recently issued 30-year Treasury bond. It echoes the dance steps in gold 20 months later, and gold had a big run up out of its 2018 bottom that interest rates are just now echoing. And the point is that gold had run a lot further from this point that we're echoing now. We're just now to the point where gold was $1,500 an ounce, and you may remember that gold zoomed all the way up to above 2,000. So long-term interest rates have a lot further to go. They're going to peak out initially about mid-May of this year and take a rest break for the rest of the summer, bottoming late August to early September, and then start another big powerful surge upward. So if you haven't refinanced your mortgage already, I feel bad for you, but there is long-term rate hikes are still coming. We're going to get a rest break in May, but it'll only be a temporary one.
It's a really interesting chart. Why do you think it operates at such a lag, 20-month lag?
You're asking the natural human question. We always want to know how everything works and why it works and what makes it work. And that's actually not a necessary question to answer in order for us to use it. People think about, well, correlation is not causation, and it's not about causation. It's about indication. Gold gets the answers first for whatever reason. And as long as you can satisfy yourself that it's a working relationship with a long enough track record, which this one's been working for decades, then you can satisfy yourself that it's okay to use without knowing why it works.
Spoken like a true technical analyst. Tom, thank you. Good to talk to you. Thanks for sharing the charts. Tom McClellan. When we come back, much more on the market when we speak to Oaktree's Howard Marks. We're going to get his thoughts on how stocks have traded since the bottom 1 year ago and where he's looking for returns right now. And speaking of big returns, NFTs have become the latest buzz on Wall Street, the art world, and beyond. But apart from artists and athletes, there's a whole ecosystem that stands to gain. We'll explain next. And as we had to break, check out some of today's top search tickers on CNBC.com. The U.S. 10-year Treasury yield, it's been on top for the past few weeks, followed by Tesla, which is also regularly a part of that list. GameStop, which is down 3.7% ahead of earnings. Kansas City, Southern on some big deal news, also added to that list for a change. We'll be right back here on Closing Bell. S&P up almost a full percent. Welcome back. Dow's up about 170 points. We wanted to draw your attention to some major moves In the Turkish market, check out the iShares Turkey ETF. Trades here down 20% today after Turkish President Erdogan fired his country's top central banker after a brief tenure of less than 5 months. He was the third central bank chief fired in 2 years. The news also sending the Turkish lira, the currency, sharply lower against the U.S. dollar. Well, for this country's been in a currency crisis for the last few years, and it doesn't inspire a lot of confidence when the president continues sacking the head of the central bank. It's just a classic emerging market story, and it's very problematic.
Crisis, as you say, for a number of years, though, had seemed to start to emerge from that after the appointment of the most recent central bank governor. But back to the recent norm, as you said, with the latest moves over the weekend, massive moves there in various Turkish assets, also coming on a day when the dollar is otherwise weak, making it all the more significant. Meantime, graphic artist Beeple, grabbing national attention after his digital NFT artwork was sold at auction this month for nearly $70 million. But apart from artists, there's another group that stands to score from the NFT craze, and Robert Frank has that story for us. Hey, Robert.
Well, NFT trading sites and platforms are racing to become the eBay of NFTs, and they're racing to raise a lot of cash. Vancouver-based Dapper Labs out raising money in a round that could value that company up to $2 billion. Now, they, of course, partner with the NBA for those popular Top Shots video NFTs, and several NBA players are actually among the recent investors. OpenSea, they're the other big NFT platform, just closing a round of funding of over $23 million led by Andreessen Horowitz. That round also including Mark Cuban and Alexis Ohanian. Mark Cuban, also a big backer of Mintable, and then Rarible raising money from a group that includes Coinbase. And then there's Nifty Gateway. They've made the Winklevoss brothers even wealthier. They bought the company in 2019 from its founders, who also happen to be twin brothers. Nifty Gateway now estimated to be valued at over $1 billion. So guys, all these companies capitalizing, raising money from their new investors at a time when the NFT craze does seem to be a craze and just keeps going. I guess Jack Dorsey just sold that tweet of his for $2.9 million.
He did sell it. I was wondering. Robert, thank you. It is a gold rush. Robert Frank, and we're going to talk more about NFTs later in the show. We've got a great guest, CEO of Otoy, the graphics company used by Beeple to help create his digital art, which sold for a cool just about $70 million. We've got a news alert right now on the FTC. Elon Moy with the details. Elon.
Hi, Sarah. President Biden will be nominating Lina Khan to serve on the FTC. She is a noted and vocal critic of big tech, also one of the leading academics on antitrust. Currently, she is a law professor at Columbia Law School, but previously she served on the House Judiciary Committee as one of the counsels and chief architects of that scathing antitrust report that they put out around the big tech firms and what should be done in order to curtail what they say is monopoly power. She also previously worked at the FTC as a legal advisor to Commissioner Rohit Chopra. And she will now face Senate confirmation in order to serve as a commissioner at the FTC. President Biden nominating Lina Khan and perhaps signaling a tough stance against big tech. Guys.
Elon, thanks so much. It'll be an interesting one to watch moving forward. Up next, Leon Black steps back. The Apollo chief abruptly leaving his post in an unexpected move. We've got the details after the break. And later, we'll ask an analyst what he makes of Cathie Wood's new $3,000 price target on Tesla. That's the base case. Even the bear case sees the stock price doubling. As we head to break, here's a check on bonds. Yields moving low today. The 10-year back below 1.7, 168.40 as we stand.
32 minutes left to go. Let's check in on some individual market movers right now. Barclays upgrading PepsiCo to overweight from equal weight. The firm saying the snack company and beverage company is a multi-year stock appreciation story and will accelerate top line and profit delivery long term. That stock up 2.5%. It's down about 7% for the year. And shares of Box also jumping today after Reuters report saying the company is exploring a sale after pressure from Starboard Value. That stock up more than 4%. Wilfred.
Time now for a CNBC News update with Rahel Solomon. Hey, Rahel.
Hi, Wilf. Hello, everyone. Nevada says that consulting firm McKinsey & Company has agreed to pay $45 million for its role in boosting sales of painkillers during the opioid crisis. Nevada says that's several times more than the state would have received if it had accepted a multi-state settlement that was announced last month. Jury selection is nearly finished for Derek Chauvin's trial in the killing of George Floyd. 14 jurors have already been seated, and 1 to 2 more are needed. And for the latest on the trial ahead of next week's opening statements, be sure to watch the news with Shepard Smith tonight at 7 p.m. Eastern. And in Japan, American father and son have been charged with aiding in the escape of former Nissan chairman Carlos Ghosn to Lebanon. Prosecutors have been questioning the pair at a Tokyo detention center since March 2nd. That's when they were extradited from the U.S. Sarah, I'll send it back to you.
Yeah, they were fighting that so hard. They knew what was going to happen over there. Rahel, thank you. Rahel Solomon. Apollo Global Management co-founder Leon Black stepping down as chairman, effective immediately. This comes after Apollo has been battling news of Black's involvement with the late Jeffrey Epstein. We spoke with Leon Black in April of last year. It was the middle of the pandemic, and got a chance to ask him, it was a pretty rare opportunity, about his ties with Epstein. Listen to what he said. I know you sent a company-wide email last year following Jeffrey Epstein's indictment, contextualizing your relationship with him. Has that had any impact on the firm?
I don't believe that has had an impact on the firm. It was a professional relationship that we had. It never involved Apollo, and it really never affected any of our investments or any of our investors or any of the new money that's been raised, which was raised at the greatest clip we've raised since then.
Let's get right to Leslie Picker, who has more on that story. Interesting to listen to those comments, Leslie, from not even a year ago. And
yes.
Speed up to what's happening today.
Yes, but so much, Sarah, to your point, has happened in a year. And it's important to note that Black had been the face of Apollo for the firm's 3 decades of existence, and he's known as one of the founding fathers of the entire private equity industry. So today's announcement means he'll no longer hold any leadership positions. Former SEC head Jay Clayton will replace him as chairman, and co-founder Mark Rowan will take over as CEO. Initially, Black planned to relinquish his role as CEO on or before late July and stay on as chair. That news was tied to the findings from an independent review from the law firm Deckard, which found that Black had paid disgraced financier Epstein more than $150 million for business-related services. The report found no evidence of wrongdoing on Black's part, but the uncertainty had been an overhang for both Apollo's LPs and public market investors. Today's news caused gains of more than 4%, guys.
So what he said there about how it didn't affect Apollo's ability to raise money, didn't affect any of the investments, didn't affect the reputation. Was that wrong, or it was just preliminary because it came before the release of this independent report?
It was preliminary. There was a New York Times report over the early fall time period, which showed how much Black had paid to Jeffrey Epstein for business services. It actually was far less than that report even found out to be. I think it was around the tune of $70 million or something like that in that New York Times report. That's really what started to get LPs a little nervous surrounding their ties to Apollo. Some of them were on record saying that they were pausing commitments to the firm. No one really redeemed that we know of, but there was certainly a little bit of hesitation surrounding the relationship between LPs and Apollo, starting maybe in the second half of the year. As more reporting came out, of course, the actual Deckard report showed a much larger number of money paid to Epstein, showing their business relationship. After that, there was just, a big overhang involving uncertainty with Black and his relationship with the LPs.
And Leslie, clearly this is being framed today as very much a decision by Leon Black. One wonders whether there's been pressure on him internally from some of his senior partners. Though either way, it raises the question as to why this sort of two-stage process over the last couple of months. And I guess we don't have any real firm insight into that.
Yeah, so in the release, he said that the reason he's stepping down has to do with other interests that he has. Also, he notes that he and his wife have health issues that they want to tend to. He wants to spend more time with his family. So that's what he's publicly said on the record. Now, there's a bunch of, rumors and things behind the scenes of various co-founders wanting him out sooner rather than later. That has yet to really come out into the public forum on the record per se, but certainly it's something that caught at least those who follow Apollo closely a bit surprised this morning when that news was announced.
Leslie Picker. Leslie, thank you. Earlier this month on our show, ARC's Cathie Wood teased that her firm would soon be putting out a new forecast for Tesla. Remember this?
About to publish, I'm hoping it's within a week or two, our new forecasts. Our confidence in Tesla has gone up for a number of reasons.
Well, the wait is over, and the call is creating a big move in the stock today. It's up 4 1/3%. We're going to break down that call with Loop's Gene Munster when Closing Bell comes right back. Losing a bit of steam here. The Dow's up 113 points.
Shares of Tesla charging high today after Cathie Wood's ARK Invest said it expects the stock to reach $3,000 a share by 2025. The bullish outlook comes a few weeks after Wood told us that her confidence in the stock had gone up in spite of its recent moves lower. Despite today's pop, the stock is down by nearly 20% in the last couple of months. Let's bring in Gene Munster from Loop Ventures to discuss it all in the outlook. Gene, I'm interested in her base case price target, her bull case, but most of all, her bear case price target, which still envisions more than doubling going forward, $1,500 target for the bear case. Does that concern you that even when someone's bear case suggests so much upside that we're just in crazy territory right now?
Wilfred, it doesn't, because of the size of the transformative market that Tesla's going after. And I think that's an important anchoring place to start. At Loop, we are long-term investors. When we talk about Tesla, we're talking about transformative. I want to caution that trading transformative tech is going to be up and down. Investing in transformative tech is wise, and that is exactly what Kathy is doing. She is laying out this long-term roadmap. And to answer your question, is it 2x bull case? Is it dangerous? I think first and foremost is the market is not fully factoring that in. Yes, the stock is up a little bit today, but there's still a long way to go there. And I think that the 2x base case that she talks about is really just around electrification. That piece alone is a massive opportunity for Tesla. And I think that as you kind of scale that up and think about where they can go, electric cars are a small part, 2 or 3%. We all know that in the future it will be a 100%. And so I think that there is her bear case is, I think, acceptable.
Yeah, so to be clear, it's a 2x bear case, not bull or base case. But so do you agree, Gene, therefore, that there is no circumstance that could lead this stock to be lower, even on the medium to long term? I get we're not talking about over the next week or month, but by 2025, there is absolutely no case in your book either that this could be lower.
Well, there definitely is a case around that. I see your point now, Wilfred, is that I think a bear case should probably factor in something around competition. We still have not seen that. We've been waiting for competition for a long time. The best competition, the Mach-E from Ford now, is delayed until next year. F-150 is coming out. The existing competition from European and the U.S. has been very high end. But that said, Wilfred, as we think out 2 or 3 years, yes, there is a case that something could fracture this. And I think the fracturing, the real fundamental risk to the shares going lower, it's a $650 billion market cap today, much bigger than most other auto companies. The fundamental risk is that eventually competition comes, it squeezes margins. Again, that has been a long and tired road. That story has been long and tired. I don't see it coming. But as I step back and think about, the gives and takes, our view is that, yes, this is still a risky company, as is all transformative tech. And there's appropriate upside around that, too.
What about parts shortages, Gene? I don't know if you saw this weekend, Tesla filed a legal document with a Kentucky court about a supplier, basically asking to take possession of supplier tooling that they deemed critical, and mentioned in that report that they actually had loaned money to the supplier, which maybe is surprising. But do you worry at a time where we already have a global chip shortage, Tesla could face a supply shortage?
That concern, I definitely have that concern, and that's where we go back to our starting point, is transformative tech has many near-term risks to it. In this case, it's the supply chain. What's unique, of course, about Tesla is they are vertically integrated. They are similar to Apple in that they help their suppliers. This is very different than traditional auto. They even do tooling and building of their own parts. And so I think this topic, Sarah, is something that is a near-term negative. It can create some bumpiness in Musk's 50% plus growth rate of deliverables. We could see some sort of pullback based on this. But again, I think that most investors, whether there's some part supply, whether it's what's going on with China and some of the recent news about government officials playing into that, I think those are more transitory in nature. Again, we just anchor that the world is going electric, it is going autonomous. Would encourage people, if you want to see the future of autonomy and be somewhere between horrified and inspired at the same time, there are videos now of Tesla's full self-driving beta that are making it into the wild. You can see that on how these cars are, how these Teslas are operating. at the end of the day, it's not ready for prime time. But again, those are the anchoring themes that I think will keep this company and the valuation moving higher over the long term.
Just finally, Gene, to go back to my prior question, over the long term, 2025, what percentage chance do you assign to the likelihood of Tesla's share price being lower than it is today? Are you saying 0% chance?
No, I wasn't saying that at all, Wilford. What I was saying is that there is a risk around competition. I would say 5 years, I would say there's a 20% chance that it's lower and an 80% chance that it's higher.
Great stuff, Gene. Thanks for joining us. Good to see you.
Thank you.
Straight ahead, a big deal in the railroad space, and Volkswagen makes a push into the US EV market. The Market Zone next.
Less than 12 minutes left in the trading day. We are now in the closing bell market zone. Commercial-free coverage of all the action going into the close. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. And today we've also got Alpha Omega Advisors chief strategist Peter Cecchini back as well. Welcome, Peter. We'll kick it off with the broader market. The Dow, S&P 500, and NASDAQ all higher today. Technology is back in the lead. The S&P is up 0.75%. We've lost a little bit of steam here, Mike. Is it the fact that bond yields are moving the other way that's allowing tech to rally? Did they go too far?
Well, I don't know if they went too far, but they definitely went a long distance in a short period of time. And by a lot of different measures, it seemed like an extreme move, again, in the very short term. So no surprise you'd see some moderation there. No surprise the knee-jerk response is, a bid in growth stocks. Nothing today that's happening seems too decisive in terms of a change in trend, either with bonds or with the sectors that are leading and lagging in the markets. And the overall S&P kind of hovering in this area that we've been for the better part of a couple of weeks. We'll see if it can crack higher. But I don't think that there's any new theme at work. It's going to kind of run the same pattern until it breaks somehow.
Peter, what's your outlook on yields and inflation from here?
Yeah, very much agree with Mike's assessment for today's action. Indecisive. Longer term, I am concerned about yields creeping higher. Really, there are two dynamics at work. I've been concerned about higher yields since election time on the deficit spending that was going to occur. So I was concerned about the supply that was going to be needed to fund that. And more recently, I have become concerned about a combination of factors influencing inflation, both the demand pull as well as cost push. And I think yields could approach 2% if the history is any guide and we get to sort of 2 standard deviations above the very long-term secular downtrend as we did towards the end of 2018.
Investors seeing a $25 billion merger in the railroad industry today. And Frank Collins got the story for us. Frank.
Hey there, Wolf. Canadian Pacific shares down 5% after buying competing rail Kansas City Southern for $25 billion in a cash and stock deal. The big headline here, this creates the first rail network that connects the U.S. to Mexico and Canada. The deal values KSC at a 23% premium and a strong start for rails even before they've hit their COVID comps. U.S. rail traffic up 3% higher year to date. Canadian rails up 6%. Container shipping up double digits for both. Mixed reaction from U.S. rails on this deal. Kansas City Southern up big up on the news, up about 11%. CSX 3% higher. But Union Pacific, the largest West Coast operator, falling more than 2%. Back over to you.
Frank, thanks so much for that. Mike, how does this stack up valuation-wise and more broadly, more medium-term? How have those stocks done that Frank just reviewed for us?
They've done certainly quite well. They're benefiting from the fact that we have high usage of transport capacity in general. Deal obviously makes impeccable industrial logic, which, put these two networks together. And I'm sure the market would love it if it gets approval. There is a decent discount being applied by the market in terms of the implied value of this deal, even with Canadian Pacific shares going down. So maybe there's some uncertainty as to whether it gets done. Final observation is just that, we saw last week the sort of Chubb bid for Hartford Financial, even the regional bank deal, M&T and People's United. It makes sense that some of these value and cyclical sectors where they feel like they have economic tailwinds and trends in their favor are going to start to see if they can consolidate their advantage with these horizontal mergers. So most likely it's going to be a trend.
That's interesting. Peter, do you see that trend continuing? And what do you think it says about where we are in the cycle or broader market theme?
Yeah, I've been favoring cyclicals over technology now for a while, and I think the cyclical trade does have some room to run. How much more room to run, though, I'm not sure. I'm seeing this, surge in growth as being inorganic and, stimulus-driven primarily. And, when I just look back a year and change ago, it really wasn't this healthy environment that so many seem to be referring to. And so I'm not sure once the stimulus makes its way through the economy that it's gangbusters all over again, because I just didn't see the gangbusters before. That said, deal makers make deals, and while there's a window, I would expect that they will continue to do so in cyclical names.
Dow up 98 points right now. Volkswagen making a big push into the U.S. electric vehicle market. Phil LeBeau with the details. Phil.
Sarah, this is an important vehicle for Volkswagen, primarily because, A, it's the first one in the United States, and B, they really haven't done much here in the United States over the last 10, 15 years. So they need this vehicle, the ID.4, which is fully electric, to be successful for them. You might be wondering, well, are they so far behind Tesla that they need to start catching up? they're actually not that far behind Tesla. Look at the global auto sales, the market share in EVs last year. Tesla sold 1 out of every 5 around the world. Volkswagen was number 3rd, 11% market share, catching up very quickly in Europe, by the way. The CEO of Volkswagen USA says he expects the market for EVs to continue to ramp up from here.
These massive shifts, Phil, aren't going to go away. The government, the invest, the environment, plus the American consumer. I see it happening, and I see it happening quicker every year.
One other note about Volkswagen, when we talked to Scott Keel, we asked him about the chip shortage that's hitting all the automakers around the world. He says it's not going to end anytime soon. He said expect this to last at least through the spring, well into the summertime. And guys, that's not surprising given the news that we've heard over the last couple of days from various automakers. And today we heard from Ford curbing some of its production at a couple of its plants. You're going to continue to hear this for several weeks and months.
It's a thread we're going to follow, Phil. Question. I saw the Volkswagen stock there. Clearly, there's a ton of enthusiasm in the market about all of these old school auto companies going huge on EVs and the EV future. Which one are they most excited about of all the legacy players?
Of the legacy players, the two that get the most attention right now, General Motors and Volkswagen. And they both have something in common. They both are doing vertical integration, making the battery packs, combining that along with their production and making massive investments. Both are viewed to have really bright futures when it comes to electric vehicles, and that's why both have moved higher over the last 6 months.
Phil LeBeau, thanks so much for that. Mike Santoli, both have moved higher over the last 6 months, considerably higher. But if you did it comparison to Tesla on earnings multiples or sales multiples, it would still be a monumental gap between the two.
Yes, and it's tough to actually apply that math, although there is a report out there from Deutsche Bank saying that if you were to apply that kind of Tesla or NIO-like valuation to Volkswagen's EV business, then you get a vastly higher valuation for Volkswagen. The issue there is when Volkswagen sells an EV car, they are at least potentially taking away a sale from their internal combustion engine business, right? It's not a zero-sum game, but they obviously have something to lose as well as something to gain. So that's why the market most likely will not, do that one for one. But certainly the idea that there's further upside, especially because Europe is certainly the most receptive developed market for EVs, makes sense to sort of reevaluate whether the market's giving enough credit to Volkswagen on this.
Travel stocks, though, under pressure today. Seema Modi's got the details for us. Hey, Seema.
Yeah, Wilf, on a day where we're seeing value and tech stocks outperform, reopening trades in the travel sector are unwinding. This as we keep a very close eye on Miami, the city declaring a state of emergency over the weekend and a curfew after spring break crowds got out of control. And that's really raised questions about Florida's travel recovery, where we have seen a sharp rise in hotel occupancy over the past few weeks. Miami is currently the highest priced U.S. hotel market, $233 a night versus the national average of $102. And Sarah and Wilf, it's also raising questions about other tourist hotspots here and overseas in Greece and Spain, how to effectively manage large crowds as restrictions lift and more travelers book vacations for this spring, summer, and fall.
Seema, thanks so much for that. Peter, do you think we will see that, a big unleash of spending from consumers in this sort of area?
Yeah, indeed I do, Will. I mean, I'm pretty constructive on GDP growth for this quarter and next. And the savings rate around 13%, even higher now with the new stimulus package. I don't think we'll revert back to the mean of 6% or so, but it's going to be a tremendous release of savings come spring, come summer. And I do think we'll see a pickup in travel, and I think we'll see, as I said, the cyclicals will respond to that, at least in the near term. And interestingly enough, and counterintuitively perhaps, that may pull flows out of the equity markets because I think, as you guys know, I've been somewhat convinced for some time that the rally in the equity markets has been largely a product of that retail bid, and the work from home sort of gambling mentality may fade a little bit when it's time to go on vacation.
It's a trend we will watch. There's the 2-minute mark for the markets. S&P up 0.7%. We've lost a little bit of steam. Still looks like We're going into the close with gains. Mike, what do you see in the internals?
Yeah, actually, internally, the market's a little weaker than it would seem on the surface. Mentioned before, when it's mega cap tech that leads, often the indexes get most of the benefit. The average stock not doing as well. You see advances 1,400 on the New York Stock Exchange, exceeded by decliners of about 1,800. We also have a picture of this sort of back and forth rotational activity we've had between cyclicals and secular growth. Look at software versus energy exploration stocks. These are two ETFs that track it. It's a month-to-date chart. Now, clearly, energy is still beating software. Software's really been hit hard, but they're not as far apart as they were just a couple of weeks ago. So this sort of ebb and flow has been active. The volatility index has also been helpful. Came into the week right around 20. It's declined to 19. That's pretty constructive if this gets into a boring springtime market trend. Not saying it's going to, but downside for the VIX is net bullish at these levels for the stock market, Wolf.
Just under 1 minute left in the session, as Mike and Sarah pointing out, off the session highs, but still green for the three major averages. The Dow's up 109. It was up 180 about 30 minutes ago. The S&P is up 0.7%, and the Nasdaq leads the charge, up 1.2%. The Russell 2000 is, though, in the red, down the best part of 1%. So quite a big divergence there across those major averages. Quite a big divergence on the sectors as well. Within the S&P, tech is up 1.9%. Real estate and consumer staples both up more than 1%, while financials down more than 1%, down 1.3%. Some of the banks down 2 or even 3%. Energy also down the best part of 1%. Dollar a little soft today. Yields slipping a fraction. And as Mike said, the VIX below 20. Gold a little soft, as is oil. At the bell, Sarah, up 0.7% on the S&P 500, 0.3% on the Dow, and 1.2% on the Nasdaq.
Breaking a two-day losing streak, ending with gains. Both the Dow, all three, S&P and NASDAQ. Welcome back, everyone, to Closing Bell. I'm Sarah Eisen, along with Wilfred Frost and Mike Santoli, CNBC senior markets commentator. Take a look at how we finished up the day on Wall Street. Tech led the charge higher on the back of lower Treasury yields. That helped the Dow rally 102 points. Microsoft had the most positive impact on the Dow Jones Industrial Average. It started at the 3 o'clock hour, the final hour of trade. We were up almost 200 points, so lost a bit of steam there. Still closed with a nice gain. S&P 500 up 0.7%, also breaking a two-day losing streak. The SPY, the ETF, tracks the S&P. Apple had the most positive impact, so mega cap tech really worked today. The Nasdaq had a good day, at least if you're bullish, up 1.25%. Off session highs again, but still a strong run for technology after some weakness that we had seen lately. Consumer discretionary, real estate, and communication services were the other big gainers on the S&P. Small caps were the losers, down almost 1%. Energy was weak today. That certainly didn't help. So were financials, bottom performing sector, also potentially weighing on small caps. We'll talk about it in a moment. Coming up, billionaire investor Howard Marks on how he is investing amid the rising rate concerns, and why he is no longer dismissive of Bitcoin. First up, let's talk markets. Peter Cecchini from Alpha Omega Advisors still with us. Marcy McGregor, senior investment strategist at Bank of America, joins the conversation. Welcome, Marcy. First, though, to you, Mike, on the action that stood out to you amid the very split market performance again. Growth worked over value.
Yeah, I mean, bonds got a little bit of a bid. I mean, really very, very modest. We're not talking about a big decline in yields, but they stopped going up and sort of consolidated a little bit. And that creates a little bit of buying in the very bond-like stocks that run the NASDAQ, like Apple and Microsoft, both up something like 2.5% on the day. So to me, there's not a whole lot of a macro message coming out of this market today, although I do think you wonder if you see the weakness in the small caps, the weakness in travel. People are just trying to digest and reassess exactly how quickly we're going to accelerate fast into this expected boom time, or whatever we think is going to happen GDP for the rest of the year. So market's well protected so far with this rotational action, but it has not really shown that kind of fresh burst of energy that's going to get it up toward 4,000 on the S&P just yet.
Marcy, we've seen cyclicals perform very well of late. Are they a bit overstretched in the short term?
No, I think what you're seeing obviously today was a bit of a reversal in this nearer term rotation, but our view is this consolidation has been a rotational move, not an indication of a big top or that we're late cycle or anything like that. Tech has just been the source of funding. And I think we're seeing it bounce back a little bit. I've been thinking a lot with tomorrow is the 1-year anniversary of the market lows of 2020, how different year one of a bull market is versus year two. We've bounced almost 75% off of the lows from late March of last year, when everybody was asking, well, what is the market looking at? Is the market totally disconnected from the economy? Now we're starting year two. Year two tends to be a little more frustrating for investors. The narrative is clear. There's consensus on the recovery, but markets don't move in a straight line. And I think we have to remember that as investors. But I think this rotation continues by sector, by size, by style, and by geography as markets grind higher over the course of this year, albeit maybe with a bit more volatility.
By size, Marcy, wanted to pick up on that call because I believe you're a fan of small caps, which underperformed today, closing down almost 1% and have been a little bit weaker lately, though they are up the most of all of the 4 big averages from that March low a year ago, up 135%. Still a buy?
Yeah, so I would still buy on weakness in small caps. We're overweight both large and small in the U.S. right now. I think there's 3 C's driving this market. The consumer, they've got fuel in their tank, stimulus, savings, and they're not waiting for the economy to reopen. You know, despite the weakness in travel stocks today, TSA checkpoint crossings are up, restaurant reservations are up. The second one, though, is CapEx, and that's where I think you're going to see the small cap as the beneficiaries. Strong PMIs, rising commodity prices, but don't forget about tech because long-term business spending plans focus on cybersecurity, data, the cloud. And then finally, I think you have to remember the yield curve is steepening. That's pointing to an accommodative Fed. I think that's positive for a lot of sectors as well. Financials, materials, energy, but don't forget those semiconductors. So I would continue to like small cap. I'd be buyers on the weakness. And broadly, I'd be buyers on market weakness right now because, like I said, I don't think this is the top of the market.
Peter, clearly the last few years, arguably even the last decade, has been driven more by momentum than valuations. Will that be the defining factor of the next decade, do you think?
Well, it's certainly hard to say, Wilf, but I think one of the defining factors has been, again, this secular trend in interest rates and yields. It's been 3+ decades. And, you know, for example, right now, the steepening that's happening in the yield curve, which normally at this point in the cycle would actually be a bull steepening, meaning short rates would be falling as the Fed continued to cut. The steepening now is happening because long yields are rising, and that means financial conditions are actually tightening. And so whereas we would normally see, let's say, 3 months to 10-year yields, we'd see that spread widen to 350 basis points. I don't think that's going to happen this time. I don't think the banks are going to see that kind of steep yield curve tailwind that they normally see. And let's stack a few other things alongside that. The Fed simply can't cut anymore. We're at the zero bound. So there's some very big differences, I think, this cycle from any other cycle we've seen. Not the least of which is massive stimulus, which again is temporary. It'll take some time to make its way through the economy. But once that goes away, I think the picture's a bit murkier than many others do.
We've got a news alert here on energy industry executives meeting with the White House officials. Kayla Tausche has the details. Kayla.
Well, Sarah, we've learned that the White House is holding a meeting with top executives from the oil, gas, and mining sectors. That is happening today, according to attendees at this meeting. We are still awaiting a confirmed list of attendees. The White House declined to comment on exactly who is attending or who is representing the Biden administration at this meeting. But we know that Gina McCarthy, who's the White House's national climate advisor, has been engaging and liaising with industry on this issue in advance of the rollout of an expected infrastructure and climate package at some point in the coming weeks. The New York Times reports that top officials advising President Biden are set to recommend north of $3 trillion in a series of proposals related to infrastructure and climate, perhaps as soon as this week. So we are still waiting word on exactly what is on the table for this discussion and who exactly is attending. But based on the information that we obtained about this meeting in advance of it, the attendees were expected to include top executives from BP, Chevron,
Exxon, BHP, Total, and more. So certainly the White House is trying to engage the oil and gas industry, which may start to back some of these measures, like a potential tax on carbon emissions, as a way to try to quantify and make finite any potential charges on emissions going forward. But we will wait and see exactly how this discussion pans out. But certainly interesting to note ahead of the rollout of this package that the White House is trying to engage oil, gas, and mining executives on these very issues. Sarah and Wilf.
Kayla, thanks very much for that. Looking forward to hearing more details as and when they emerge. Meantime, existing home sales falling sharply last month. Diana Olick has that story for us. Hi, Diana.
Hi, Wilfred. Yeah, the drop was larger than expected. Sales falling just over 6.5% in February compared with January. But it is not for lack of demand. It's all about supply. The inventory of homes for sale plummeted 29.5% from a year ago. That is the largest drop on record. Potential sellers are just not wanting people to come through their homes. They're not listing. And of course, they're worried that they won't find something else for themselves to buy. The supply crunch pushed February's median sale price to $313,000, a record for the month. And the reason we know it's not prices pushing people away is sales of homes at the low end, priced between $100,000 and $250,000, were down 11% from a year ago, while sales of $1 million plus homes were up over 80%. Wilfred.
Diana, thank you very much for that. Peter, I'll come to you in terms of your outlook here for, I guess we've talked about rates specifically, but the impact it can have on the housing market and that supply-demand dynamic that Diana was touching on.
Well, I think it's also important to note that mortgage applications also fell off significantly on the bump in rates. And, you know, that's, as goes the entire economy, it's very sensitive to the rate environment right now. And with a tick up in rates, it's no surprise that mortgage applications fell quite a bit. And I think that bifurcation between low-end and high-end buyers also shows you that, you know, sort of the income inequality and the wealth inequality that we're seeing is also at play to a large extent, whereas wealthier people haven't quite been affected as badly by this pandemic. They can still afford to buy homes at low rates, and they were less likely to have lost their jobs than lower wage earners. So the housing market is certainly just as complex as the rest of this picture.
Peter and Marcy, we'll have to leave it there today. Thanks so much for joining us.
Thank you.
Up next, billionaire investor Howard Marks on the risk of rising rates and where he's finding opportunities as yields do move higher. Plus, we'll discuss the red-hot NFT market with the CEO of a company whose graphic technology was used by Beeple to create the artwork that recently sold for $70 million at Christie's. We're back in 90 seconds. Welcome back. Tomorrow marks 1 year since the market's pandemic lows. Stocks bouncing back after a year of uncertainty, and some Wall Street firms growing more bullish on the U.S. economy this year. Bank of America and Goldman Sachs recently raised their GDP forecast to 6.5% and 6.8% respectively. Let's talk more about the outlook for the economy, for markets, and everything, really. Oak Tree Capital's co-founder and co-chairman Howard Marks joins us now in a First on CNBC interview. Howard, great to see you. Thanks for joining us.
Nice to see you, Wilfred.
I wanted to start on that topic of the economic outlook, having read your most recent note, because I guess you're very positive that the economic recovery will be strong, but not just this year, that we are, in fact, at the start of a new economic cycle as opposed to the tail end of the last one.
Well, I would take issue with your word positive. I'm never positive about anything. But you know, I believe that you know, we expect that there will be a recession once in a while. I believe last year's recession was that recession for that cycle, and that we have commenced a new upcycle. It's not 100% sure of that, but I believe so. And I think things look positive. The trends in income are very good. People are going back to work, and I believe that you'll see strong spending this year. But you know, savings have been at a very high rate, and I think that the savings and rising income will buoy us in the certainly the few years to come.
And of course, the question that follows is whether markets are already pricing in that economic positivity, and you're kind of torn on that overall.
Well, I think they are pricing in the economic positivity. It's very unusual to have the market at a high level, and certainly you couldn't say that this isn't at a high level at the same time that a recovery is getting going. Usually, high levels on stocks coincide with high levels on the economy.
So, Howard, it's Sarah. What sector, if any, what part of the market offers the most opportunity right now?
I think that the most opportunity is always found in the things that other people are ignoring. And I think that what they call value, although I differ a little with the terminology, but you know, out of favor, lower valuations, you know, the sectors that were hurt by the pandemic and where the stocks reflected the pain from the pandemic, sometimes to excess. If you can find companies that have been penalized for their difficulties in the pandemic, and the penalty was overdone, and the difficulties are temporary, I think that's a good sector right now. Although, you know, after being trounced thoroughly by tech last year, so-called value and cyclicals have had something of a rebound already this year.
Yeah, I mean, on a related note, I was going to ask you, you're known for distressed investing, and I'm curious what that is right now, and whether there is distressed opportunities where everything gets bailed out.
Well, you're right to ask. It's a tough question to answer. I mean, right now, one way I put it is that any company that has difficulties in this environment deserves to be distressed. You know, the bailouts have been generous, the liquidity has been rife, and you know, the default rate in 2020, which was predicted to get into middle teens, didn't even reach half that. So there are always some people who find it easier to raise capital than others, and those are the ones we're emphasizing at this time. But there's not widespread distress, to be sure.
Howard, one of the theories that gets discussed a lot, of course, of late is that rising rates will hit big cap tech and the highest PE stocks more than others. Part of the thinking behind that, of course, is standard valuation models, discounted cash flow valuation models, though those models haven't really been the dominant factor of market performance over the last couple of years. Is it possible that that will be the same going forward, and therefore fears over rising rates as it applies to high PE stocks is overdone?
Well, I think the analogy between high PE, between growth stocks and bonds is appropriate. You know, long bonds react more to a change in interest rates than short bonds. And I think that growth stocks, where more of the story is in the distant future, will react more strongly to interest rates. But on the other hand, to the extent that the rising rates connote a strong economy, with all equities, that's an offset. And I think that is what's going on. The fear is of an overheated economy that produces inflation and thus calls for higher interest rates. I think that the great tech stocks, the great growth stocks, can offset inflation through their growth. But you have to pick the right ones. It's not my business. I'm not. Oaktree doesn't invest much in the equities market, mainstream equities market, but that would be the goal.
As you mentioned, there's been so much stimulus flowing into the system. Howard, do you worry at all about the effect of higher taxes, which are likely to come with the next big package that the Biden administration is passing, and what that could do, what kind of impact it would have on the economy and the markets?
Well, of course, it depends on the shape, but I don't think, look, lower taxes are always more stimulative and conducive to economic growth than high taxes. I don't think that the things under discussion are so draconian as to change the outlook very much. The big increase on the personal side that they're talking to is wealthy taxpayers, and wealthy taxpayers have so much excess income that I don't think a couple of point rate will change that much.
Howard, wanted to ask you about Bitcoin. It seems from some comments you made relatively recently to a publication in Asia that you're changing your mind on Bitcoin. Is that fair?
I'm opening my mind on Bitcoin, Wilfred. One of the things that came out of the pandemic is I got to spend several months living with my son, who's also an investor, and of course he's 2 generations younger than me, and we came to the joint conclusion, I had a little help in this regard, that my initial reaction to Bitcoin, which was very negative in 2017, was too much the product of my inherent skepticism and conservatism, and the success I've had in the past with skepticism of innovation, and how many times I've seen financial innovations fail to live up to expectations. I think I was, as we said, knee-jerk skeptical. And while Bitcoin doesn't have an intrinsic value, the same can be said of the dollar and many, many other things that have value, like paintings and diamonds. And I've been more sensitized to the supply-demand case, which says that the supply is finite and the demand will grow with a positive impact on price. So I haven't reached a conclusion, and I still don't consider myself informed enough to have an opinion, certainly to express it publicly. I would just describe myself as more open-minded, hopefully on many things, than I was in the past.
So it sounds like Oaktree doesn't have exposure there. Do you think it's prudent for a company like a public company like Tesla to buy $1.5 billion worth, put on the balance sheet?
No, again, that's beyond my competence. Certainly Oaktree has no involvement.
Howard, wanted to ask your view on a sort of traditional portfolio of 60-40 or whatever the percentage split is of equities and bonds. As we look at the sort of 5 to 10 year outlook ahead, is the traditional thought process behind that and how it might balance out the risk going forward weaker than it's ever been before, given where both equities and rates are at the moment?
That's a great question, Wilfred. Most of my clients are institutions, pension funds, endowments, sovereign wealth funds, et cetera. Certainly pension funds, defined benefit pension funds and endowments need a certain return, and for the most part, that's in the region of 6 or 7% in order to make the math work. And the old 60-40, 60% equities, 40% bonds, nobody would expect that today, I don't think, to fulfill that requirement of 6 to 7. In fact, bonds may be fairly valued relative to stocks, but with yields of 1, 2, 3%, it's hard to justify inclusion in portfolios, I think. nobody thinks they're going to get the returns they need in the institutional realm just from stocks and bonds. So again, you would have to add in alternative investments in order to get up to the levels required. So that means the 60-40 itself is not enough. The one, I've always included a passive benchmark like 60-40 or maybe 70-30, where I was on investment committees at nonprofits, because it gives you an idea. I mean, it's not a good benchmark for whether you pick the right managers or pick the right asset class. It just gives you an idea of whether you did better than you could have done in the most passive of portfolios. And when you look at it after 10 years, I think it's very informative.
Howard Marks, always good to get a window into how you're thinking about the world, the markets. Thank you for joining us.
Good to be here. Pleasure, Sarah. Bye-bye.
Bye-bye. Up next, Mike Santoli looking at the recent weakness in emerging markets. That index, whether there could be more pain ahead. We already spotlighted the Turkish lira cratering today. Plus, help is on the way. That's the message from Goldman Sachs to its junior bankers who say they've gotten burned out from massive workload. Details on that latest twist when Closing Bell comes right back. Welcome back. News alert now on a big pandemic winner preparing to go public. Leslie Picker with some details on Coursera. Leslie.
Hey, Sarah, getting closer to that public debut, setting terms for its IPO just moments ago. That starts its roadshow process where it'll engage in discussions with investors and determine a final price. But for those discussions, Coursera, which is an online education platform, they plan to offer 15.7 million shares at $30 to $33 each. That's according to an SEC filing. Doing some math here, that equates to about $519 million for its offering size at the high end of that range, implying a valuation of over $4 billion if it were indeed to price at the high end of the range it plans to market. Now, interestingly, in this prospectus, it says that Bailey Gifford and Capital Research have agreed to buy $125 million at the IPO price, so therefore kind of serving as an anchor investor, two anchor investors for this deal. Coursera plans to list on the NASDAQ stock market under the symbol COUR. Wilf?
It's been a hot area of late. Leslie, thank you. Let's get up to Mike now for a look at emerging markets and how they've been performing of late. Mike.
Yeah, well, as a group, they actually had been performing very well based on the 2-year scale here. They've just about caught up to the S&P 500 before this quick little setback. Now, a couple things going on. First of all, a lot of tech exposure in the emerging markets indexes. And then also, obviously, rates going up, Treasury yields rising, also the dollar bouncing has acted as a little bit of a headwind. There has been a pretty good correlation between rising yields and weakness in emerging markets, but also it had become a hot trade. Take a look at the flows into emerging markets funds globally. This is a cumulative number. So basically, it nets out all inflows and outflows over the course of this time, 20 years or so from Credit Suisse. You see here, we're back at a peak level of cumulative flows. So obviously, it's not a monthly flow number, but definitely tells you that this was a consensus trade, kind of an arm of the value and cyclical trade, even though there is a lot of tech in the EM index. So we'll see if it's just a cooling off period or something like more of a setback as we move along, see what yields do, guys.
And Mike, I guess I wonder also what vaccine rollout progress will do to these sorts of index. Also, perhaps Europe versus, say, UK and US in the rest of this year.
Yes, absolutely. That's another one of these sort of toggles that we're going to have to watch. Clearly, global growth estimates are still going up right now. It seems that people aren't revising down their GDP outlooks, but that certainly could be in the future if we do have a little bit of fits and starts in terms of that vaccine rollout.
Okay, Mike, thanks so much for that. The dollar, of course, as Mike was saying, has been an important factor to this. It's been a bit of a bounce back year to date, at least for the dollar. It's up, 2% or so, the broader DXY. We have some breaking news on the Federal Reserve. Steve Leisman's got it for us. Steve.
Wolf, thanks very much. In testimony tomorrow before Congress, Fed Chair Jay Powell will say the Fed will provide support to the economy as long as it takes. He does hope for a return to more normal conditions, quote, later this year. It gets a little optimistic here. It says economic activity and employment have both turned up recently, echoing some comments that he made last week. And the recovery is both quicker than expected and, quote, looks to be strengthening. He said the situation is improved and the worst was avoided by swift and vigorous action from both Congress and the Federal Reserve. He had a lot of praise for the fiscal policies that have been enacted so far. Recovery, he says, though, is far from complete. The 6.2% unemployment rate, he says, underestimates the shortfall in labor market. So, Wolf, there you go. The testimony tomorrow. He'll be sitting with appearing at the same time as Treasury Secretary Janet Yellen for this mandated testimony when it comes to the CARES Act spending.
And I guess, Steve, we'll be watching the reaction in the bond market first and foremost. He pretty much answered all the questions on that from you and other reporters in the news conference last week when he said, we're not too worried about it, and doesn't seem like he's going to do anything. Is there anything that could change that? What will you be listening for tomorrow?
Well, all of those things that you say, he could change his answers anytime. He's a little bit more upbeat in this characterization of the economy here. I hadn't heard him say, maybe he had, but the idea of returning to normal later this year. Any hint at all that things might be moved up? As you know, Sarah, the market has moved up its estimate for when the first rate hike comes, and we had a NABE survey this morning that had a lot of folks 70 or 80% in really ahead of where the Fed is right now. So there is that dissonance, but it is a year out or a year and a half out. So there's time for both the Fed and the market to align here. But the question becomes whether or not this year is the announcement for whether or not they reduce the quantitative easing that's out there right now. So far, I think even Barkin said today that he had not seen the preconditions met for a taper of the quantitative easing. So we'll wait to see if Powell also agrees with that and doubles down on his comments regarding that.
Steve Leisman, thanks so much. $69 million. That's how much this NFT artwork from Beeple recently sold for at Christie's. Up next, the CEO of graphics technology company Atoy, which Beeple used to create that piece of art, on whether the NFT craze is more than just a fad. We're back in a couple minutes.
Well, you may recognize this artwork. It's the NFT created by the artist Beeple, fetching nearly $70 million at auction earlier this month. What you might not know about is the technology used to help create the piece. Otoy is a cloud graphics company and a leading platform used by digital artists to create NFTs. It's also known for powering the visual effects behind some of Hollywood's biggest movies and shows, including HBO's Westworld and the Netflix hit The Crown. Joining us now is Jules Urbach. He's the founder and CEO of Otoy. Jules, thanks for joining us. Explain exactly what you do.
So Otoy's background is in visual effects and even video games. And we've been bringing artists and content creators tools for over a decade, whether they're small artists, individual artists that are graduating into motion graphics, or the big studios like Disney. We've been giving them the tools to make CG and beautiful content, at speeds that are 10 to 100 times faster than you could do a decade ago. And that has also led to the creation of a lot of art like Beeple's that allowed him to do every day. He would do a new piece of art every single day with our software, post it on Instagram. And that really led to that giant piece of artwork that sold at Christie's for $70 million.
But how is it really worth $70 million?
Well, I think like all art, it's in the eye of the beholder. And what you have with digital art and NFTs is you have a contract between the artist that created the piece and the collector that's buying it. And because the blockchain itself is as immutable, really, as atoms and matter, right? The concept of having the artist give you that art is what's valuable. And I think there's a generation of collectors and artists that recognize that value. And I don't think it's going to go away. I think it's only going to get bigger because it's easier in some ways to prove that you own a piece of art, where it came from, how it was traded, than it ever has been in the physical world.
When you provide, Jules, these services to people like Beeple, is it a fee for service that he pays to use your software, or do you have a percentage exposure to the pieces of art that he creates?
We have a pretty simple model, $20 a month, a little bit like Adobe's Photoshop, and artists get all of our tools. When they're actually using our software to render on the blockchain, which is part of how you authenticate that your NFT was created, with our tools by the author, that's something that we take about a 5% transaction fee on. But for the most part, most artists are paying that $20 a month. Most recently, though, we put the entire software suite on the App Store, and Apple featured that, and it was the #1 app. So we imagine that we're testing the waters with a free version that would be powered entirely by usage fees. And with Apple's featuring of our app, we've seen a huge influx of artists come on board our tools just this month.
So forgive me for following up. Did you get a cut of Beeple's $69 million or not?
No. That went off to Beeple, and that's how it should be. I mean, we're providing the tools and the software to create it. And should future NFTs, though, that are rendered on the blockchain entirely, and these are a whole new class of NFTs that Beeple and I have been working towards for months, then we would get that 5% fee. But we're not at that point yet. And this is the Wild West of NFTs. We're in the Napster days. So there's a lot still to be done, and we see our role in that expanding as that progresses.
Well, so you call it the Napster days. That's sort of where I wanted to go, Jules. A lot of people think this is a massive bubble fueled by speculation. It's going to end really badly. And a lot of people think this is the future and like the early days of the internet. How sustainable do you think it is? From your vantage point, where does this go?
So I think there's a lot of bad stuff that could be happening in the NFT space that is just not legitimate. I mean, we had an artist that created a piece of work. It was taken from his website, resold as an NFT for $2K. But for verified art and top artists and authentic creators like Beeple, Pack, who also uses our software and is going on Sotheby's shortly, there is a huge future, and that's not going away. So I think that as I said, it's sort of in the Napster days. There's a lot of cleaning up to do, but I think that will happen quickly, and I feel that the future is huge for NFTs. It's going to be bigger, I think, than anything that sort of happened in the physical world before for art. That's where I see it heading.
Jules, going back to what your business was founded on and what you did before NFTs in terms of graphics and stuff for movie studios and the like, how fast are the advancements being made there such that we could be in a place soon where entire movies and TV shows are produced via software like yours as opposed to filming it? Are we about to be defunct in the TV presenting business?
No, I'm sure actors and performers will always have a role, as they do even in CG films. And I think that even deep fakes, which are a problem, there's something that just doesn't feel real about them. And so the authentic artistry that goes into a film or into a performance is really important. We do have entire productions, though, that are done in our software. The 2-minute title sequence of Ant-Man the Wasp was rendered in our software. We have films and CG that's done in our tools. And we have Disney and HBO as investors. And in the case of HBO and Warner Brothers, we did an entire CG authentic version of the Batcave and the animated series, which is something that is also rendered on the blockchain. So I think that the future that studios are looking to us for providing is a combination of how can we tap into the NFT space, how can we do films for a lot cheaper and with a lot fewer artists, but also provide an authentic piece of media and art. And also there's a whole future for AR, VR, holographic displays that's coming this decade, and we're preparing everyone for that through our tools.
Jules, we'll have you back on. There's so much to talk about here. It's really exciting. Thank you for joining us, though, for now.
My pleasure. Thank you. Thank you.
GameStop has been at the core of the retail trading revolution, and that's helped the stock skyrocket, more than 900% this year. We're going to take a look at what investors should expect when the company reports earnings tomorrow, whether the results could spell trouble for the stock. And as we head to break, take a look at shares of Viacom CBS, which are falling after the company just announced a secondary stock offering. A lot of people expected this, as it has been a very, very strong mover, falling 3% after hours. We'll be right back.
Welcome back. Time for a CNBC News update with Rahel Solomon. Hey, Rahel.
Hi, Wolf. Hello, everyone. The House of Representatives holding a hearing on making Washington, D.C. the 51st state. Outside of Capitol Hill, demonstrators marched in support of the move. Now, while D.C. statehood has significant support in the House, it would need a 60-vote majority to pass in the Senate. Arkansas lawmakers have become the latest to approve a ban on transgender girls and women students competing on female sports teams. Republicans in at least 20 states have been pushing for similar bans this year. The NFL plans to have fans at its big draft event, scheduled to start April 29th in Cleveland at several locations around the city. The specific number of fans, though, to be allowed has yet to be determined. And an NBA legend of the 1960s has died. Elgin Baylor's revolutionary jump shots helped transform the game from a ground-bound sport into an air show. Baylor was an 11-time NBA All-Star with the Lakers and was the first person to score more than 70 points in a game. Elgin Baylor has died at the age of 8.
Here, let's turn the volume down. Oh man, I just looked over there. Lost Elgin Baylor. That's tough. I mean, I'm a huge basketball fan. Yeah, that's tough. Obviously, got basketball stuff up here. So yeah, Elgin Baylor's an absolute legend. Look at this. What are they talking about? Of course, they go to a commercial break. They're probably going to come back, leaving you guys on a cliffhanger. So what they're probably going to talk about is not just how GameStop performed today, but more so that tomorrow is the earnings report for GameStop. It's the first earnings report we have seen since this whole fiasco started back in late January. So I guess that means their last earnings report must have been in December, probably 3 months ago now, probably late December, around Christmas time, give or take a few days. At that time, GameStop was looking healthy. I mean, by some measures, healthy. It was going up and had been slowly going up for the past couple of months. I think there was a little bit of online vibe about it. I mean, our friend Roaring Kitty or DFB had his thing going for 6 months, a year maybe since then, and was doing really good. So there were some people that had some sort of sentiment about what was happening with GameStop, but not even close to what was happening in late January. So I'd be curious to know if some of the executives and the finance professionals and of course the analysts knew that maybe this was not that this spike was going to happen, this short squeeze was going to happen, but that something was going on online with retail traders in Reddit or Twitch or Discord, whatever it may be, related to their stock. I don't know how aware they may have been at the last earnings meeting, the last quarterly meeting back in December. So this one, obviously they are aware. Not only are they obviously aware, but there's been a congressional hearing about it. It's been all over the news. Their stock has gone up, 10x probably since that last meeting. There's a lot to talk about, I think, in the GameStop quarterly meeting tomorrow. Not just their normal, hey, here's what our earnings, we lost a boatload of money. Sorry, guys, we're going to do better next quarter. I don't think that's really it. I would be very interested to possibly listen in on it, and I might actually do that. But I'd be interested to see if this executive, I forgot his name off the top of my head, but the guy that was the CEO of Chewy that joined their board, that really kind of spurred some of the good news vibes that are coming out of GameStop over the past 6 months, whatever, that's kind of creating this short squeeze phenomenon a little bit as well. I'll be interested to see if he has a take and see what they think about it here.
Tomorrow, the company will release its first earnings report since the Reddit frenzy. Joining us now on the phone is Anthony Chukumba, analyst with Loop Capital. And Anthony, you've suspended coverage. Why? Is this hard to value in the current environment?
Well, to be more specific, I dropped coverage, and then the reason I dropped coverage is because, partially because the fundamentals have completely disconnected from the stock price. I mean, this is a stock that when I dropped coverage, my price target was $10, and so the fact that it's trading at these levels, to me, is nonsensical, quite frankly.
Yep.
What are the fundamentals of this business? What do you expect we'll learn tomorrow?
So I think what we're going to hear tomorrow is that sales trends definitely improved in the fourth quarter, as did profitability, but that was totally to be expected, right? We had these new video game consoles, specifically the PlayStation 5, the Xbox Series X and S that came out in November. If GameStop could not make money with new consoles coming out and everyone cooped up in their homes, they were never going to make money. But we knew from the holiday sales results that the holiday sales were disappointing. I think that GameStop has lost a bunch of shares. So we will see some improvement, but it doesn't mean that the core underlying fundamentals of this business are significantly better. The digital disintermediation trend has not gone anywhere.
Anthony, thanks so much for joining us. We appreciate you hopping on the phone with that brief preview for tomorrow's earnings. Goldman Sachs' CEO speaking out for the first time after an internal survey surfaced, which shed light on the working environment for some of the company's junior bankers, 13 of them, in fact, in total. The details coming out.
Holy crap. I mean, I think of the amount of ads that I put into a YouTube video is sometimes too much. I mean, they come back from a commercial for 3 minutes, maybe, talk to this analyst about one stock, and then they're back to another 4-minute long commercial break. It's bananas. I mean, the amount of money they charge for commercials during closing bell on CNBC has got to be insanely high. So in a way, you know, capitalism at its finest, get as much money as you can, squeeze as much, but geez, man, for the viewers, you're getting 30 minutes of talk time and 30 minutes of commercial time. I'll bet you the split is close to that. Whereas the average TV 30-minute episode of a TV show is 22 minutes of talk time and 8 minutes of commercial time. So it's crazy. Anyway, let's look at some of the stocks we had today. Of course, we're talking about GameStop because their earnings report are coming out tomorrow. Today, though, kind of sucked. It was down about 3%, a little less than 3% today. Was kind of up and down all day long. You know, nothing really crazy happening with GameStop. So, you know what? I've got the news up here in the corner. Let's see if there's any news of anyone talking about anything going on with GameStop here before we go into tomorrow's crazy day. Sorry, I'm just reading the news here real quick. Well, I mean, Wall Street expectation. Wall Street analysts expect GameStop to earn 1.35 per share on revenue. I mean, at least it's positive. Not only is it positive, the last year was 1.27. So if they come ahead of 1.35, if they're 1.4, 1.45, man, dude, it's game over. That stock's gonna go through the moon because I think there's just so much uneducated pent-up demand to buy more GameStop stock. Just as he was saying, it's completely disconnected from fundamentals. So if it comes in above, then, you know, who knows? Who knows is what's going to happen. Now, again, another reason why they're estimated higher is just because the guy I mentioned on that clip, you know, the new video game console is coming out. A lot more people are getting into gaming this year versus the year before. But still, GameStop is very primarily a brick and mortar type of operation, not so much an online presence like some of its competitors or some other types of things. So anyway, I'll let them talk about Saks. We'll keep talking over here. Let's look at some of the others. AMC, did they seriously just go to another commercial break? Dude, seriously. Like they just came back to say another preview about the Goldman Sachs survey that went out. And we'll be back for more. What is wrong with these people? Anyway, GameStop down, but not a ton. AMC could never make a comeback. It was down 10 today. Express also never made a comeback, down 12, almost 13 today. Cost down 6.67. Not a great day all around for a lot of these. Let's see how Tesla did. Tesla ended the day only up 2%. The NASDAQ and other tech stocks I thought were going to continue in a straight line up today. They did not. They definitely tapered off into the afternoon. Still a good day, still up 1.23%. Bitcoin went down pretty significantly here just in the last couple of hours. It's down below 55,000 for the first time since that kind of glitch back on the 18th. So if that sustains below 55,000, that's interesting. Let's see if that trend goes down, because it hasn't been sustainably below 55,000 since probably 2 weeks ago. So that's interesting. I wonder what caused that. It's probably going to cause a lot of the other Bitcoin related stocks to go down significantly. Treasury yield down to 1.64. So it stayed relatively low for the day. Let's all really hope that it stays low or goes down even more. I think that'll help a ton. Yeah, Tesla ended up 2.3, but it was up pretty high midday. It got to 699.62. So it lost a lot of steam later in the day. So overall, a very, balanced day. Some good, some bad. Tomorrow is going to be an interesting day. Could be a lot of fireworks. I'm looking forward to it. And so let's go back to the news here. They'll probably come back from their 30-minute commercial break any second now, and we'll watch the rest of closing hour and then finish up the stream here pretty soon.
On the Hill tomorrow?
Last week, an internal survey at Goldman Sachs surfaced and shed light on how some junior bankers were feeling. 13 employees took part in the survey, saying they're suffering from burnout from 100-hour work weeks and demand during the big SPAC boom. One analyst survey said, quote, "My body physically hurts all the time and mentally I'm in a really dark place," end quote. Goldman Sachs CEO David Solomon is now saying management is going to work harder to give junior bankers Saturdays off and to shift bankers from other divisions to the busiest teams in the investment bank to help ease the pressure. For more, go to cnbc.com. And guys, really interesting. This one has got everybody talking in the last week. And I would say, despite that very positive and warm response to it, to address the issues from David Solomon, which is great to see, and I guess you would expect as well, most of the people I've spoken to in the last week, and as I said, this has really got people talking in a way that often our stories don't. I'd say the response is pretty universal. I'm talking, by the way, to be clear, about people, my age, plus or minus 5 years, not senior management at the banks, Goldman or otherwise, and that everyone kind of sticks to the same tune, which is that people should know what they're getting into when they go into this. We're talking about people getting paid hundreds of thousands of dollars with a path to millions of dollars, and I don't think anyone's saying that money is more important than happiness or money is more important than mental health, but that you have the option to leave and focus on mental health if you'd rather do so than focus on money.
Yeah, I mean, I would say that's fair. I mean, I think a couple of things can be true at the same time, which is one, yes, this is kind of what you signed up for these jobs. It's always been a grueling grind, no matter what time it was. But also, it could be the case that this massive flow of deals that really has almost accelerated out of nowhere for SPACs and other things is outstripping the scale of the staffing that these banks have had. So I think you can basically have, yes, everyone is stretched even more thin than usual, but this is basically the bargain in these professions.
Yeah, I mean, it speaks to the comeback in the capital markets, how strong it's been for IPOs and M&A and SPACs and everything like that, if they're feeling this way, even with many of them working at home. Guys, as we look ahead toward
one very quick final point, I was just going to say, Sarah, the great change is that everyone's talking about it. Well, whatever your view on this, 20 years ago, as we said last time, I don't think you'd ever get the junior bankers speaking up. And today, 20 years ago, sorry, you might not see what the management is saying in response, which is all of this is going to be addressed in a positive dialogue way, rather than jumping to the extremes of someone, say, deciding to leave or getting fired or whatever it might have been. Yeah.
Yes, for sure. I mean, it went completely viral. And the fact that the bank is responding is notable. As we look ahead to tomorrow, one big highlight, Mike, is going to be Powell and Yellen on Capitol Hill. We know that Powell is going to reiterate his message that the Fed is in it to support the economy as long as needed, something he said last week in the news conference multiple times. He said it in a Wall Street Journal op-ed 1 year since the crash. What else will you be watching besides the bond market and how it reacts?
Yeah, it's mostly been the bond market deciding how we should feel about these things. I do think you want to be on alert for signs that the market's getting slightly nervous about the plateauing of case rates and maybe some of this travel issues. I don't think it's really a big issue now, but you have to keep one eye on it.
We are out of time here on Closing Bell. Thanks so much for watching. Fast Money starts right now.
I'm Melissa Lee, and this is Fast Money. Tonight's trader lineup: Guy Adami, Tim Seymour, Brian Kelly, and James McDonald. Tonight on Fast, back from the brink. Tomorrow, marking 1 year since the COVID bottom. We'll take a look at what turned out to be some of the greatest buying opportunities and find out if there's still buys right now. Plus, chips and dips. The semi's surging today, but the sector's still down over the past month. Should you scoop some beaten down names up? And later, we are gearing up for GameStop, the company reporting results tomorrow after the bell. And options traders are making big bets ahead of the print. We will break down the action. But we start with a party on Wall Street. Stocks pushing higher to kick off the week with all three major averages finishing in the green. The Nasdaq, the big winner, gaining 1.25%. But could this party be coming to an end? This is spring break in South Florida. People packing the streets, things getting so out of hand. Miami Beach declaring a state of emergency, enforcing curfews and restrictions to limit the partying and crowds. All this as COVID cases are back on the rise in more than half of the country. 27 states reporting a jump in new case counts. New Jersey pausing any further reopenings. And over in Europe, Germany and England extending their lockdowns of Poland, parts of France, other European countries are introducing new measures to curb the outbreak. So the question tonight, is the market ignoring COVID risks, taking its eye off the ball, just plain old getting too bullish? Guy, what do you say?
Well, obviously, hey, Mel, we look at everything through the prism of the market, right? So it's important to make it clear that, we don't want to see anybody getting sick. We understand what's happened over the last year. I think it's important to say that because people can slice and dice these, our comments however they want. With that said, in a perverse way, I think this actually might be bullish for the market. Why? Because maybe it'll slow down the move in bond yields. Maybe people will reinforce their belief that the Fed is going to be there regardless. And by the way, we've been through this before, and the market's learned how to deal with it. So of all the things that I'm concerned about in the market, and there are many, this isn't at the top of my list, and it clearly isn't at the market's either, being that the VIX closed below 19 today for the first time in probably 13 months.
Yeah, Tim, you brought up the VIX being below 20 earlier on a call today.
Yep. Well, it's just extraordinary. So a year ago, and we're going to do all these look backs, and we're going to have a great segment on what you'd want to invest in a year later. But, the VIX was 75 a year ago today. And Guy's bringing up great points about, fear has inspired unprecedented policy response. And so the fear of removing unprecedented policy response is what's had the markets have anxiety. What gives me anxiety is that you get to a place where the year of mulligans that we had, which was then on 2020 and really 2021 earnings, is something that you're going to have to address by the time we get to mid-year. And I think we will have to, unless you slow down the pace. So everything Guy caveated this with, we care about the world's health a lot more than we care about the stock market. I do think you have a case here where the market is going to be fine with bond yields coming down because there's more fear of less opening. And I think, unfortunately, that's just the market we're in. But again, I am not worried about the environment. If anything, I do see 7% GDP growth and a labor market that's 4.5%. And those are the Fed's numbers by the end of this year. That's going to be very, very strong backdrop ultimately for stocks. Let's just hope it's not too strong.
It almost sounds like between what Guy and Tim are saying that it maybe perversely sets up for a win-win situation. Brian Kelly, you either have a straight-up reopening that is very successful beyond our wildest dreams, the economy reopens, gangbusters, demand is there, and the stock market goes higher, or you have a reopening that has stutter steps, and maybe the bond market, the yields slow their ascent, and markets don't have a thing to worry about.
I think that's probably what the market's saying right now. I mean, it's just a couple different things. We showed that clip of spring break in Miami. I don't think it's just 20-year-olds that feel that way. People are ready to get out and do things. So when we do reopen, I think scenes like that are likely to be maybe not as wild as that, but people are ready to get together, go out to restaurants, go out to movies and shows and whatnot. So that is the reopening trade. Now, the caveat there is that has to be stronger than any of the tailwinds. So rising rates, inflationary pressures and all of that. And for now, the market appears to be saying, yeah, earnings growth are going to be a lot stronger than any inflation concerns. even though that is a tail risk. So I think that's what the market's doing. The one thing I would note, though, which is kind of interesting today, we talked about at the top of the show here, the NASDAQ started to rally. Now, that is where, some of these names are their idiosyncratic growth. That's where you get growth in a slowing environment. So maybe there is that rotation. So maybe the market is worried about COVID shutdown, and you're starting to rotate into the tech sector.
Yeah, I was going to point that out, and I know that James noticed that as well, but we had a lot of the stay-at-home trades, like a Zoom and a Peloton, do well. We had a lot of the really hardcore reopening trades, like the cruise lines, the airlines, particularly JetBlue, which has more exposure to Florida, really get hit hard today, James. So maybe the market is tipping off to some concern about what is going to happen.
Right. We study convergence and divergence in the indexes and correlations, and when the indices stop moving in the same direction, eyebrows are raised. And today we saw a recovery and a rally in the S&P as well as the NASDAQ, but a continuation of the selling that began last week in the Russell and the small cap. And it was just the opposite for the first 2 months of the year. Tech and the S&P were showing weakness, and small caps and value caps were rallying. And so I think that money is looking for a place to grow in this market today. And there's been so much bullish sentiment for so long now, this backdrop of a reopening trade and the reassurance from the Fed that protection will remain and there will be a tepid a movement of monetary policy as we see how things go. All this in the face of new cases and pauses to reopenings and pauses to announcements of going back to normal. There's a lot of uncertainty here, but there's been so much money made in this bull market that money wants to find a place to keep growing. And I think the energy of buying will consistently follow through wherever it can find a home.
Tim, when you took a look at what was going on with the airlines in conjunction with what we saw out of Florida, did that make you concerned about some of the names that you own, that even though we're talking about the markets broadly here, this could have a very specific impact on some of the names that you own in terms of the airlines?
Well, so I'm long Delta at this point, and I'm long Boeing, and I think Boeing is very much of an airline trade, as we know, and I mean traffic, not necessarily even some of their own specific issues. But I think you've got a case where the rally across the airlines was so extraordinary over the last. If you look at that Jets ETF and measure the airline industry, you can see the move we've had over the last 6 weeks. I am of the view that airline valuations aren't terribly interesting here. This is also one day. And I think the sentiment around today and the sentiment around really, I think Europe has had us concerned over here because on some level Europe has been a leading indicator in terms of what's been going on with the virus. What's different is that really, and thankfully, and it's proud to be American time. I mean, what's gone on here in terms of vaccinating this country and what's going on with some of the biggest drug companies in the world. Look, I don't think we're in the same situation as they are in Europe in some case. I don't expect, first of all, people are going to be responsible. People are going to do the right thing. But we are opening. And ultimately, if you're back to your airline trade, if you liked airlines on Friday, you like them today. You're not doing anything different. I'm telling you, I think airline valuations are actually not terribly interesting at this point. You've had a tremendous rally, and that airlines ultimately have proven to be great trading stocks. So with that in mind, I'm dancing near the door.
That's a good way of putting it, dancing near the door. You're still inside, but you're close to stepping foot outside there. Guy, how would you interpret what the market is doing? Because it seems like one day you're in tech stocks, the next day you're in, I mean, it's just, the rotation is on, and just, it seems to churn.
Yeah, I mean, it's clearly on autopilot in terms of, I think it's all predicated on bond yields and the comments out of the Fed. I mean, I think it's important to mention that, and I know most people knew this going in, but JetBlue filed or priced a $650 million convert, which is about 10% of their market cap. And the stock price, by the way, good for JetBlue, by the way, for taking advantage of the huge move in their stock. JetBlue traded up to the levels that we saw February of last year. I mean, so for all intents and purposes, the stock was basically right where we were before this entire thing started, which is pretty remarkable if you think about it. So obviously that weighed on it. And to answer your question, I mean, I think it's that simple. If you think, as I do, by the way, that bond yields are going higher, I think this is just a pause and the NASDAQ sell-off is going to continue. If you think for some reason we've stopped here around 1.7% or so and headed back lower, then it's all systems go once again. It really comes down to your view on yields. I think yields go up from here.
Our next guest says the market may be ignoring some key risks to the reopening trade. Let's bring in Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. Mike, always good to speak with you. Reading through the notes, it sounds like the thing that you're worried about is not necessarily a rise in caseload, et cetera, but once the economy opens, that demand will far outstrip supply of whatever it is, services, of goods, et cetera.
Yeah, that's right, Melissa. I mean, look, we try to worry about things that people aren't worrying about. So now everybody's focused on rates. That was what we were concerned about back in January. But now that move's happened. Now, I agree with Guy. I think that rates are eventually going to go higher, but we've had a heck of a move, and everybody's focused on it. So, part of today's trade is just, the rate thing came down a bit, and, the tech stocks could breathe. But the new leadership is clear, okay? I mean, it's crystal clear to us. It is a rotation into the, what do you want to call them, reopening, pro-cyclical value, whatever it is. That's the new leadership, and it's been established, and it really got established today. The vaccines were announced back in November. I don't think people are worried about a recurrence of the virus because we do have an answer to it. We do have vaccinations, and yeah, I mean, Europe's been behind the curve, but they're going to get there. The U.S. has done a really good job here, and we're going to get past this. Okay, so the market's looking forward. And so now, just like last year, the economy was horrible, but the market was great. We looked forward. And now I think we're going to be a bit surprised. People might be surprised that as we reopen, there's going to be cost pressures. And I think a lot of companies are going to have a hard time dealing with that. Not the end of the world, not going to kill the bull market or the recovery, but it's going to be more difficult. And it's going to affect probably small cap companies more than any others negatively, which is why we downgraded that space last week.
Hey, Mike, so you're talking about bottom-up factors and, oh, I'm sorry. Go ahead, Brian.
No, go ahead, Tim.
Okay. So at what point are you really looking at valuations, Mike? And your role as a strategist is to not look at anything in a vacuum, and you're talking about market factors. My point earlier was I'm really concerned at the point when folks like you and like us can only be focused on EPS and dynamics, at least in a static environment, all other things remaining equal. When do you think that's going to be, when these valuations make no more sense and the mulligan's over?
Yeah, I think it's been happening, right? I mean, that's basically our call for this year, is that as rates markets finally adjusted higher, people can no longer ignore, that stocks are stretched. Now, they went after the big growth stocks first. Okay, fine. Now they're going to go after some of these more speculative areas. You mentioned some of the reopening stocks, quite frankly, have gotten ahead of themselves. And so I think it's happening right now. And by the way, that's usually what happens at this stage of the recovery. You have the recession, valuations expand during the recession, then you have the recovery, rates go up and valuations come down. That's very normal. This time we have some parts of the market that are really stretched. And that means you probably have net negative pressure on the overall index, small cap stocks, some of the expensive areas. And you just got to be a little bit cognizant of that. I mean, the trick this year, Tim, as you know, as being a portfolio manager, is finding idiosyncratic stories that can kind of outgrow that multiple compression. But the game is on now. Multiples are going to compress this year, probably 10, 12, 15% at the index level, and that's normal.
Hey, Mike, so it's BK. You're talking about this multiple compression, and I imagine a little bit that has to do with some of the inflationary issues that you were talking about, some of the shortages we're seeing. But what is the trigger in your mind for when that multiple compression, which sounds like you think is going to be somewhat benign, turns into something maybe a little bit more violent? What should investors look for to say, okay, that's the trigger?
Well, like I said, I think in some of these really expensive areas, that trigger is already, that rate move has got people's attention. And I'm very comfortable saying right now that a lot of these stocks have made their highs for the year, and they may have made their highs for years, period, or plural. And so I think if you have been invested in very expensive parts of the market, I mean, you're on warning right now. And I think you need to be careful with valuation in those particular areas because I think those stocks may not recover this year at all.
Mike, always great to speak with you. Thank you so much.
Great, thank you.
Mike Wilson, Morgan Stanley. James, what do you make of the inflation pressures that Mike was talking about?
They're real. And, if we look at commodities and we look at the steepness of the rally, we see that there's a lot of crowding into those things. I've been watching deuterium, corn. I've been watching palladium. I've been watching a lot of the sectors that were hammered When the virus first came out, we saw auto production go to zero in China. It had a trickle-down effect. Inflation is real. However, we know that the Fed is going to protect us. We know that the Fed is going to offer support. We know that people are going to get stimulus checks, and so it's shrugged off, I think. Ultimately, when we get back to normal and the Fed starts to walk back or at least reduce its indication that it's going to come in and provide unlimited support, we're going to see these prices come down. I know we're going to talk about one of these stocks later, but I think that ultimately, this is a risky area in the commodity space as it relates to inflation mostly.
Yeah, I think the way Mike had put it, Guy, was I mean, obviously it's the right way. He's Mike Wilson of Morgan Stanley. But in terms of thinking about it hitting small caps much more, I mean, small caps can't pass on those price increases to consumer as well as larger corporations can and absorb that cost, the increased cost and whatever it is, by just taking some off the margin.
Yeah, no question. And that, you asked Mike what the trigger was for him or what it will be. The trigger for me, and we'll see if it's right or wrong, but for me, it was like getting through 1.5% in the 10-year. And that's, I think, when the bullish tailwinds became headwinds. And it's really manifesting itself in the Russell. You just brought it up. I mean, on a decent tape today, I think the Russell was down 1%. And if you look over the last couple of years, I mentioned this, I think, on Thursday, the Russell has led us up by about a 2-week or so head start, and it's led us down by about the same amount. It's interesting to see if that's going to be the case here. I do think it's going to be extraordinarily hard for these companies to pass on those costs. And I do think, like James said, I think inflation is absolutely here in spades. It's just a question of when the market acknowledges it, and I think we're pretty close to that point.
All right. Coming up, all aboard a $25 billion deal. Find out if our traders are booking a ticket on a mega merger in the transports. And later, the ultimate comeback kids. We found 6 stocks that have more than tripled from last year's market bottom. And our traders think some of these names are still a buy. We'll bring you the trades when Fast Money returns. Welcome back to Fast Money. Shares of Kansas City Southern topping the tape today after agreeing to be bought by Canadian Pacific Railway for $25 billion. The deal creates the first freight rail network connecting the U.S., Mexico, and Canada. It still needs approval from U.S. regulators. BK, you on board with this deal?
Yeah, you know what's interesting about this deal is you think about this reshoring effect, right? And so things are going to likely be more transported more by trucking and rails. And the one thing, you know, Charlie Munger's always said this, they're not making any more railroads, right? We're not going to put in a new railroad. The cost to do that is outrageous. So this, I think, is actually a pretty good deal, but it's a longer term type of deal where these companies are going to do well over the next couple of years.
Canadian Pacific has tried to do this a couple times in the past, 2014 and 2016, I believe, Tim. Do you think regulators approve this one? They are the two smallest of the 7 North American railroads, but still.
Yeah, I think a lot of, look, this has been carefully thought out and so unanimously voted through by both boards. I think there is some sense that this is a deal that could get done. Therefore, it's a deal that got done, and it got done at a level that made, you know, a lot of sense and probably couldn't have come a lot more expensive than, you know, about 16 times EV. But I like the deal. I like the upward pressure it puts on multiples in the space. I like the synergies, but I like the pricing power. I like the efficiencies, and look, I like the charts. Transports, ultimately, if you look at the IYT, this is one of the great charts off the lows of the crisis. But really, on a 5-year basis, outside of a stall, really kind of going into COVID, this has been just a great sector to own, and companies like FedEx and you know, UPS. But then we've talked about the airlines, which may be a little bit more tactical. But in case of the rails, these are companies that have gotten better and more efficient, and I think they're a place to stay.
Guy, I know you like the name, the proposed name of the combined company. It's very creative. Canadian Pacific, Kansas City. Do you like the deal, though?
You know, it's interesting. I don't think it's, you know, I don't think it's coincidence that this deal was announced during this administration. You know, quite frankly, it's funny. Kansas City Southern is a name we talked about 4 years ago, I believe, at probably 1/3 or so the price was that we're talking about now during the Trump administration and all the rhetoric around Mexico and stuff. And we talked about it glowingly then. It's hard to really be as enamored of it now, given this valuation. But what I will say is, yes, I like the deal. And I'm surprised at how poorly Federal Express continues to trade. Listen, I thought it was a great quarter. You're talking about a stock that should have at least a 16 multiple. And on the back of the $20 they're going to earn next year, you should be talking about a $320 stock, in my opinion. But here we've been meandering for the last 3 or 4 months. Leaves me scratching my head. I think if you really want to find a place to be off what I thought was a very good quarter, it's Federal Express.
Quickly, James, your favorite transport?
Wow, that's a great question. I wasn't expecting that one. I study the indexes, and you know the transports broke out all-time high today. This is the time when mergers and consolidation happens up at the upper echelons of bull markets, and so this is expected. I think the deal will get done, but I don't directly invest in any specific transport name.
All right, got it. We have got a lot more ahead here on Fast Money. Here's what's coming up next.
Stocks have surged in the years since the market's pandemic bottom. But is there still an opportunity in these soaring shares? Plus, semiconductor stocks ripping higher today, but still down big from their recent highs. We'll break down the chip tip and which stocks could still be worth a buy. We've got all that and more when Fast Money returns.
All right, guys, I think we're going to take this opportunity to sign out. It's nearly 4:30 over here in Central Time, so it's 5:30 Eastern Time. Haven't seen a whole lot of movement after hours. Tesla is just continuing to stay down after hours. So we'll see. They're squandering all the ground they made up during the day today. AMC had a little bit of an increase there before the after hours, and then it's just kind of tapered off since then and settled down here. Same really with Express as well. I guess it kind of tanked a little before after hours. Yeah, just all around for these guys I have here on the board, not a great day. Not a great day at all. I think I have a little bit of positivity in Bed Bath & Beyond, but that's about it, and that isn't unless it tanked here at the end of the day. So yeah, it was just barely a game there, but that's about the only real meme stock that had a great day today. Overall, the markets were up, but these guys kind of brought everything down, which is a bummer. And then the major indexes actually tapered off and lost some steam there at the end of the day. So they're still positive, but not the best finish into the gates there, unfortunately. So yeah, we're gonna sign off here. I appreciate today. So if you guys have been keeping track, if anyone of you is still here listening, this is the largest amount of views we have on the video during these live streams. 32 views today, which is super awesome. I know I've at least earned one new subscriber and 10 likes. 32 playbacks, 10 likes, one subscriber. Those are by far the highest numbers I've had on any of these live streams. Here's the deal though. I may or may not be able to live stream the full day for the rest of this week due to stuff going on with work. Might be able to live stream some of it, but not all of it. I'm not really sure yet. But either way, if I can't, then I will get back on the horse next Monday and join back on with the guys. If not, I might touch base with some minor videos like what happens with GameStop's earnings tomorrow, things like that. So if you do want to be able to make some just quick videos and upload to the channel like normal rather than doing some streaming. So otherwise, I'm gonna get out of here. I appreciate everybody who has joined.